as the company claims. Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to see.
Very good morning. You're watching India Market Open, and we're set for, after that little pause of Thursday, folks, we're set for a good start to the day and a pretty good morning.
I have a very interesting did you know?
Okay.
Even I didn't know. So I can't really say whether.
Now we know.
But yeah, now we know something like that. Vietnam needs so much sand to service its booming economy that it imported 27 million cubic meters of sand from Cambodia last year.
Wow.
Can you guys beat that? Here's an economy which is growing and doesn't have sand.
Wow. That is
interesting. Yeah.
That is definitely interesting.
I'm glad that India has no dearth of sand.
Yeah, but that's why our beaches are kind of disappearing because of sand being used in construction, but that's a whole different...
And it's flying around the city.
That's a different thing. But yeah, the cheerful mood is because you are set for a pretty good day today. Look at the implied open. Let's start with that. And we'll set you up for what you can be expecting. Meanwhile, 140 points up is what we're expected to open at. The rebound is continuing on Wall Street as well. US stocks have continued their rebound for the third consecutive session. In fact, all key indices up in the green, 2.5%, nearly 3%. On the NASDAQ, S&P 500 about 2% and about 500 points up on the Dow Jones as well. So what's happening is that trade conversations are on in the Trump administration. And of course, in the last couple of days, Trump is toning down on China. He's saying he's not going to fire Jerome Powell. Street is taking some reprieve. Alphabet results also helped a beat on top line and bottom line for Alphabet. The stock was 5% up, because better than expected quarterly results. What I found very, very interesting, guys, and this was just one thing I wanted to share, the AI feature that Google has started, because that's the big threat.
On the search.
Right, that's the big threat to them as a search engine, right? Because if everyone has an AI feature, am I using other AI chatbots to search or am I using Google? The AI feature has gone to 1.5 billion users a month.
Interesting.
1.5 billion users are using that AI feature. So it's insane. The future of search
engines
is changing.
But I'm wondering, okay, so am I wrong when I say that when you do a search, like I was looking at Avas Financials for the results today, and it actually gave me, I was looking PB FinTech, and it gave me history and all of that. So the default search also gives you that AI?
The default has become AI.
AI first.
What they've done is they've moved to a default AI and seems to have worked for them, because that was the concern with Google always, or with Alphabet, that other perplexities and the Groks and the chat GPTs of the world going to take over the core search engine function. That's work. What's not worked is YouTube. Those advertising revenue slightly below par. But anyway, bond yields continued their downward trend, the 10-year at 4.3%. Oil has remained largely unchanged, Brent at about $67 mark. Asia looking decent in, as far as the opening is concerned. And like we told you, the India implied definitely up in the green. So that's important. Shanghai completely flat right now. What's important is what's happening on trade wars. And I just want to place for you two quotes which have come out. One is from the Chinese side, so the Ministry of Commerce spokesperson He Yadong said yesterday that if the US really wants to resolve the problems, it should cancel all unilateral measures on China. He's also denied that there are any kind of trade talks which are on right now. Meanwhile, the Treasury Secretary Scott Bessent says, we have had a very successful bilateral meeting with the Republic of South Korea today. We may be moving faster than I thought, and we will be talking technical terms as early as next week. Also, news reports that India could be one of the first nations to ink a trade deal that would prove a further fillip to the markets. In fact, let me take that question first to Jeffrey Dennis, independent emerging markets commentator, who's joining in. Jeff, always great to have you on the show. Thank you so much for your time and for joining us this morning. Let me start with the pace of trade deals, and does that become the next catalyst for what we see, especially in the Indian context, where even FII seem to be rediscovering the India story?
I think the trade deals are very, very complicated to put together. Significant, deep, detailed trade deals are very hard to put together. And therefore, I personally don't think we should get too carried away about any individual country and how quickly they can do a trade deal with the US. Now, obviously, there could be a quote unquote trade deal because China decides in concert with the US to reduce these ridiculously high tariffs, without there being much behind it. But to see broad trade deals across all of these countries that want a trade deal, it's going to be very difficult. I think India remains in a relatively good situation vis-a-vis trade deals. For a start, it doesn't have as big a deficit with the US trade deficit as do a number of other countries such as Taiwan, such as China, such as Mexico, and such as Korea. Also, India is a relatively closed economy. Economy is not as much impacted by the export sector. The export sector, let me put it another way, is not as big in the Indian economy as in other economies. And you're also getting some benefit from things like soft oil prices. So the very nice rotation back from China into India since the beginning of since the beginning of April, which is worth about 900 basis points according to the MSCI relative indices, I suspect will go a little further. So that's really the way I see India at this point.
Jeff, just to go further on that point that you just made. Hi, morning or good evening where you are. CLSA just put out a note. It said that uncertainty on global trade is bringing back TINA, which is there is no alternative. And Neeraj and I had a couple of chuckles. It's been a while since we were talking about TINA in the context of India, so TINA is turning. And so the question that I have is, we've seen significant flows, foreign flows into India over the last few sessions, particularly yesterday, 8,000 plus crore on a net basis. The question is about the durability of that. So if things change very dramatically in the US, and earnings has not been terrible, you have 75% of the S&P 500 companies so far, 157 companies that have actually beaten estimates. So if things turn on that trade front, could money flow back very quickly?
2 points there, I think, 2 areas of discussion there. First of all, I tend to believe that we're getting a short-term bounce here. I'm not saying we haven't passed the bottom, but we're getting a short-term bounce. It's very powerful. But I don't think the selling is over necessarily for a number of reasons. First of all, we've still got to get through the US economic data, which will eventually deteriorate. A lot of support for the data right now by short-term buying ahead of the tariffs, whether it's by companies or whether it's by consumers. Inflation's going to pick up. The Fed's not going to be able to do very, very much about that. And as I say, I think we're all getting a little carried away about where these tariffs are going to go in the short term. Are we going to get trade deals? So my base case here still is that I think the dollar probably drifts lower again at some point. The bond yields are a tug of war between the weak US economy and if you like, the sell America trade, which is stopped for the time being. And also, I think equities in the US will pull back for a period of time. Now, how does India do in that particular context? I think it does very, very well. because in relative terms, it is a defensive play in relative terms, especially within Asia. If you look at these big four markets in Asia, China is absolutely in the gun sights of the US, if I can use that expression. In terms of the trade war, the high tariffs, we know that. The Korean economy has just fallen, looks like it's going to go into recession, has a huge trade surplus with the US. And Taiwan is very dependent on the performance of TSMC, which of course is very dependent in turn on the Mag 7 in the US. So you look at these big markets in Asia, I think the flows that have come back to India are absolutely the right trade. And I think those flows will continue. Again, in a context, to be fair, in my view, where I think we're going to see a bit more global selling eventually, and this is not going to be a straight line back up again, because I think the fundamental challenges here are still severe. The US economy, the scale of the tariffs, the trade war that's going on, the uncertainty generated by this, and frankly, the terrible and capricious policies of President Trump.
Yeah. Jeff, good evening to you, Neeraj here. Been a while, so lovely talking. Just, I understand it's very difficult to predict what could happen, but I heard your view on what could happen to EMs. Just one thing here. I have counted at least 5-6 instances wherein there has been a public declaration by the US about either a visit to China or a visit from China or a trade talk with China, etc., with almost complete rebuttal or non-acceptance of that from the Chinese end. So what's happening here? Is it that, even yesterday Donald Trump has said that, we are talking to China, and China said that it's all or nothing. Unless you take it back, we're not going to talk. So my question is, could it well happen that unless all the things are... Sorry, you want to make a point?
No, keep going.
No, I'm just saying, could it well happen that unless all the tariffs are taken back, there might not be a conversation at all in the first place, and therefore this tariff war, as we see it right now, may cease to be one altogether?
Absolutely. I think that could well happen. Now, first of all, neither Trump nor Xi Jinping want to talk to each other until we have the fundamentals of a trade deal. That is obvious, and we're hearing that from both sides. And we don't have that yet, so I would not expect to see Xi and Trump talking. I think there probably is some low-level official conversations going on between the US and China, which could end up with some easing of this tariff situation. But what I think is very interesting is if you look at the public comments from both sides, they are saying, the US is saying, we won't talk to China until China reduces the 125% tariffs on US goods. In other words, reduces or even removes the retaliatory tariffs. And China is saying, we're not going to talk to the US until the discriminatory tariffs on China versus the 10% across the board, which are on a lot of other countries, the base level of tariffs, until we get back to that sort of level. So everybody, both sides are waiting for the other to take a step here. And frankly, I'm not sure they're going to do that. I think we've got a lot of water to flow under the bridge here before we get any sort of decent trade deal, which I think is going to justify the market's optimism. Now, Trump, of course, could come out and say, forget the reciprocal tariffs, which we were going to put on, and then we delay them for 3 months. Maybe he could cut tariffs here and cut tariffs there. But to actually settle the China-US trade war, which it is, I think it's going to be very hard. And you can see that from the lack of really high-level negotiations. And both countries want the other side to act first.
Thanks so much, Jeff, for joining us this morning, and pleasure having you always. All right, let's talk about what happened in trade yesterday. I want to start with that foreign institution number. I did refer to it when I was speaking to Jeff, but it's quite a big number. In fact, it is the largest in this month so far. The only one that eclipses it in the recent past is at the end of March, when you had that 11,000 crore odd net buy number by foreign institutions. And what's interesting is that there are no big bulk deals or anything like that to talk of. So it seems like it is buying in the secondary market that has taken place through the session yesterday. They have now bought along with that yesterday's buy number, 29,517 crore rupees in just 7 sessions on a trot. In fact, for the first time in 7 sessions, or rather after 7 sessions, you had the Nifty 50 cool off, and it saw just a narrow decline of about 1/3% or so, led by both banks, which have been on a red-hot rally, as well as HUL, which bore the brunt of selling after the outlook for the coming financial year was not as pretty as some had wanted it to be, and that margin picture is a bit of a concern for them as well. Bharti Airtel also lost ground in trade yesterday. In fact, take a look at some of the worst performers on the Nifty 50. You had HUL, which led the declines down about 4%. The others didn't see too much of a crack. You had Bharti Airtel that lost about 2%, Aisha about 1.6%, ICICI Bank about 1.5%, and Zomato also on the back of those top management changes that have been announced was under a little bit of pressure yesterday. All the benchmarks traded in a very narrow range on Thursday, and so that consolidation was evident after that one-way rally that you saw over the past 7 sessions or so. In fact, most sectors ended in the red, led by realty as well as FMCG, consumption. The one that bucked the trend, though, was pharma, and it gained about 1.1%. Quite a few interesting names from the broader pharma healthcare space also buzzing in trade yesterday. And by the way, metals also managed to eke out gains of about 0.2% or so. A couple of big movers that I will highlight because they've probably been on your radar. Sterlite Tech dropped about 25%, but that is post-demerger. The stock traded ex-demerger on Thursday. And in fact, if you don't remember, the company completed the demerger of its global service business earlier. The second that I want to point out is Syngene. And we spoke about this at the start yesterday. It was a weak set of numbers. 12.8% was the decline in trade yesterday. The FY26 guidance was significantly below expectations. The revenue growth is seen only at mid-single digit, and the new biologics division is set to increase operational cost and increase depreciation, as a result of which EBITDA margins are set to moderate to the mid-20s from the 29 odd that it currently has. A few notable gainers from the broader markets. Newgen Software was up about 11%. MMTC also by that same amount. Whirlpool, Sonata Software, and Natco Pharma were all buzzing in trade today. And there were a few more, but the market breadth was tilted just a tad bit in favor of the declines, Neeraj, yesterday.
Yeah, but this is all. I mean, I was just looking at how easy or difficult it is to predict anything, right? So, all things Trump and trade. Trump says US is talking with China on trade. Japan is saying, oh, we will not join a bloc against China. Besant is saying US, Korea understanding next week. Yesterday we had rumors of India, US happening so much. So if that is also becoming so difficult to predict, and if on that is what the daily trade is hinging, then it's very difficult to predict that, right? But if you just take it back a little bit, and I know Puneet will talk about it a lot more, but if you just see the expiry, post-expiry, the market-wide rollovers were slightly lower than the previous month. And one would have presumed that this month would have actually seen a fair degree of longs. So the longs, if there are that have not been rolled over. So there have not been aggressive pushbacks. Now, is that because there's so much of tariff uncertainty that people want to play safe? I think because it's the Liberation Day series or Liberation Day month. So kind of people have maybe taken a bit of a back seat on that. Undertone seems positive, right, guys? I mean, almost everything we hear, including the CLSA headline today or otherwise, or maybe the FI buying that we're seeing, the undertone is positive, just that at the valuations that we are at, and what even Sonthalia was saying the other day, Manish Sonthalia, if we are in a band which most people believe we should be based on earnings, and we are at near the upper end of the band after today's open, right? Yeah. 25,000, circa the top end of the band, we're probably there. The only sectoral thing that stood out for me somehow from all the commentary, and we haven't heard from KPIT Tech as yet, I know, but from everybody from LTTS to Tech Mahindra to anybody else who's come in, is saying that the automotive vertical for almost all tech players, including ER&D, is weak. And we'll obviously see LTTS react today and we'll talk about it. But I think that bucket probably will not see a recovery. So that seems to be the most predictable thing, that autos are weak and therefore auto ER&D focused players. HCL Tech has that, even though the other verticals are firing. But KPIT, entirely auto. It'll be interesting to see. I'll not be here, but 28th, it'll be lovely to hear that. I'll observe it on our channel, what's happening with KPIT Tech commentary as well, but LNTTS, etc. and stuff like that. So that vertical seems to be really troubled. Maybe we'll have a problem there.
I just want to make a very quick point. 2-3 weeks back also, this valuation picture conversation was entirely different. So the kind of rally that we've seen in the last 8 trading sessions odd or 10 trading sessions has changed it towards what Manish was saying, which is 25,000. Just for 3 weeks, 3 weeks has changed the game completely.
Now we're talking about 26,000 with a year's outlook. Was the conversation last week? I don't know if it's going to take a year.
Yeah.
I don't know if it's going to take a year. Might be earlier.
Yeah, December end targets were that.
Yeah,
Agree?
December end targets were 26,000. Are we advancing them? Are we going to sit in this range for the rest of the calendar year? I'm not too sure with the way things are going.
But I'm interested in listening to what Puneet has to say with regards to rollovers, because that was the interesting point that stood out this time around.
Yeah, absolutely. Before we go to Puneet, some of the factors to watch, and apart from what Neeraj added on the auto verticals, I would also watch out for consumption, because we had a fair amount of data coming in from Nestle, HUL, Tata Consumer before that. So that hope is kind of getting busted on the consumption pocket, where it really seemed like it would be better than expected. The big bet was on consumption. But on the other hand, a lot of the results which have come in so far have not really disappointed on the downside, perhaps because expectations were so low, which is why your corporate results are going to continue to be in focus. Reliance Industries will post results or announce results after market hours. I'd watch out for RIL, because if RIL fires, then this is going to be good for the Nifty at least. I would also add that the close on Thursday does indicate potential signs of fatigue in the short-term uptrend, even though you might have a pretty good start. Analysts suggest that any minor dips could be buying opportunities. We've been hearing that for a while. The opportunity of a dip has not yet presented itself cogently. The overall trend, though, remains positive, but consolidation is expected over the next couple of sessions. You can see a Nifty support at 24,000, resistance at 24,321. Bank Nifty reflecting a resistance at higher levels. Despite the consolidation, it has held above the key 55,000 support zone. Support at 55,105, resistance at 55,457. The RSI at 72.3 is showing slight signs of cooling, but above 70 still is in overbought territory technically for RSI. So is it still overbought or not is the question. And Puneet, after the expiry yesterday, what is the picture looking like?
Well, thank you for that. And just to start with, the point that Neeraj also was making, rollover data, we presented it yesterday. For the Nifty, it was 57%, generally averages between 70 to 80%. So yes, it's been very negative. And for Bank Nifty as well, actually, it was just 11% rollover data. So essentially, traders are pulling back their current positions and, waiting on the sidelines as of now. That's what it is, because they've closed their April positions, but not rolled over the similar position in May. When you look at the implied open, suggesting, premium, of course, of 126, but implied open suggesting 134 points. It's interesting because for Nifty, essentially the level to watch out for the next one is 24,360. We're starting off above that level as of now. It'll be interesting if we can, close above that level as well, because yesterday we saw a reaction on IT stocks because of LTIMindtree. Today also it's a very, it's a 2 and 2 basically, because we've had Emphasis results which were decent. Tech Mahindra was decent. But on the other hand, we had other two results of Scient, which was actually negative, and LTTS as well, as you guys mentioned. So definitely, a lot of fundamental factors will move the index today. If we can also follow up the Bank Nifty as well. That's been an index that's been slightly under pressure. 55,200 is the level to watch out for here as well. When you also look at the OI distribution as well for both calls and puts, we have seen a maximum call open interest at 24,500, and that level has building up slowly over the last couple of weeks. 24,300 was the level which we highlighted yesterday. That's another level to watch out for on that aspect. On the put side, it stays firm at 24,000. Finally, if you can look at some stocks as well on the both gainers and losers side in terms of open interest, and again some fundamental factor backing it there, because we've seen some short build up in Syngene, and we saw the results, and Alex also mentioned about them. While ACC, we saw some long build up, results were largely in line as well. Apart from that, if you can look at the open interest losers as well, and we saw some long unwindings on LTIM, again a result that wasn't in line. So the data also for May futures suggesting that as well. And the very strong FI buying number, largely of 8,000 odd crores, while the index was down yesterday by 80 basis points, we didn't see too many trends in terms of either that kind of inflow went into banks or went into IT. So that will be something to watch out for in this next week if the FI buying happens. But it's the highest in the last 4 weeks. That's a big positive number, at least a big silver lining essentially going into trade today.
The FII buying definitely is, I think, a little more than a silver lining, because you're seeing domestic investors then maybe taking money off the table. But a good set of numbers that have come, so far in the evening, at least the first on my watch list. I'm starting with Axis Bank, giving it a thumbs up basis, the numbers that have come in. And let me just take you through everything on Axis Bank. Here's what's worked. Net interest income was slightly below estimates. Credit cost decline has aided the profit beat. Much awaited 1.8% of ROO and 17% of ROE is what we have seen. Deposit growth was extremely strong at 7% Q on Q. What didn't work? Maybe the loan growth that was well below expectations. Now, here are the core numbers as far as Axis Bank is concerned. Net interest income was at 13,811, up 6%. Net interest income was a little below NDTV Profit estimates. Operating profit at 10,752 crores, up 2%. Provisions at 1,359 crores. PAT at 7,117 crores. And I think the NIM figure, important for me, up 4 basis points Q on Q, 3.97% versus 3.93%. So they've managed to hold on to that. What are various brokerages saying? I'll add Macquarie here. They've maintained an outperform with a target price of 1,440. All eyes on loan growth trajectory, they say. PAT in line, aided by high OPEX, low treasury income, offset by higher NIM and lower provisions. They also say credit costs are lower than expected. GNPA is 18 basis points down, which is something that they like. Current liquidity environment to aid deposit and loan growth. TechM has a few mixed views as far as brokerages are concerned, but all in all, TechM getting a thumbs up from our side. Revenues were flat at 13,384. In line with estimates, EBITDA was up 2%, margin at 10.5% versus an estimate of 10.3%, net profit at 18.7% at 1,167 crores. So what's the story with TechM? Results were largely in line. Deal wins stronger than analyst expectation. Top 3 segments largely flat to low single-digit growth. What are brokerages saying on it? Pull up the Investec note, saying they've maintained a buy with a target price of 1,672 versus 1,510. They say they've delivered on their promise of improving growth trajectory. Deal wins during the year have grown 42.5% year on year, the highest versus the peer group. This is why that thumbs up on a TechM. Their ROCE has also increased from 14.6% at the end of FY24 to 22.6%. They believe this is the only tier 1 company that could potentially deliver higher growth in the next decade. Macquarie has though maintained an underperform, saying encouraging deal wins but misses estimates. Margin benefits from Comviva are seasonal, which is why they're not so excited about this. Management suggests that its original FY27 margin target was based on normal industry growth rate and not factored in the headwinds right now. So they're not sure if those FY27 targets could be met. But all in all, TechM thumbs up this morning. Likewise for Macrotech. So what are the key highlights for Macrotech? Robust pre-sales growth in Q4 has beaten FY25 guidance of 17,000 crores. Company has registered 30% of pre-sales from new launches in FY25. They've added 10 new projects with a GDV of 23,700. So that's greater than their guidance of 21,000 crores. Their net debt to equity ratio also remains below their ceiling level of 0.5 times. Macrotech developers, just let's run through the numbers very quickly. Revenue up 5.1%, EBITDA up 16.6%. Margins have also improved. And for a realty company, not half bad to see margins at 28.89% that we are seeing for the fourth quarter consolidated year on year. Net profit also up 38.4%. And guidance is bullish. Valuation, of course, is what's limiting upside as per Morgan Stanley. There's a Morgan Stanley note on it, and they've maintained an equal weight with a target price of 1,230. So you're seeing a decent kind of a morning, at least for the first 3 on my watch list.
Yeah, and the first one on my watch list is also something that, in fact, our guests have pointed out from a space that is relatively undervalued, the life insurance space. And SBI Life is a counter that I want to start with because the numbers came through yesterday. And on the face of it, take a look at it. So the growth numbers are not great. The net premium income is down about 5% at 23,860 crore rupees. The net profit is up only about 0.4% or so at 813 crore rupees. The thing is, if you look at the margin picture for this company, and it's improved very dramatically. And the reason for that is a change in the mix, in the product mix. They are focusing much more on non-par, which is non-participatory products. In case you were unfamiliar with the term, it relates to terms like products like term insurance as opposed to ULIPs. So these non-par products usually have a higher margin, and as a result of which the margin profile of the company changes if there is a significant shift towards non-par. For example, Life Insurance Corporation of India does not have a very large amount of term insurance that it sells, as a result of which any increase in that mix will result in an improvement in the margins. But take a look at this. Their non-par product mix, SBI Life, is at 35% versus 22% in the previous quarter and 26% in the year ago period. So there is a considerable shift. What our brokerage is saying, UBS has maintained a buy with a hike in the target price to 1,915 rupees. And it says that there was a beat in the value of new business, and the AP has grown about 9%. That's the annual premium equivalent. VNB has grown by 7% on a year-on-year basis. The banker channels, which is essentially the sales that take place through the banking channels, that growth has stabilized. And the change in the mix that I just spoke about has impacted agency growth. By the way, Citi has a similar view, and it has also hiked its target price just a bit. PB Fintech, and I thought that this was an interesting development because, and by the way, I think that it is a positive development. It has completed the funding round, which it had spoken about in March for its arm PB Healthcare Services. And PB Healthcare Services was a gamble, if you can call it that, because it's an insurance broker that is starting a company with hospital services or medical services. And I think this has been talked about by a few entities. I think Narayana has gone the other way, where it's talking about launching insurance for healthcare. But what has PB Fintech done? It's invested 539 odd crore rupees into the arm PB Healthcare. And as per the seed funding round, other investors could deploy about 922 crore rupees. The investment is lower than the earlier envisioned 696 crore rupees. That was the approval that they had gotten in March. And the stake as a result of this fundraise in PB Healthcare has fallen from 100% to 32.14%. The plan, of course, is to start operations by the end of 2025 with 1,000 beds in the first year of operations. And PB Fintech intends to further dilute its stake in future funding rounds to 25%. So it's not a very significant capital deployment in the larger scheme of things, and if it works out, it's going to bode well for the company going forward. The last stock is Aavas Financiers, thumbs up as well, and this is a good set of numbers. The net interest income is up about 14% or thereabouts. However, bear in mind that the impairment was up about 25% sequentially at 7.6 crore rupees. The net profit is up about 8% or thereabouts. The AUM has grown about 18%, which also is slower than it's managed over the course of the last several years. In fact, that trajectory or that growth number is the lowest in 8 financial years. But having said that, the NIM or the net interest margin has improved in the quarter gone by. In fact, it was the highest in FY25, stood at 8.11%, and they've managed to keep their return on assets at 3.27% as well. Asset quality has improved marginally, though it wasn't a concern to begin with. It came in at about 1.08%, the gross non-performing assets, and net non-performing assets have come in at 0.73%. Morgan Stanley on Aavas Financiers has maintained an equal weight rating with a target price of 1,780. It's actually a downside from this point. They've said that the PAT was in line, and they are positive on the fact that the management expects a 20+% increase in disbursements growth and 20% loan growth in FY26. The target of 50,000 AUM in the next 5 years is something to watch. And they say, however, that the valuations as they stand right now appear full.
ACC, the first stock on my list. The numbers are known, significant improvement in the unitary EBITDA, but what brokerages are saying is interesting. Citi, Nomura, for example, says that the strong volumes and realizations driving this recovery of unitary EBITDA is a significant positive. Citi's hiked the target price, saying that any possible swap ratio while in favor Ambuja when the merger happens, the fundamentals are constructive, and hence ACC is something that I'll watch out for. Cement is not exactly in favor. Keep an eye out though for ACC. Cyient is the other one. Revenues were down 0.9%, so flattish, but margins went up quarter on quarter. Profit after tax up 39.3% on a day when IT service firms have not done too badly, by the way. Emphasis numbers and commentary is also looking okay. Watch out for Cyient. But like I said, ER&D not so, and LTTS is a disappointment. The stock may likely react. Revenues were up 12%, which is strong quarter on quarter, not bad really. Maybe marginally missing estimates. EBIT margin though, significantly missing estimates. 13.2 versus 15.9. The estimated were nearly 18%. Don't know how, but forget the estimate. 15.9 and 13.2 is a miss by itself, as a result of which the profit after tax down 3.4%. The company's guided to double-digit constant currency revenue growth, which is a strong number per se, but it is weaker than anticipated. And as a result of which, some brokerages, including Citi, have revised the targets downwards. Citi's revised the targets by 7 to 8%, the estimates by 7 to 8%. Watch out, won't be surprised if LTTS reacts a bit negatively in the session today. So those are the top 3 on my list.
Yeah, but a lot more. There's so many stocks to cover this morning, so we're going to put it together on this watch list for you very quickly so you don't miss anything. Here's what's on our watch list. Aavas Financiers, another one to look at. Thumbs up from our end. Strong NII growth. Margins have improved. Ami Organics, stock split 1:2, so some action there. Axis Bank credit costs have declined. They've been a beat on most indicators. Macrotech, robust pre-sales growth, beat of FY25 guidance. Emphasis, BFSI, TMT have shown strong growth in constant currency terms. SBI Cards as well. Margins have recovered. Credit costs have declined.
Okay, and there's also Tech Mahindra, strong deal win, and this has met estimates from the IT pack. More hits than misses so far, and that's something to cheer, I guess. On the other side of the spectrum, you have Cyient, which has posted a relatively weak set of numbers. The margin guidance has been lowered, and so therefore it could be under pressure. L&T Tech, Neera just spoke about both of these entities. Weak results, and the revenue guidance is below estimates.
Yeah. So tech is the interesting beast because, like we said, I mean, these are weak. Emphasis, the strongest quarter in the last 3 years, QOQ growth, and deal wins okay. So it's a bit of a mixed bag, right? HCL Tech also did reasonably well. So much to talk about on tech and otherwise. Dipan Mehta, founder and director of Elixir Equities, with us on the show. Dipan, good having you as always. Thank you so much for taking the time out. Everybody grappling with figuring out if we're closer to the upper end of the range of 25,000 that everybody's generally talking about. Is this the time to not be too aggressive? Or as CLSA says, that it's the return of the TINA factor for India. There might not be too many alternatives other than Indian equities.
Good morning, Neeraj, and thank you for having me on your show. I think that the entire complexion of the market has changed. We were really scared around the time the Trump tariffs were announced. They were crazy, and that would have led to a complete freezing up of global trade and would have impacted the real economy really badly. And it kind of brought up the ghosts of 2008. But now I think that the Trump tariffs are on pause and there's a lot of bilateral negotiation taking place. So the risk factor from that particular development has reduced, and to an extent, the stock market has also discounted it, and it has recovered pretty well from the lows. So I think that we're entering into a new phase in the bull market, in this multi-year bull market, and all corrections are good opportunities to enter into stocks, increase your exposure. But I think as it goes with all bull markets, you need to be a little bit selective in which sectors you're overweight in, and within that, which stocks that look most attractive. So it's not going to be across the board bull market, across the board stock prices going up, but I think it'll be quite selective. At the same time, I think there'll be enough opportunities as well for investors to deploy their capital.
You know, Dipan, I think when everyone was very down and out on the markets, you were the one who said the tide is turning, and that has been proven completely correct. And you were one of the first ones who said that on our platform, at least. The point is now about sustainability. Do you look at the bank rally pausing for a bit or continuing stronger? Are you excited about what you're seeing with banks right now?
Yeah, Tamanna, I think, first of all, good morning.
Good morning.
Yeah, I think that banks have got into a new growth phase. See, banking per se is a highly cyclical industry, and we are entering into an upcycle over there. Valuations are reasonable, and RBI rate cut has benefited the banks. Liquidity has improved. Overall economic activity has picked up, so credit growth also should look up. I think NPA provisioning is flattening out for a lot of banks, so core pre-provisioning profits will start to flow to the bottom line. And most importantly, FI selling has, reduced. And earlier in the last 2, 3 years, FI selling was focused on banks where they were the largest owners and largest holdings were there over there. So from a fundamental perspective, from a liquidity perspective, even from a technical perspective, I think bank and bank nifty may be the leaders in this phase of the bull market. So very positive on banks. In any case, they have about 34, 35% weightage in the nifty, and investors should be at least equal to that weightage when it comes to banks or NBFCs rather than being underweight. And it's a great India-centric business as well, a complete play on the Indian economy. So at a time when you're looking for good quality, reasonably valued, yet decent growth rates, India-centric businesses, I think banks and NBFCs fit all of that criteria.
Hi Deepan, Alex here. I'm just wondering whether you're parsing that entire bucket though. It's quite a large one, and I think there are a few views based on the kind of run that we've seen over the past week and a half, 2 weeks, that there are a little bit of question marks about the valuations as they stand right now for a few of them. They might be a little, if not overvalued, they're more or less where they should be. So when you said that you need to be selective, how are you parsing the banks and NBFCs?
See, I think first of all, our preference is for the NBFCs, especially multi-product NBFCs like say Bajaj Finance or L&T Finance, Chola and Poonawalla, which are into several products and not just focused on one particular segment, because that's typically a de-risk business model. And with risk weightages going down for lending to NBFCs, I think these banks will find adequate liquidity for improving their lending as well. So I would say large part is in good quality NBFCs. Within the banks also, of course, you have to be selective. The larger banks, the HDFCs and the Axis, ICICI, their base has increased significantly. For them to grow at that level is extremely difficult. So we prefer fleet-footed banks like say AU Small Finance Bank, IDFC First Bank, Federal Bank. I think they are just the right size. They have a good track record, good technology platform, and very aggressive management. They have shown the capability to grow well above the system averages. They are expensive, no doubt, but the quality-wise and several other quantitative and qualitative parameters suggest that these stocks, despite being more expensive than the large cap banks and the PSUs, may still deliver industry-beating returns.
Point made. Kush Bora joining us in the studio. Kush, good morning to you as well. And consolidation is what some people had anticipated. Yesterday, you saw perhaps the first signs of a little bit of steam getting released from that rally, right? So 7 days in a row, you thought that it would occur the previous day, but you saw that rally towards the end of the session. We ended with gains of about 0.7% for the Nifty 50. Yesterday, you saw that cooling off. Where do we go from here? Because the indications are for a positive start.
Sure. First up, a very good morning, guys. And what's with the color red?
I know.
Yeah.
I just wear whatever I'm given.
These two are so out of sync.
Or far too much in sync, right?
No. With what the Friday is maybe looking like for the markets.
Yeah.
I wear what I'm given.
As a small anecdote, I'm growing up, and by that I mean, in the college years, when we were very early in the stock markets, we used to take this as an indication. आज अगर anchors ने red पहना है तो शायद market नीचे जाएगा. Of course, now we know better than that. But yeah, it just reminded me of those days. Now the view for the index, Alex, today is a bit blended, right? I'll tell you why that is the case. Even now, the view is buy on dips, as I've been speaking about for a while now. It's just that, the markets have not presented a big enough dip for us to initiate a fresh long position. And we all know that is largely thanks to the FII buying that has gone on for the 6 straight sessions, in the cash segment. What's also interesting is the fact that the FIIs are net long in index futures to the tune of 41%. Now, there are 2 ways you can read this. One is that FIIs are super bullish and, you should create fresh long positions from here on as well. The other one is that these are historical, highs for net long positions for FIIs, and hence you could see some consolidation. Where do I fall? I fall in the latter camp, the second camp, which believes that anyway the markets do seem a little overheated, right, technically. Although some of that data is being reset, because of the expiry and because of the kind of consolidation that you're seeing today. But given that this has been the historical net long index future position for FIIs, some cooling off is par for the course. Now, the other end of that, blended view is that agar thoda FOMO ho raha hai, then it's not a bad idea to consider a long trade, right? But with a very small quantity. And the levels to watch for are 24,500 on the Nifty. Uske upar nikal gaya, then you might consider 55,600 on the Bank Nifty. Uske upar nikla, to aap long trade consider kar sakte ho. But keep that ticket size very small. Hence the blended view. If you ask me for one view, my view is buy on dips closer to 24,000 on the Nifty and about 54,400 on the bank, 54,400 on the Bank Nifty.
So do you think Nifty is going to outpace the Bank Nifty now in the next few weeks to come?
No, I feel Bank Nifty will continue its outperformance. Okay. The reason we've seen this outperformance, in the last couple of days for Nifty, mind you, I mean, if you look at about a month, 3-month data, Bank Nifty has outperformed.
Yeah.
The reason we're seeing this consolidation is because of the IT, pack coming back, largely because of the IT pack coming back. And the kind of stellar run that Bank Nifty has had some cooling off over the last couple of days. Now, I've maintained this view for the last 2-3 days. I want to see IT outperform or at least perform beyond the expiry. So if today, in the next week, IT performs, then I would say that perhaps the near-term bottom is in place. You might consider going long. Otherwise, this could well be a short covering rally, a rollover, trade that has played out, and the IT stocks might continue to consolidate and see further lows. So I just want to see that whether post-expiry also we see those kind of moves, on the upside on IT. If not, then Bank Nifty performance will continue. That is my view.
And what about stocks this morning?
Going long on both the trades that I have today. One of them is Apollo Tyres. Very good moves over the last 10-15 odd sessions, coming up close to the 200-day moving average resistance. But with the kind of volumes it's clocking, there's a good chance that might be taken off today or in the coming days. So 480, 490 are your targets, 460 is where you place that stop loss. On the other end is Elecon Engineering. If you look at the medium-term structure, the stock has actually rebounded from the 50% retracement levels. Very strong support around those levels, and it's rebounded from there. Volumes on the way up on a weekly basis also have been very, very encouraging. So for targets of 555 and 575 with a stop loss around the 525 mark, Elecon Engineering is the second buy.
A couple of points on both of these. On Apollo, Sumit yesterday in the dealing room segment, I was watching it while I was home, has spoken about Apollo Tyres and there being a corporate development sometime soon in the European side of the business. So maybe there is two to tango out here. And on Elecon, the numbers looked fairly okay. They came in during market hours, which is why the stock gave a bit of an uptick. Should be interesting to see if there is a bit of a follow-up there. But speaking of numbers, you can't take your eyes off banks, can you?
Yeah.
And let's get in Harsh, therefore, to talk about Axis's numbers. The Q4 numbers beat estimates, but loan growth may be a bit disappointing. So, Harsh, one, what are brokerages making of this number? And two, how does Axis now rack up compared to some of the others which have come already?
Well, so brokerages seem to be positive overall with regard to the numbers that Axis has clocked. Let me first talk about a little bit about what brokerages are saying. Macquarie maintains its outperform rating, target price 1,440. They believe that I should be on loan growth trajectory. Now, in terms of loan growth, it's been a muted kind of a number that we've seen. 8% YOY, doesn't enthuse at all in that sense. So that's probably a large miss with regard to where loan growth is concerned, given that it's considerably smaller in size, versus an HDFC, which has done far better in terms of QOQ loan growth versus an Axis. So maybe loan growth is one thing they're concerned about. PAT, they believe, is in line. How has that taken place? One is higher OPEX. Second is lower treasury income, a higher margin and lower provisions. That's how that combination has led to according to them, PAT being in line versus consensus PAT was above. Credit cost lower than expected, 18 basis points QOQ, so positive there. And they believe that the current liquidity environment should aid deposit as well as loan growth for Axis Bank. Bernstein, they maintain outperform, target price 1300 rupees a share. They believe a clear improvement in this quarter despite weak growth. They believe credit cost improvement has driven an ROE of 17% and growth remains tepid, improvement in liability mix required. That's how they assess the result. Overall, it's a decent set of numbers. Provision reversal of roughly 800 crore has led to a credit cost beat which has aided ROAs which are nearly 1.9% and a 17% ROE. Nothing more than that can be expected from Axis given the performance over the last few quarters.
Okay, Harsh, thanks so much for that. In fact, let's listen to some of what the management said. My colleague Vishwanath Nair asked the management about the cost of funds impact and also the tariffs that have impacted the bank numbers. Listen in.
Yes, we have always maintained that we manage our balance sheet on quarterly average balance basis because that's what's sustainable and that's what drives the income profile of the franchise. On a reported basis, the CD ratio has moderated from last quarter to current quarter. Our CD ratio has dropped to 88%. To your qualitative question on are we comfortable operating the balance sheet at these levels? Yes, we are comfortable operating the balance sheet at these levels because we do look at other aspects, not just the CD ratio and balance sheet management. We look at our LCR and other liquidity variables, which we are comfortable with, reflected in the excess SLR and the consistent LCR performance we have. To your second question on loan mix and transmission, we have a policy to transmit rate changes at the end of the quarter in which the rate change has been announced. This policy exists for both upsides and downsides. So consequently, the disclosure that we've made on loan profile will get repriced as per this policy. I think on deposit cost, the assertion that deposits will reprice down later in the cycle, yes, we would agree with you that deposits will reprice with a lag from assets. But we've consistently maintained that please think about a bank balance sheet our size on duration basis. We've commented on the fact that the duration of assets and liabilities for us is near matched, and therefore we'll be able to compensate any asset pressures on pricing over the period of duration.
Okay, all right, so that's the whole hog, if you can call it that, on Axis Bank. And we've already spoken to Deepan about his view on financials and specifically on banks. He's talked about NBFCs as well. Deepan, I do want to ask you your view on consumption because we've had a few numbers come through yesterday. There was HUL, there was Tata Consumer, there was Nestle as well. And I think there seems to be a lot of people agreeing to the fact that FMCG is going to continue to see a little bit of pressure heading into the next financial year as well, first quarter as well, and maybe second half will improve. So if you are to play the consumption theme, where would you look?
Outside FMCG, I think the entire consumption basket for the average Indian family has changed. And as they get more wealthier and there's more disposable income, a higher proportion is going to all the products and services outside of FMCG. And in fact, FMCG, the volume growth is now more or less equivalent to the population growth. And all the benefits which the FMCG companies got from expanding into the rural areas, all those benefits are now in the price and in the volumes of these companies. So I'm very bearish on the entire FMCG sector. Sure, there could be trading rallies. The base effect could benefit them and they could have a decent volume growth for a year or so. But long-term secular growth rate has flattened out for FMCG. But look, there are a whole host of consumption-oriented stocks which have opened up for investors to look at. They are in the healthcare space, hospitality, travel, retail, and many such allied industries, appliances, real estate, automobiles. So I would prefer those consumption-oriented stocks rather than FMCG at this point of time. FMCG was a great consumption play maybe 15, 20 years ago, but now I think it's just a laggard in your portfolio. And many investors who've been holding these shares for generations have a tough choice to make, who are sitting on profit, have a tough choice to make to exit out of these companies and get into some of the more, consumption-oriented stocks, which are more in sync with what the current consumption patterns are.
I mean, isn't that the logical choice to make though?
Yeah, absolutely, but it is easier said than
It's
done.
easier said than done. Agreed.
I mean, if I speak to investors who are holding HUL shares for 2 generations,
Yeah.
in a 100 bagger for them, and it gives good dividend, they are not in a mood to sell, how much ever you may tell them.
Fair call. Okay. At some point of time, we'll of course talk about the overhanging cloud of what happens because of geopolitics too. But need to get in Harsh right now to talk about SBI Life, because I thought from all the 3 life insurance names that have come out, SBI Life probably clocked in the best numbers.
The best numbers with regard to VNB margins for sure, Neeraj. So VNB margins much better than expected at 30.5%. It's an impressive number, by any stretch. And even the improvement sequentially, 3.5% absolute in terms of the way in which margin trajectory has moved. So clearly impressive on that count, but growth missing to a large extent. So it's a miss with regard to growth, better margins though. What they're saying is that non-par drove the margins higher, understandably, but new product launches also aided it. So the focus with regard to non-par is coming back. ULIPs, in fact, tapered in terms of growth. They didn't speak about demand per se, but yes, ULIP in terms of the mix got tweaked in a large fashion. Non-par has come back in a big fashion, and therefore they're seeing this margin uptick. Sustainability, difficult to say. They believe that margins will again come off. This is slightly on the higher side, but that's likely a combination of growth plus margins, and therefore growth plus VNB, if I can call it. And therefore, as growth probably kicks in again, probably those margins may get sacrificed by 1 or 2%, or maybe 2 or 3% is what the management has been saying. But broadly, it's of course a strong set overall.
All right, watch out for that in trade today. Harsh, thanks so much for that. We have to slip into a very quick break. We've got more stocks to talk about on the other side, so do stay tuned.
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to the current market price. A premium of nearly 10 to 15% is what the dealers are indicating.
361 is going to issue these securities to UBS at a deal value of roughly 40,000 crore pre-money and around 42,000 crore post-money.
The second buyback is in Naukri InfoEdge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
Power pack morning right here on India Market Open today. The implied shows that you're going to have a good start. In parts coming in with a set of numbers which were decent. Quarterly results have not been half bad. Axis Bank reported after market hours, so did Tech Mahindra. And Tech Mahindra, in terms of what their deal pipeline look like, is almost, I would say, beating its peers. So look out for Tech Mahindra as well. The fourth quarter numbers were posted last evening, largely in line. Brokerages are a bit mixed on it, but Puneet is joining us for more details. Puneet, on balance seems better than others, at least to me.
Well, definitely, the results were largely in line, and that's a key positive for something like a Tech Mahindra ending the FY25 year on a strong note. But very interesting in what brokerages are making of it as well, as you rightly mentioned. Kotak has a target price of 1,650 rupees per share. They've said that it's on track despite some growth bumps, and they also had a wage hike in this particular quarter. But despite that, the company has been able to deliver margins. There are two key interesting points again in this report. They've said that the company has an FY27 vision of 15% EBIT margins. For this year, FY25, they are at 9.7%. So definitely it's a steep target for the next 8 quarters for the company, but they see that the deal wins provide a much needed portfolio boost to moving towards the high margin businesses going forward in FY26. And they believe that actually Tech Mahindra is on their way to have that 530 basis point expansion in the next 8 quarters. They also see that Tech Mahindra is reducing their exposure to loss-making as well as low-margin businesses, an effort from the new CEO, Mr. Mohit Joshi, over the last 4 quarters. And a successful turnaround as a base case scenario for them should lead to a re-rating in terms of multiple as well. That's what Kotak said. A similar view from Investec. They've actually increased the target price to 1,672 rupees per share from 1,510 earlier. Again, 3 key points in this particular report. They mentioned that the company has delivered its promise on growth. Deal wins, again, were 42% higher on a year-to-year basis, which is the highest versus peer group, as you mentioned. And the ROCE has increased from 14% last year in FY24 to 22% now, another big positive there. And they believe that Tech Mahindra will be the only tier 1 company to potentially deliver the highest growth in the next decade compared to the previous one. And just finally rounding this off with a couple of brokerages were slightly negative on it. Citi has maintained its sell rating with a target price of 1,265 rupees per share. And they mentioned that the macro uncertainty might be difficult to achieve that margin, and they've actually cut their EPS estimates. And just one brokerage on Macquarie on maintaining underperform rating, target price of 1,050 per share. And they have said that some margin reversal in Q1 might be negative.
We're getting into the pre-open, so thank you for that, Puneet, and that detailed conversation. TechM, any views, Deepan, or on IT overall?
No, negative on the sector and TechM included, although the numbers look good optically. TechM for March quarter, the profits are lower than what they made in March 2022. And last 10-year sales earnings per share growth has been sub 5%. So you could have an upswing because the results may look good on a quarter-on-quarter, year-on-year basis. But long-term trajectory is one of stagnation in the past as well as going forward.
This is what the beauty is of looking at things with historical perspective. If you're at the same levels at 2022, what really are you doing? Thank you so much, Deepan. Always a pleasure to have you on. And I know we have to let you go at this point. But Kush, on TechM, any specific views?
Interesting moves, over the last 3 to 4 sessions, volume backed. I won't be surprised if, the stock actually goes ahead and hits the 50-day, moving average near the 1480 mark. If that is taken out, perhaps 1520 is also in play. But I would keep a very strict stop loss near 1400. That's been the support zone for the stock for some time. If that is taken out, then again, the, recent lows that it made could perhaps come into play. But given the recent moves over the last, 4 to 5 sessions, backed by very good volumes, there could be, an uptick on this stock as long as the 1400 mark is held.
Okay, well, certainly watch out for those. I wonder just want to mark the initial ticks for, let's say, an Emphasis and LTTS. Tech Mahindra won't be 9%, by the way, so let's wait. Emphasis, maybe. LTTX, yeah. So I think these are more believable rates. I don't think the 9% on TechM, of course, stays. So that's a bit of a given. So keep that in mind. What about the others? In fact, even a Cyient, which I thought, while they've shown a growth, but I thought the numbers look slightly weak. Yes, in fact, not slightly weak, about 10% lower. So that one, I don't know again if it will be down 10% or no, but certainly weak numbers. So 4 names. So we've spoken about one. What about the non-Nifty names? So a Cyient, an Emphasis, or an LTTS? Any one of these 3, if you have a view.
I think there is some short build-up in LTTS, which is coming about. There has been a falling trend line resistance that the stock was looking at, and the 20-day moving average, the stock's trying to dearly hold on to that level, which comes close to the 4,400 mark. If that is broken, you could actually consider a short trade on LTTS. So I'll actually watch out for that. Emphasis is coming up to that resistance. There's a double top formation in the 2600 mark. If that is not taken out, again a candidate for a short trade. So I will see if the 2600 level or 2550 thereabouts, is taken out in the near term. So I think a short candidate in terms of LTTS, as long as the 4550 resistance band is intact.
Okay. LTT Tech in focus. So are a host of consumption stocks. FMCG companies, large ones, reported their earnings yesterday and day before. Tata Consumer, HUL, Nestle are in a steady show across the line, but margins are under pressure. Mahima has all the details before we get to that conversation with Abneesh Roy of Nuvama.
Right. So, in terms of overall view for all of these 3 Nifty 50 earnings, Tata Consumer numbers were pretty much largely in line, HUL numbers largely in line, and Nestle was a slight beat in terms of what the numbers came out to be versus its estimates. Now, in terms of where revenue and PAT growth is concerned, Tata Consumer saw a double-digit growth of 17% in revenue. PAT growth was 59%, but there was a one-off item of exceptional gain of around 120 odd crores. For HUL, this growth was 2.4% in terms of revenue and 3.6% for its PAT. Nestle saw 4.5% growth and a negative PAT of 6.6% growth, but that was still better than what the street was expecting. Street was expecting a negative 8% growth in PAT. So overall, in terms of revenue and PAT growth, Tata Consumer fared out to be better than what HUL and Nestle came out with. In terms of volume growth, well, Tata Consumer saw a volume growth of 6%. This is the first time that Tata Consumer did come out with its number with respect to what its underlying volume growth was. HUL and Nestle both saw a volume growth of around 2%. So here also Tata Consumer was better placed than Nestle and HUL. In terms of common trends being observed, margins definitely still under pressure. Higher tea costs have highly affected margins of HUL as well as Tata Consumer. Gross margins will remain under pressure in first half of FY26 is the commentary that management has commonly said. And in terms of growth, revenue growth was led by pricing for all of these 3 companies. E-commerce growth has strengthened and faster growth has been seen in lower end products as compared to premium products. So that's a new trend that is coming out in FMCG. In terms of demand, rural recovery is taking place, but it is gradual. Urban still under pressure. In terms of the last metrics, dividend has been declared by all of these 3 counters. Tata Consumer 8.25 per share, HUL at 24 rupees per share and Nestle at 10 rupees per share. So this is the overall view as to how so far FMCG earnings have fared out to be.
Yeah, we'll wait for the ones coming in from Colgate, Palmolive and others as well. But a fair enough picture now forming. Abneesh Roy joining us. He's Executive Director Research, Nuvama Institutional Equities, and the word you need to listen to if you want to understand what's happening in the consumption space. Abneesh, very good morning. Great to have you on. People are fairly down and out about this entire basket. We were speaking with Deepan a short while ago saying that those who have generationally inherited these stocks should cash out. How are you looking at the numbers?
Sure, thanks. Good morning. So we don't think things are as bad as some people are saying. One is, of course, from an outlook perspective, things will improve in FY26. Second successive good monsoon. Food inflation has also cooled down and we expect more correction there. Interest rate also 2 cuts have happened. Salary also April will be the first salary where the tax rebates will kick in. So FY26 definitely looking better. From a investor interest perspective, also defensives are coming back in favor gradually because of the overall global uncertainty and global slowdown. Now, coming to this quarter results, as your reporter also highlighted, numbers are in line with expectation and urban slowdown will continue at least for one more quarter. So even in Q1, we don't see a dramatic recovery for the staples companies. Currently, our topics in the broader consumption space will be essentially the liquor stocks, United Breweries, United Spirits. We also like Pidilite and Marico. So these will be our topics. FMCG staples, as you rightly said, currently because of the urban slowdown and because of the raw materials inflation, which is currently still there. Palm oil is still 20-25% up. It has corrected from the peak. Tea is up again 25%, and a lot of the copra, etc., are still up. So Q4 and Q1 margin pressure, urban slowdown will still continue. From Q2 is where the recovery should start for staples. Till then, we'll be more positive on the liquor companies, Pidilite and Marico.
So Q2, there are other people that are talking about H2 FY26. So point well made, Abneesh. Hi, Alex here. One of the points that Mahima was talking about after looking at the numbers that she reviewed yesterday is that down trading is evident for these companies. Is that a trend that is likely to continue, and what are the implications therefore for the margin picture? And I know that you're saying that staples will improve second quarter onwards, but then are we likely to see subdued margins? I think that's why HUL took a hit as well.
So yes, HUL yesterday post results impact stock was up. But when the outlook statement on margins was seen, then investors did get worried. And that's why there is a cut in terms of the EPS for FY26 by most of the street. Because company earlier outlook was 23 to 24% EBITDA margin, and now 22 to 23. Now, where is this 100 bips going by Unilever? I think they are clearly investing in 2-3 spaces. One is they want to make 3 more challenging brands, Lifebuoy, Glow and Lovely, and Horlicks. They want these growth to come back. Second is they have noticed the improving macro food inflation and second successive good monsoon. They want to invest now because you have to do it before the macro really turns. If you delay that, then other competition will catch up. We also see the global CEO of Unilever driving some of this because he is very positive on India and he is more aggressive than the earlier CEO. So we see that also possibly could be one of the reasons. Coming to other companies, as I said, Tata Consumer, next tea crop is very important. We'll get clarity in the next 3 months. So Q1 margins will remain under pressure. For Nestle, if you see, wheat crop is looking better. So Nestle and Britannia, my sense is wheat crop is very important. And that is looking better than last time and better than initial expectation. So I will say every company you have to take one by one. But Q2 is where I think clearly we'll see the demand situation start improving because that comes into the base. And as I said, some of the tax rebates will kick in, food inflation. But from a competitive intensity, I think clearly the legacy companies will acquire a lot of the D2C companies. So we'll see that trend continue.
Abneesh, good morning. Just wondering if indeed the smaller regional players are chipping away at the market shares of some of the pan-India players, is a better investment if one has to do it or wants to do it in the non-Nifty, non-pan-India, non-large cap names? Is that seemingly a better option even if you want to bet for the next 1-2 years?
No, it's not like that. One is if you see Marico is growing 6.5% volume growth, Imami is growing 6% volume growth.
Okay.
So these are also fairly large companies. But yes, your earlier question on down trading is a reality. Currently in urban India, especially, consumers are down trading to smaller packs. See, smaller packs, whenever they buy, clearly there's a impact on volumes because instead of buying a 1 kg pack, if they buy 500 gram pack, that is there. Yes, some consumers are moving to the regional tea companies, for example, or maybe even regional soap companies. That could happen, but we are not seeing that in across all categories. For example, in noodles, we don't see that happening. Chocolates, coffee, we don't see that happening. Even for Marico's categories, we don't see that really happening. So yes, 1 or 2 categories, it is definitely an issue in terms of tea, etc. But our sense is once the raw material cools off, I think again this scenario should improve. So we see that if you see HUL is picking up the competitive intensity against Honasa also. I will say that because now legacy companies are buying a lot of these D2C, the competitive intensity for D2C startups will remain quite high. And regional players, frankly speaking, it's a play on the gross margin. When the commodity cools off, they come back. So it's a cyclical business for them.
In terms of is HUL, Nestle specifically, and Tata Consumer, since these have reported, would you have a pecking order there, Abneesh, at all? Or in the frontline staples, FMCG counters, would there be something that you would like at this point?
Sure. So from a broader topics, we have United Spirits, United Breweries, Pidilite, and Marico. Now coming to the results, in terms of the pecking order, good question. Out of these 3, we'll prefer Nestle currently. Wheat crop looking better. Nestle is the most indexed to urban consumption, and urban consumption 2-3 quarters have happened. One more quarter is there. From Q2, our sense is further recovery in Nestle will happen. Even in Q1, we expect further recovery for Nestle. If you see Nestle's India numbers, every quarter there is a recovery. 2 quarters back, India business grew only 1%, then it became 3%. And this time it is 4.2%. So we are more positive on Nestle. In Tata and Unilever, one common factor, we don't know what will happen to the tea crop. That's one thing which impacts Tata much more because it is less diversified. For Unilever, clearly the focus on lower margin, that I think is a near-term concern. But Unilever said that this is a 2 to 3 quarter lower margin. After that, they intend to get back to the 23 to 24% EBITDA margin.
Okay, thank you so much, Abneesh, for speaking with us. Great to have you on. We have to wrap because we're just getting into the opening ticks on the channel as we see the markets opening. But Investec has a note on Nestle today. They've downgraded it to a sell. They've hiked the target price to 2,386. They say valuations are outpacing growth expectations. Top line growth remains soft. Raw material pressure weighs on operating margins as well. An EPS cut of 2 to 3%. Risk of revenue-led downgrade is something that they are seeing with Nestle. Sunny joining us. Sunny, very good morning. Let's look at how you're looking at Axis, TechM, and Nestle since we've been talking about. Let me just start there very quickly.
Yeah, good morning and thanks for having me on the show. So among all three, I think TechM, I believe there we are more bullish because we feel that the earlier trajectory in terms of margin recovery that is on track as far as TechM is concerned. And again, on valuation front, trading at a reasonable valuation, FY26, 18 time price to earning multiple. So TechM definitely give more comfort at the current juncture. Axis again, although we believe the results have been mixed bag, but looking at an healthy growth outlook for the entire banking industry and the way rate cut cycle is going to increase the margin at least from second half of FY26. So again, Axis will be the second pick among all three names.
Got it. Okay, we have about 35 seconds. So, Sunny, thanks for that. Stay on. Kush Bora, if I can urge you to give us one top trading idea for the morning after the pre-open rates have been discovered.
So Neeraj, I'll go with Coromandel International. About 2 sessions ago, we did discuss this, for the first target of 2240, that's being hit today on open itself, but the momentum is still very much there, new series, so, there could be further upsides to this. So for levels of, 2280, 2300, you can consider Coromandel and keep your stop loss around the 2200 mark.
Okay, so targets, stop losses, top trading idea from Kush Bora. Here's how the markets are starting off this Friday morning. We are seeing a bit of green, but actually it's a lot more muted than what we thought. Wonder if IT is playing spoil sport here. No, it's not. Maybe FMCG. Let's figure it out. But mid caps and small caps should come up on your screen in just a moment first. 0.17% for the mid cap index. 0.21% for the small caps. Building up, by the way, the Nifty now. Let's get the heat map up on the screen, see what's moving and what's not. So Tech Mahindra is certainly down about 4.5%. Axis Bank about 3%. So individual movers there. And some bit of pain in our Nestle. But a lot of green, by the way, which is actually pretty heartening. Just that the gains would not be very pronounced, except for SBI Life, the best life insurance player amongst all the three in terms of the results that have been declared for Q4, and it's showing in the way the stock is doing. HDFC Life too, by the way, a bit of a collateral beneficiary, if you will, maybe 1.8% higher. TCS, some gains at the expense of TechM, I presume. Shriram Finance, Maruti, Cipla are amongst the others. These are names coming out with numbers. Maruti and Shriram Finance in particular. The strength in Coal India and JSW Steel. But clearly, it is the result reactions which are dominating the index with a fair degree of green. Axis, TechM on the downside, throwing a Nestle out there. The showstopper has to be SBI Life, and it's pulling up some of the others along with it. What a move, 9%. I think on an intraday basis, 9% for SBI Life is something that we may have seen multiple quarters ago. Really strong, really strong move, Tamanna.
Yeah, and exciting and moving up even as we speak. Little surprised at the moves on TechM and Axis Bank because numbers weren't half that bad. But SBI Life surely, undoubtedly, a strong set of numbers. Let's take a look at what's happening in the broader markets just very quickly and whether they're holding up. Nifty is not doing too badly this morning. I would say about 0.5% up, 24,350 levels crossed quite easily. So keep an eye on that. Bank Nifty is also okay, flattish. It's a day of the Nifty today. Mid cap index is about 0.25% up, and small cap completely flat. So you're in the green. It's a cautious but positive kind of start to the day. Let's pull up the sectoral heat map also if we can and just get a sense there. Nifty Realty, I suspect pulled up by Macrotech. We'll come to that. Nifty Metal also doing decently. Trade wars easing works good for commodities and metal stocks. Nifty Auto and IT leading over there. Private banks pulled down by an axis. Remember, there was one note here today talking about a valuation concern, and that's bearing out on, perhaps the Nifty Private Bank Index as well. But individual stocks, let's look at that in result impact. I want to pull up SBI Life once again because I want to see if it's holding up at a 9% pop at opening trade. We have Macrotech we should look at. Yeah, 9.5% now. Macrotech about 3.5% up. IEX also reported, Elecon reported yesterday, but has been facing a bit of pressure today. IEX, good set of numbers actually, 4% up. Cyient was not the best set of numbers. What has the street said? The street has given it a very, very clear thumbs down, 9% down. Laurus Labs also in pain. SBI Cards also seeing perhaps a bit of pain this morning. Let's pull up and see what SBI Cards is doing. Lock-in has ended for Wari. We should look at what's happening with Wari as well. All right, there you have SBI Cards about 5% down. So that's also in the pain point space right now. Look at Wari Energies. That's because of the lock-in ending for the IPO, and that stock seeing some impact. I wonder if you can pull up Aavas Financiers as well, because it's all about results right now. And that's always good for the markets, I would say. If you have the street responding to how the companies have performed, then it's back to basics. And you're not worried about, whether there's going to be a trade war or any other kind of war right now. So overall, that's a good sign. So I would say stocks are getting what they deserve this morning, Alex.
Yeah, no doubt. And a few of them reacting very, very sharply. I do want to stress a little bit on a stock that you mentioned, Tamanna, today, IEX. And I'm curious about what Sunny makes of this one, because the earnings came through, as Tamanna pointed out. And interestingly, doubling of the IGX, which is the gas exchange part of the business, of the IGX PAT at 8.9 crore rupees. I'm just wondering whether that is contributing to this positivity, because otherwise the numbers were a tad bit soft. Sunny, we were discussing this earlier. I was actually asking Sajith about this, and he is saying that maybe power producers increasing power production in the fourth quarter, and to that extent, maybe power demand from IEX would not have been as substantial. Of course, Q1 is going to be fantastic, all things considered. But what do you make of the numbers? Would you buy into it right now? 5% pop at the start today?
Yeah, I think, Alex, you are right. To some extent, there is a seasonality factor as far as IEX is concerned, and that is even we have seen a kind of bump up in the number. But looking at a plain vanilla number, I think at least after a long time, IEX has posted a decent set of growth. Coming to valuation, I feel at current market price of 200, I think trading north of 40 times price to earning multiple. I would not like to buy or chase the momentum at a current juncture. Maybe buy on dip with the right strategy as far as IEX is concerned. Coming to exchanges, I think we are more bullish on MCX, although that's related to capital market, not related to power. So if I do a relative valuation, I think MCX is better placed compared to any other exchange.
Sterling Wilson Solar is down despite the YOY numbers looking okay, because I think there was a bit of a run up in the stock ahead of those numbers, and the numbers are slightly below what the whisper number on the street was, which is why this 4% downtick on Sterling Wilson Solar. Parallelly, Macrotech has done really well. It's trading probably at the high point of the day because the guidance remains strong for FY26 as well as for FY31. Kushbora, both of these stocks on the charts, and SW Solar because it's had a run up, right? 22% ahead of the numbers, getting beaten down right now. What do the charts suggest?
In fact, if you pull the charts back a little and not too far back, I mean 10 odd sessions, the stocks actually moved up from 220 to 300. So, significant, about 30-40% kind of a jump already. Hence, what you're seeing is par for the course. The structure from a near-term perspective still looks very interesting for this one. And as long as it holds above the 295 mark, I think, this dip could be taken as an opportunity to re-enter, because the risk-reward ratio, as we all know, is fairly favorable on this one. Now, as far as, macro tech goes, again, a very good run on this one. But what's happened is, despite the kind of enthusiasm that we're seeing today, the stock's not able to take out the high that it made yesterday, which is close to the 1380 mark. So as long as that is held, there could be some near-term pressure on the stock. Once it's in the clear of the 1380 mark, you could see further up move on macro tech. But while we are on the subject of realty stocks, let me add one more stock to that name, which is Valor Estate, the erstwhile DB Realty. It's a little muted today, but it's had a very good run. And Alex, if you'll recall, on Ask Profit, we had a viewer who had a profit of about 3 crores on this one, has been holding on to this one since a while now. And sometimes good ideas come from viewers as well, so why not? So very good moves on this one. I did some further studies on this one. The FII stake also in this one has actually gone up in the previous quarter. The price action is also suggesting that. As I said, today there's consolidation, but on the whole, this is a good medium-term setup. So with a stop loss around the 170 mark for positional targets of 210 and 230, Valor Estate is something that you should consider.
Okay, I don't want to very quickly ask Sunny about Valor Estate, because just the question that was asked at the time, Sunny, the viewer said that he had 50% of his portfolio in Valor Estate, and it is a concentrated bet, 3 crore or so profit. But the way that he looked at it is that the market capitalization, around 10,000 crore? I'm not sure. At least that was what it was at that point. And what he was looking at was the value of the land that they currently have in Mumbai. And the fact that he values it at more or less where the market cap is right now, if not more. Would you look at it that way, and would you buy at this juncture fundamentally?
Yeah, definitely. I mean, the company is sitting on a huge land bank, and there is a potential of significant pre-sales as well as the sales number both from residential and commercial space. But again, one has to keep in mind that real estate projects do take time to execute. I mean, if you even launch any one residential project, the time from sales to actual profit conversion or cash conversion takes a 3 to 4 year period. So again, the value unlocking in a real estate usually take time of 3 to 5 years, the long gestation project. So yeah, definitely in terms of if I take into account the land value, obviously the stock look relatively cheaper. But again, somebody is holding to the stock, then he or she need to have a slightly longer term investment horizon at a current juncture. If somebody is looking at a relatively safer bet, I think at a current juncture, Macrotech already has reported a very solid set of numbers. Maybe buy on dip is the right strategy on Macrotech front. Century Textile, which is now basically Birla real estate play. There we feel that they are expanding aggressively in various parts of the country. So Century is one of our pick. Coming to the south-based market, Brigade Enterprise, I feel December quarter was a very solid quarter for Brigade, and we expect the same to continue during the March quarter also. So Brigade can also be entered.
Got it. Okay. Sunny, we'll leave it at that. Thanks so much for taking the time out and being with us. Really appreciate your time. One of the other reasons why maybe Sterling Wilson or some of the others might be under a bit of a cloud today, or just people might be a bit careful because the proximity to the Pakistan border where a lot of operations are, and therefore maybe some people might take that call that let's be a bit safe with regards to large trading positions in businesses which might be having large operations in and around India-Pakistan borders.
Consider that. That's an important point. Yeah.
So that's something to keep an eye out for as well. Kush, very quickly, because we have Lotus Labs out here, 30-second answer. What do the charts suggest here? Purely as a trade.
Lotus?
Lotus Labs.
Well, I'll wait for this, I'll wait for the support zones of 615 to be tested, because the last two sessions have seen consolidation, negative RSI divergence on the daily setup. So yes, some profit booking is par for the course. 615 is the level that you have to watch for. Closer to that, if the stock holds and rebounds, then you go long.
Okay. Thanks a lot for that, Kush. By the way, there's a large block deal, but 104 crore shares might look very large, but for Vodafone, it's less than 1.1% of equity. So nothing meaningful really. I don't think the stock would be reacting too much either. But Kush Bora, take a moment to thank you for joining in today and giving us your thoughts. Really appreciate your time. Have a great weekend. All right, Dr. Satyanarayan Chava, founder and CEO of Laurus Labs with us, first on NDTV Profit to talk about the numbers and the outlook ahead. Dr. Chava, good having you. Thanks so much for joining in. This is Neeraj here. Good morning. How do you rate the quarter, sir? Because when I look at the exit margins that have come in into quarter four, I'm starting with the minutiae first, the margins, because it was such a big talking point, right? All through FY25. What do you do? Do you end at 20%? Do you do higher? The exit margins are good. Even though your average margins are not 20 but 18, but the exit margins are very strong. What went into that quarter for the exit margins to be what they are? And what's the color that you can provide for the quarters ahead, sir?
Good morning. As we were talking in the previous quarters, we guided our investors. The H2 FY25 is going to be good, and we delivered those numbers. When we delivered 20% in Q3, then people were thinking, unless we do over 25% EBITDA for Q4, we'll never be able to get an average of 20. Interestingly, we did that. And that was because of higher revenue share coming from CDMO. And we could see some leverage happening in our asset utilization.
Okay, so Dr. Chava, what's the color that you can give for what happens? Because I understand you haven't come up and given a formal guidance this time around, which is fair. So my question to you is two-pronged. One, is the global uncertainty prompting this, or you do not want to go out into the guidance business here on?
We are not interested in giving guidance. That's the one question. The second, going back to your question of global uncertainty, the CDMO business, the timing may vary, but we have very large pharmaceutical companies, well-defined clinical programs. Some of them are very large. So for us, the investments we made in CDMO division over last 3 years, we did over 3,000 crore capex specifically for CDMO across crop sciences, animal health, and then human health. And that asset has to give revenue sometime. And even if you consider our asset turnover ratio earlier, where we achieved 1.2, even put that number, so we should be able to do in CDMO 450 million, but we don't want to put a timeline to that because all depends on the clinical programs, when clinical programs move to the next phase, when we start commercial supplies and that. But one interesting fact to know, most of our clinical programs are in phase 3 or NDA filing stage. So we have more certainty right now in CDMO projects. We have customers, we have projects right now. Only we have to execute depending on how the projects move from one phase to the higher phase. That's the way I am looking at. Once we do higher revenue sales from CDMO, obvious to guess our EBITDA margins will improve. And we use our facilities better. So asset utilization will go up, and margins will go up, and EBITDA margin will certainly go up significantly. That's the way I will end answer to your question.
Okay. And I have a couple of questions on CDMO, sir. But since while you are looking at this business rightfully as you must, the way you are, because equity investors would just want some color about what FY26 could be like. So I understand you may not want to provide color on what the revenue growth will be. You said that it will be better than FY25. So fair enough. Two-part question on that. One, could it be leaps and bounds better, or is it difficult to say that right now and you will leave it at it's being better? But part two, can the exit margins of quarter 4, which is about 24 half, can that be the average margins for FY26?
Quite possible. Quite possible, Neeraj. Yeah.
Okay. So quite possible the exit margins. On the revenue growth, leaps and bounds better, moderately better, modestly better, or difficult to say?
As I mentioned, we do better in our asset terms, and we have assets in place, we have projects in place. we expect it should be a good year for FY26 for us.
Okay. Now within CDMO, Dr. Chava, and please correct me if I'm wrong, but I was looking at the distribution of the CDMO business versus the overall business. Because we have slightly limited time usually to what we usually do, I'm gonna focus a bit more on CDMOs. That's the talking point right now. And I believe you had some fabulous exports for the month of Jan, Feb, March as well, which is good to know too. But I want to just understand one macro thing first. Me and my colleague Varsha, who tracks your company closely, we're looking at what CDMO has contributed to the overall business in FY19 versus FY23 versus FY25. FY19 was a very large share, maybe 36%, or slightly lower, sorry, 19%. FY23, I believe you were at 36%. Last year, you've done in about 25%. So what is I know it's a lumpy business, but what's the bare minimum that you believe CDMO will form a part of Laurus Labs over the course of the next 5 years? If there is some color you can give to the kind of question I'm asking.
In the next 5 years, we expect it should be equal.
In the sense, sir?
It should, both the CDMO and generic should contribute 50% each.
Okay. So at some point of time you're saying between FY26 to FY30, CDMO's contribution to your overall revenues could rise to as much as 50%.
Yeah, we expect so.
And that would not be because the other business is declining. That is because CDMO is growing faster.
Yes, absolutely. You're right.
Okay, lovely. Now within the CDMO basket, sir, I would presume, and correct me if I'm wrong again, that animal health will peak by maybe FY27. So is crop science CDMO going to make up for that? And that's why you kind of underscore the kind of growth that you're saying for CDMO?
I think majority CDMO growth will come from human health, followed by animal health. As you mentioned, we expect FY27-28 will be the commercial year where all the molecules what we are validating will go commercial. And we also started nurturing another relationship in animal health that should start kicking in some revenues in FY28. Crop sciences, we need to wait 1 more year to give more clarity. We started commercial manufacturing last quarter, Q4 FY25. And we have visibility for 2 more projects, which will go commercial. Not commercial, validations will be done, 1 this year, 1 next year. So in next 12 months, we have more clarity on crop science segment near us. Whereas animal health, we are seeing very good traction, and we're hopeful to add 1 more partnership there.
Okay, no, this is a surprise. So, Dr. Chava, you are saying that in FY27-28, which means that at the very least FY28, but presumably in FY27, human health CDMO will start contributing to your numbers? Meaningfully?
Yeah, meaningfully.
FY27?
No, even now our human health segment is the biggest in CDMO. That will continue to be the biggest segment.
Oh.
And by FY27 or FY30, you take our human health segment is going to be the biggest in LC.
Okay. I stand corrected then. Thank you for correcting me, Dr. Chava, but good to know this. Now, the other question is, Dr. Chava, we didn't get a chance to talk then, but this whole conversation around US negating the Biosecure Act and the kind of impact that it has on Indian CDMO and other suppliers as well, we still haven't seen a resurrection of that. And in between all of that, the tariff impact has come in. And now people believe that Indian players are best positioned to take advantage of the business that moves out of China and some of the other buckets. Pharma players, textile players, so on and so forth. I would love to know, sir, what has been the kind of inquiries that you may have observed as a result of the heightened tariffs on China thus far, and therefore are people looking to move the supply chains in a hasty fashion to India, and therefore to companies like yours?
See, I will speak about our company. See, we have gained expertise in several new technology platforms like biocatalysis, flow chemistry, continuous manufacturing, high energy chemistry, continuous chromatography. All these are helping us to get interesting projects from big pharma. And we also have scale. We can do all these new modalities at scale. So most of our projects at late stage right now have one or more of these new modalities. So we are very confident if any project needs scale, any project needs some of these new technology platforms, I think we are well positioned to grab that opportunity. And if any geopolitical things are biosecure and all those will come in place or will definitely help Laurus Labs.
Got it. Fair. And now the final question, the non-CDMO businesses, Dr. Chava, what's your verdict on what is the kind of performance that we can expect in FY26?
We will have a very stable ARV revenues. We don't expect the ARV revenues will go down. And our CMO with our European partner, the capacity will come into commercial use by end of this calendar year. We are having few launches in US and Canada. So we expect to grow in generic division as well. But the growth will not be as significant as CDMO. But we are not anticipating any decline in our overall generic space.
Got it. Okay. Dr. Chava, we'll leave it at that, but thank you so much for joining in today and giving us these perspectives, and all the best for what seems to be a challenging year for all businesses. Thank you for talking to us today.
Thank you.
That's Laurus Labs. First on NDTV Profit, two key things stand out. One, that the exit margins for Q4 FY25 could be the average margins for FY26, which is a strong number because FY25 average margins are 18%. So purely on the EBITDA front, they'll probably do well. And human CDMO, will become 50% of his overall business in the next 1, 2, or 3 years, which is a tall statement considering that it is about 25% right now.
Yeah. So the outlook looks good, but the numbers by themselves have been not something that the street has been too
above
excited
estimates,
about.
yeah, but maybe the street penciled in higher margins which haven't come out. But 24%.
Yeah, I mean, what the street is saying is about a little bit of a downtick on it. Same for Elecon, which is actually the next company that we're speaking to, and that is also going to be first on NDTV Profit. 2.5% down on Elecon Engineering when the numbers actually look pretty good. We're going to be speaking with Mr. Patel in just a minute from now, but Anushi is joining in to set up the conversation for us. Anushi, take us through the numbers and also what was the street expecting that doesn't seem to have been delivered?
Right. So firstly, if you look at the fourth quarter earnings, it's 41% of a revenue growth that we are looking at. EBITDA also a 44% growth. Margins have net rate remained similarly in the 24.5% of a range. If you talk about what has happened over the quarter and even in the FY25 scenario, if we see, firstly, we saw a rebound in the gear division in the domestic market, especially wherein they saw about a 29% of a revenue growth. Do note till the 9-month FY25 picture that this gear division had seen a slower than expected growth due to a slowdown seen in the steel and the sugar sectors in India. MHE division, that's a material handling equipment division, continues to sustain growth, revenue up around 98% over the year. Now do note with the fourth quarter numbers out, FY25 revenue guidance was met at 2,225 crore, which is in line with the 15% growth guidance given. In fact, even if you look at the EBITDA margin guidance, that was at 24%. So it was the guidance was met in this metric also. But what impacted overall, if you look at the FY25 margins for the gear division, was higher freight costs along with one-time repair and maintenance expenses that happened in the second quarter that was there. But MHE division continues on a strong margin footing with better product mix over there. So considering all these factors, let's also see how the FY26 outlook stands at. Now for FY26, they see a 19% of a revenue growth. EBITDA, they see about a 17% of a growth, while margins are expected at 24% as compared to the 24.4% of mark that we saw last year. So this is the overall picture that we are seeing for Elecon Engineering, how the gear division had fared in the last quarter and how MHE division continues to sustain growth forward as well.
Thank you for that, Anushi. In fact, Mr. Prayasvin B. Patel, the CMD of Elecon Engineering, with us on the show now. Mr. Patel, very good morning to you and thank you so much for your time. You know, when I look at the numbers, at first look, I think this is the best ever performance that you have clocked. Take us through what you've seen this quarter.
I will start with the first quarter. The first quarter was very slow because of elections in the country. And therefore, there was a lot of catching up that we needed to do in the last quarter. Our teams performed extremely well under these circumstances, and we were able to grow at a phenomenal rate because we were all prepared to see to it that we achieve our targets by the end. So, and especially in material handling division, we had large sets of orders coming in, and therefore it was possible to achieve this.
Okay. Have you seen that clear recovery by Q4? And if you look at the whole year overall, Mr. Patel, is it all about the gear division rebound that has pushed your numbers this time round? Or is it MHE that has been the big focus?
MHE has been a higher focus this year, but going forward, we believe that both will be doing very well because we expect to sustain our margins and grow the top line by 20% next year.
Which sectors have aided this growth, especially as when we talk about the gear division? And if you look at your 9-month, that's where the recovery really shows, right? In the gear division, if I compare with the whole 9-month picture, then that's not looking as robust. What are the sectors that have really, contributed to this?
Power and steel have been one of the largest. Both in gear as well as in the material handling division. And I believe that they are having substantial traction even in the coming year. So these would be the two drivers which would drive the entire order booking during this year.
So a couple of things which may have impacted the gear margins include your freight costs. You have some one-time costs as well. Just on the portion of freight costs, do you see this persisting, higher freight costs, as a problem area?
Not really. The Houthis are creating issues in Yemen, and which is the reason why in exports the freight costs have gone up. But I believe over a period of time that will reduce and even out.
In terms of the export push, and I know most of the business is domestic, but in terms of the export push and with the current climate of trade uncertainty globally, is there an impact that you're thinking about and penciling in for FY26? Is that one of the reasons that the margin guidance is a little muted compared to what we saw in FY25? Just trying to understand where that 24% number is coming from, or what is the thought behind it?
No, our margins in exports have been reasonably good or healthy. Probably most of the time better than the domestic market margins. And we believe that going forward, overseas thrust that we are trying to give will see to it that the margins are very well sustained or improved over a period of time.
Okay, so you want to increase your overseas mix or your revenue from international market 50-50, I believe, by FY30. Is that still on track considering the global headwinds right now, or will you pivot for the next couple of years to a more domestic facing? What is the plan there?
No, exports is going to be the thrust, and we will see to it that we achieve those numbers going forward. These headwinds that we see right now, I presume, are temporary. And there are a lot of areas or territories that have got great potential, like South America, Africa's, as well as North America, especially Canada. So, I mean, the opportunities are very many in various countries. So I believe that for us to reach those targets would be easy. The US tariffs are creating a small hurdle right now, but we look upon that as an opportunity, and going forward, I believe that should help us in the long run.
Exactly is the nature of impact of US tariffs for you? You've described it, Mr. Patel, as a small hurdle, and then you've said it's an opportunity. So if you can just elaborate on both those points.
Yes, we were using US as a hub for the entire Americas. Now, what we will be doing is we will ensure that the exports to Canada and South America, including Mexico, would be made directly. So this gives us an opportunity to get a stronger foothold in Canada and in South America by establishing entities out there.
Okay, let's just take a look at your overall guidance for margins for FY26. Mr. Patel, you've penciled in at 24%, if I'm not mistaken.
Yes.
So why is that lower than the 24.4% clocked in FY25? Just trying to get a sense there.
Normally, it depends on the product mix that we have. But this is an approximate guidance. I'm sure that we will try to even further improve upon it. And 24% is what we have been able to sustain over a period of time. And I'm sure we will do our best to achieve this even this year.
All right. Thank you so much, Mr. Patel, for speaking with us. Alicon Engineering, they're talking about, staying on track on their expectations to boost revenues from exports coming in to 50% of overall revenues by FY30. They have been on the conservative side on their margins. That's for next year, their guidance for margins for next year, and that's probably what's weighing on the stock. But SBI Life is the stock of the morning. They've reported better than expected margins in Q4. Harsh is joining us. Harsh, why this extent of outperformance on SBI Life? Take us through the details.
Well, there's been a sharp shift, Tamanna, with regard to the product mix of SBI Life. They've focused more on non-par. ULIPs, which is a lower margin product, has reduced in terms of the mix for Q4 FY25, really boosting non-par and therefore boosting their margins as well. Margins at 30.5%, and we did speak about this in the morning as well. 30.5% is no mean feat, because 3.5% improvement in absolute terms on a sequential basis. The only possible concern within those numbers are the growth numbers, but outside of that, that very sharp margin uptick reflects the fact that life insurance in general as a pocket could start to see a shift towards higher margin products, and you could likely see margins improve. This is not the normalized margin number. You will see a 2 to 3 percentage point reduction on a normalized level as growth comes back, but largely it's very, very positive because you're starting to see that shift in product mix and you're starting to see margin uptick.
Okay, Harsh. Just very quickly, Harsh, as we said, 20 seconds. On VNB, this is the best performance from amongst all three life insurance companies, right?
That is correct, yes.
Okay. Fair
and that's the three companies being HDFC Life, ICICI Pru. LIC numbers awaited.
LIC numbers awaited. Yeah, sure. Private sector names, this is the best one. Okay, great. Harsh, thanks so much for putting that into perspective. Now, you could also argue the same thing for Emphasis, because it's a stock that's buzzing in trade or relatively buzzing in trade from the IT pack, because it reported its Q4 numbers yesterday and late yesterday, and the revenue as well as profits grew about 4% on a yearly basis. Margins saw a small contraction. But you could argue that they were largely in line. Now, I spoke to Nitin Rakesh, the CEO of Emphasis, and Arvind Vishwanathan, the CFO on Emphasis, about that. Hear out what they have to say with regards to the quarter and the outlook ahead. It's not too often in this quarter that we've seen an inline set of results in a weak environment, save for maybe a handful of 2 or 3 companies that I've seen. Not too many have done that. Emphasis has managed to do that. Net revenue is largely in constant currency growth in line with most estimates. Segment growth driven by insurance, I believe, BFS and TMT, while logistics and transportation vertical continued to decline for them. Let's get in the management. Nitin Rakesh, CEO of the company, Arvind Viswanathan, CFO, joining right now to talk about the numbers and the outlook ahead, more importantly. And gentlemen, thanks so much for joining in, and congratulations on what's turned out to be in the current times an inline set of quarter or number is not a reasonable quarter, but a good quarter. So congratulations on that. Nitin,
thank you.
Let me try and understand what is the environment around you telling you with regards to deal wins, with regards to the change that you have to contend with both at the client side as well as internally, and how do you mix all of this to try and hypothesize what you can do in FY26 or beyond?
Thanks, Neeraj. I think it's an interesting environment because there's a lot of volatility and noise around just the macro, right? All forms of things that go in the macro, whether it is interest rate cycle, tariff uncertainty, geopolitics, recession fears, and a whole host of second-order impacts from there. So that's definitely, a bit of a headwind because that makes everybody nervous. It's not easy to get decisions done. 90-day pause means let's wait 90 days to make a decision because we don't know which way this is headed and so on and so forth. The other interesting thing that's underway also right now for the last 2 years or so, but it's starting to pick up absolutely in the last, I would say, couple of quarters, is what does really AI mean to customers? And as they've gone through a phase of experimentation and piloting and proof of concepts and use cases, I think there's a pretty much consensus that this is something that really means they can have a big impact to their customer experience and their cost to serve. So efficiency using AI and adoption of AI to actually get better with their customers and their overall business. In that environment, I think if you combine these two, we basically took a call about, 12, 18 months ago that in an uncertain macro, with this kind of change that is driving through the underlying business, let's get focused on the micro. What that means is, on one hand, we are very focused on client by client, account by account, understanding what their priorities are, what their journey looks like, what phase of evolution they're in, and what we need to do to them what we need to take to them to actually align with their strategic priority and become a strategic partner. Even if we already were, how do we become a partner in the next phase of the journey? On the second hand, what that focus on micro means is evaluate where we need to invest in, within our business, both in terms of not just people and upskilling, but more importantly, what does this mean to the model of our business and our industry? I think we are in a pivot where we are moving from being a service provider to being a tech solutions provider. And that requires the ability to orchestrate tech solutions, take an end-to-end view to what client requires, what the outcome is required to be driven by the business, and then align yourself not just to that solution, but also to that outcome. And I think that's kind of what's playing out, and that's what's driving pipeline closures, conversions, client value frameworks, and in a number of cases also driving how we sell, who we sell to, what we sell, what we deliver, how we deliver it.
Got it. So Nitin, let's try and talk about that. About what, 390 million, if I'm not wrong, of deal wins. Now, a couple of your peers, and I mean not exact peers, but within this industry, right, that we've spoken to, have said that a lot of the deal wins or closures happened in March, and that exit rate is actually good news for the quarters to come. Also because the risk element around the tariff uncertainties being dialed down a little bit with the pullbacks that the US has done too. Are you sensing that in your conversations, or for you it was business as usual through the quarter?
I mean, it's very hard to be business as usual in this environment, but I can tell you I am not smart enough to tell you what will happen to this macro situation.
But
could go
what are client conversations
either way.
like?
Client conversations are very, very focused on what is it that we are driving for them, what is their priority. Because I tell you, one bank CEO publicly stated earlier this week, and this is a very large bank, very well known, that just because there is macro uncertainty or tariff uncertainty, we are not going to stop implementing AI at the bank. That's a pretty powerful statement. Which basically means that if you have the right proposition, the uncertainty doesn't matter to the bank, but it has to be the right proposition for the right reasons, for the right impact of their business. Another bank CEO said, we are going to continuously modernize our estate, both technology and operations, because we have an untenable cost to serve right now. So I think the ability to drive through decisions depends on how well you're aligned to these priorities at a customer level, at even a line of business level. And I have some news for you, because I know you're going to ask me a question around discretionary spend. I think the wait for discretionary spend is going to be an endless wait in the current environment.
Okay. Wow. Okay, that's a powerful statement as well, Nitin. I mean, so okay, then I'm forced to ask you a follow-up before I get Arvind in. So how do you strategize in this current context? Because I know you mentioned that you took a call 12 months ago to focus on the micro, but while such a situation is on, what do you do in order to have deal wins? Companies are wanting to modernize, you are out there, but AI probably upends the model of IT outsourcing companies. billing for employees and the resultant revenue coming in. I think that is getting appended too. So in light of all of that, Nitin, how do you strategize, and what does therefore FY26 hold in store? I know you can't give exact numbers, or I don't even want numbers, let's say, but give some color. Will it be a growth here?
Yeah, I think you already addressed what's going on, right? In a sense, what's going on is that we are appending the model of people-based services and moving it to tech-based solutions. I just said it. What that means is, for us, how we deal with that is, firstly, we take a bold approach and say, let's go to the customer with the right value proposition. If it means that we have the ability to align to the right outcomes, we have a deal discussion. If you have a deal discussion, we qualify it. We move to the next stage, and there you have an opportunity to actually win a large deal or not a large deal, doesn't matter. So that's exactly what we've been doing. That's the reason why we took a bold call to set up a large deals team. That's how we've actually managed to increase our pipeline year over year by 80+% and quarter over quarter by 26%. And the reason for that really is we are having these conversations at a client, at a customer level, at a business unit level, at a proposition level, and we're also not stopping investing in propositions that we think are working, and we need to keep them ahead of the market, and hence we need to take a much more forward-leaning approach to it. So I think the short answer is take a bold forward-leaning approach, align yourself with the client value framework, and just focus on deal making around that framework.
Got it. Okay. Arvind, just wondering, just a follow-up on that and getting your view in, what does that do to costs? Because I'm presuming that setting up a large deal team, or for that matter, something that one of the other companies has done, which is go to clients and tell them that we'll do the work right now. If it works out, then you get to pay. I don't know whether you're doing that or not, but I'm just saying different companies are trying different things. And for you, like Nitin said, the employee and therefore the revenue model is getting upended. So how do you manage costs in such a scenario? Your margins are marginally off what the street was working with this time around as well.
Yeah, so I think our margins are flat. We did 15.3% for Q4, which was flat Q3. On a YOY basis, we improved margins by about 20 basis points for the full year. So I think from a margin standpoint, the way to look at it is that, I think all of us need to invest on certain elements, right? Large deals is one element that Nitin talked about, but equally around the AI value proposition, that is again going to be an investment. But what we believe is that, there will be leverage at a gross margin level, and some of it will have to be reinvested into specific investment areas, right? Be it coverage, be it large deals, be it AI. We are confident of operating in a range. We kind of narrowed our range from what we had said before. We're confident to operate between 14.75 to 15.75 EBIT. We are bang in the middle of it, and I think that's how we see it over the medium term.
Got it. Okay, gentlemen, I know you had a very long day, and particularly Nitin at that side of the world. So even though I have more questions, but I'll call it a day for today. But Nitin, with the confirmation from you right now that we'll have a conversation mid-quarter sometime to understand your views on how the scenario is looking like.
Sounds good, Neeraj. Absolutely happy to do it. And thank you again for taking the time, and we'll speak soon.
Thank you so much, both of you. Thank you for joining in today.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to the current market price. A premium of nearly 10 to 15% is what the dealers are indicating.
$361 is going to issue these securities to UBS at a deal value of roughly 40,000 crore pre-money and around 42,000 crore post-money.
The second buy pick is in Naukri InfoEdge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
In the last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two
For the worst. I want to pull up the intraday of the Nifty if we can very quickly and just give you a sense of what is happening here. Nothing seems like a clear reason for this kind of a downward trend apart from fears perhaps of an escalation, if at all, across the border. There have been reports of cross-border firing across the line of control since this morning, firing first from the Pakistani side and then India has retaliated. Even the conversations and the statements from both sides, very strong statement coming in from Prime Minister Modi yesterday, Pakistan then putting out its set of factors that it would look at, including saying that we will no longer recognize the Shimla agreement. Maybe those are some of the reasons that you're seeing fears of an escalation grow. Is that what is hurting the markets right now? Could be one to watch, because definitely, if you take a look at the Bank Nifty, actually even worse off than the Nifty in terms of how it has taken a downturn. Pull up the Bank Nifty if we can. Let's pull up the heat map if we can. Nifty down about 1% now. Bank Nifty over 1% down. The broader markets hurting even further. Look at the mid cap. 1 second. Let's pull up the Nifty mid cap 100. 2.5% down at this point. Broader markets taking a bigger tumble than any other. Can we pull up the advanced decline ratio as well? Very quickly, if that's okay, and just take a look at what is souring the mood here. I want to see the Nifty heat map. I don't know if you put that up. Let's pull up the Nifty heat map. The advanced decline ratio has gone quite adverse and pretty quickly. Yeah, that's all red there. One SBI Life is managing to hang on for dear life in the green, apart from the others, but an Axis Bank also about 4.5% down. So deepening there across the board on the Nifty. Well, Macrotech Developers. Let's pull up Macrotech Developers. Has recorded a strong Q4 set of numbers. Company has beat its FY25 pre-sales guidance of 17,000 crores as well. And its net debt is also reduced by 320 crores. That stock started off strong but has taken a tumble with all the fears across the market coming in. Anushi is taking us through the highlights of the earnings.
Shares of Macrotech Developers are in focus after they've posted a strong set of Q4 numbers. Now, some of the key highlights, if we see, of the quarter. Firstly, it's the pre-sales which were in focus even after the business update that we've seen. The company has beat its FY25 guidance of pre-sales, which was at 17,000 crore. In fact, if you look at the FY25 picture, they've registered about 30% of growth of pre-sales from its new launches in 2025. Along with that, they've added 10 new projects with a GDV size of 23,000 crore, which was against the guidance of 21,000 crore as well. So strong beat here also that we are looking. Net debt to equity continues to remain at 0.2 times, which is below the ceiling level of 0.5x that we've seen. Now, if we just talk about the four general numbers of the quarter gone by, revenue was up around 5%, margins on expansion of 284 basis points to 28.89%. Net profit saw growth of around 38%, but do note, for real estate companies, it's the key operational numbers which are in importance, wherein we saw about a 14% of a pre-sales growth in the fourth quarter. Collections also strong growth here at 26%, and they added 2 new projects in Pune with a GDV value of 4,300 crore. What's interesting to note is the kind of outlook that the company came out with for FY26, wherein they expect a 19% of a growth in pre-sales in line with their target of seeing around a 50,000 crore of pre-sales in the next couple of years that we are seeing. So pre-sales expected at 21,000 crore for FY26. Operating cash flow is expected at 7,700 crore, so 17% of a growth here as well. And they expect net project additions of 25,000 crore as compared to 23,700 crore, which we saw in this financial year. Net debt to equity to continue remain below 0.5 times of level that we are seeing. So this is the overall roundup of macro tech developers in Q4 and what's the outlook for FY26.
Well, that's good from macro tech's end, but as we said, has come down. It's good for India's end as well, broadly, per se. All that's happening around the world, except for, of course, what's happening on the geopolitical side back home. But an interesting note from CLSA on its India strategy brings views from Vikash Kumar Jain and Lawrence Balanko. Let's go to Somit for more of what the note has to say. And Somit, it was very interesting to see that CLSA says that the TINA factor is returning.
Well, it's a contra view actually coming in from the same broking firm, that is CLSA. Obviously, one of them is a fundamental view and the other one is a technical view. Firstly, on the fundamental side, Vikas Kumar Jain has made some changes to his portfolios, exited Hindalco, JSPL, SBI Life and Axis Bank, while he has added SBI and Godrej Properties to the CLSA India portfolio. Now, he says that the TINA trade is back. That is, there is no other alternative trade. He says that uncertainty on the global market is bringing back the TINA trade, which is the feeling among the global investors. Now, they are feeling this because the fact that the Indian market exposure to the global trade is on the lower side, and hence Indian markets stand to benefit compared to other markets. However, he says that the recent rally that we have seen in the market has taken the both Indian equity and the bond market to back the stretched valuations, and this coupled with EPS cuts which are expected to come in that will not bode well for the market going forward and will limit the upside as per Vikas Kumar Jain. He also said that in the sectoral wise he prefers staples, energy, real estate, utilities and banks and industrials and materials as well. Now on the flip side, that is the technical side, Lawrence Balanko is saying he's bullish on India. In fact, he's saying that the Nifty's price action has shown continued improvement and the current breakout that we have seen in the market suggests for a potential upside target of close to 26,333, which is the level that is effectively revisiting the highs of 2024. Now his preference has always been private banks like HDFC Bank and ICICI Bank, but he's also now looking to add PSU stocks, and few stocks among the PSU index or the BSE PSU index which look interesting to him are REC and Bharat Electronics at this moment.
Okay. Thanks for that, Somit. So, well, contrasting views, yes, but I love the line out there that the TINA factor is returning. Does it see a small bump because of the geopolitics? Remains to be seen. The Axis Bank shares also have seen an impact of all of this and more. Loan growth probably disappointed too, so that is an issue there. Harsh Johnson, with what brokers are making of these numbers? Harsh.
Well, let me first start off with Macquarie's views. They've maintained an outperform rating, target price being 1,440. All eyes on loan growth trajectory is what they say. Profit after tax is in line. They're saying higher OPEX, lower treasury income and offset. Have a couple of those factors have offset the higher net interest margins, and lower provisioning has also offset it to ensure that there is a profitability which is largely in line with estimates. Credit cost is lower than expected, they say. The GNP has declined 18 basis points sequentially, and the current liquidity environment is likely to aid deposit and loan growth is what they're saying. Bernstein, they've maintained their outperform, target price 1,300. They believe that there's clear improvement despite still weaker growth. Credit cost improvement has driven the ROEs to 17%, which is a positive, and growth remains tepid. Improvement in the liability mix needs to be made. So those couple of factors or views coming in from Bernstein as well.
Okay. Thank you for that. Axis Bank, pain point, SBI Life doing okay, but I think bigger concerns right now before the market. Ravi Dharamshi, founder and CIO of ValueQuest, joining in on our conversation. Ravi, so great to speak with you. Finally getting a chance to hear your views on what's been going on. Do you think that now that the Trump trade fears are behind us, what's going to dominate perhaps, and what we're seeing today as well, is fears of an escalation across the border? How big a concern is that for the market right now?
Good morning. Good morning to your viewers. But see, honestly, it's a sad, tragic thing what has happened, and it is going to lead to an escalation in the tensions with our neighbors. But at the same time, purely from a capital markets point of view, I don't think it's that big an event. And we should not be overly obsessed about it. It will dominate the headlines of the white papers. But from the point of view of pink papers, it probably will have a small mention. I mean, a small probability that it blows up into a full-blown war. But even then, I don't think it is going to impact the markets much. Sad to say,
What
but
do you think is spooking markets today? Do you think that after the kind of run-up we've seen, because we saw a very, very good start, Ravi, after the kind of run-up that you've seen, is this a bulls taking a pause, or are there bigger concerns right now till we don't have clarity on what happens over the next 2 or 3 days?
No, clearly, I mean, markets had run up furiously, right? And the market positioning, which was ultra bearish, has now turned more neutralish. So, from that perspective, clearly a pause was needed. Had this event not happened, we would have still had markets correcting a little bit. So, I will not attribute this to any kind of rise in geopolitical. It is purely markets had run up a lot and some supply is to be expected. So, I would say it's normal course of market action.
Okay. Ravi, good morning. Neeraj here. And I read a view from you a few days back wherein you mentioned that if the markets would have gone down further, then the probability of making money would have risen to 90% or more. Now that's turned out to be true. What's here on, Ravi? Now that the markets are no longer at 22, but circa 24, 25 or somewhere in between?
So let me just give a couple of minutes to why I thought that odds were in our favor. Because everybody at that point of time was clearly very worried. The world as we know it is coming to an end, and new economic order is being put in place. And even today, I think big voices like Bridgewater have put out notes saying that this is not a small thing. It happens once in 50 years kind of an event. No doubt about it. It is a big event. We are rewriting the rules of the trade, but I do, believe that the president of United States has a particular style, and there is a pattern to it. It is you can read through it that he makes some kind of an egregious, outlandish statement, brings people to the table, negotiates, and gets a good deal. That's essentially his entire playbook is about getting good trade deals. So. And for all practical purpose, it looks like India will be first of the block in terms of getting a deal, and deal might not be so unfavorable for India. So from both perspective, India actually ends up in a better position vis-a-vis. And the main point of friction for them is with China and other Southeast Asian nations, which are conduit for China. So that is where the fight is, and we might actually end up falling on the right side of this equation in the new trade order. So very different views if you are in US. I do believe that from a very longer term perspective, what has transpired, US had become almost 75% of the world's market cap. I think that is untenable and unsustainable. The rest of the equity markets will also now perform, and India will be a beneficiary in that as well.
Got it. Okay, Ravi, you take a lot of bets in futuristic themes, but I believe the ordering and the juggle would have gotten reset because of this tariff announcements as they came in. Now we know that those issues have been dialed down quite a bit from the US end, right? So has it involved juggling the portfolio all over again because of some assumptions that rightfully could have been made at the start of the tariff war? And what is it, where is it that you have the highest conviction? Because the street is very, very divided on a lot of themes due to the tariff war or otherwise.
So, first of all, I believe we are not yet clear on how this trade war will materialize, in what kind of new rules are being rewritten. Only thing what we know at this point of time is that there are certain sectors which are not impacted by the trade war at all. For example, financials, we have seen the kind of rally that this, because it's not impacted by the tariff war, it is totally linked to the domestic economy. And domestic economy actually is now on the path of recovery. Whatever was ailing has now been turned, whether it is government, whether it is RBI, whether it is liquidity, whether it is interest rates, everything is now supportive of growth. So from that perspective, there is a clear winner in the set of companies and industries which are not impacted by tariffs at all. That is one part of this. Second part, in which could be the winners or losers out of this tariff war, I would like to reserve my judgment on that at this point of time. And I would not even like to place my bets. I think what I like to say is that you should take bets regardless of whether that sector turns out to be a winner of the tariff war or loser of the tariff war. Now, if there is an added kicker that the supply chain realignment leads to that sector being a beneficiary as well, that is a great thing. So you should be able to justify an investment without that additional kicker. If that comes in, nothing like it. I mean, I'm just giving an example of, let's say, textile sector. If textile sector looks good, of course, with UK FTA, EU FTA, and if we have some kind of a deal with US, it will be a big kicker for that sector, and that sectors can change trajectory dramatically. But will that definitely be the case? I'm not 100% sure at this point of time. Early indications are there. So that's just, there are some second order, third order implications also of that. For example, where will China supply then? If they are not going to supply to these markets, then where will it go? And can that end up oversupplying our domestic market? So those kind of things one has to worry about. So I would like clarity to emerge before declaring winners of the tariff wars.
Ravi, in terms of clarity, is this an opportunity to buy? We've been speaking over the last 7-8 days or trading sessions with everyone who says it's a buy on dips market right now, and no dip in this sense has presented itself. For those who missed the bus, got very cautious, conservative or fearful with the kind of 6-month downturn we saw. Are we seeing opportunities of buy on dips? And if so, where would you be most excited to see deployment?
So I think first of all, we need to understand that the larger trend, which is still an uptrend in my opinion, is not broken yet. It was a corrective move. Whatever the 6-month we saw was still a corrective move and not a reversal of the larger trend. See, we are at the mid-cycle of the earnings cycle. I don't think the leverage has peaked in the corporate world, neither has the asset quality, it's pristine in banking system. So this is a little bit of a growth challenge, little bit of a margin challenge, and a little bit of valuation challenge. And that can correct itself over a period of 6 to 9 months with some kind of a correction, which is exactly what has happened. Now, wherever there is no issue, whichever sectors and companies are not facing growth or margin challenges, we'll see revival for sure. Because the factors of growth are also, the lead indicators are again back in favor. So I would say it remains a buy on dip market. The dip turned out to be a much deeper one than anticipated by most this time around, but it was still a buy on dip. Now, having most of the, from the bottom, we have recovered quite a bit. I would anticipate that the pace of going up to slow down. There will be some kind of a consolidation. And not to expect returns in the next 3-month time frame, but from a 3, 4, 5 year perspective, I think we are still very much invest in the market mode.
Ravi, you now manage a fair degree of global money, and you'll be speaking to a lot as well. 30,000 crores in the last few days, the highest buy number yesterday since March 27. Clearly, the nature of the global opinion out here is changing. We see it in the sell side notes as well as the advice that they are giving to their global clients. What's your sense? Here on, is global money likely to stay sticky and the inflows would continue into India? Are you sensing that in conversations that you might be having with your investors as well globally?
No, I definitely feel foreign money is going to come in, and this is only the beginning. See, for the last 15 years, there was one trade that was panning out: buy US and sell everything else, which was being called as US exceptionalism. We come up with these terms every now and then, but whatever might be the case, once all of us knew about US exceptionalism is when the US exceptionalism ended. So every crisis that we have seen in the world in the last 2-3 decades, the rush has been to go to the safe haven, which is US dollar or US treasuries. This is the first time that we are witnessing money flow out of US treasuries and US dollar. What does that tell you? That tells you that the confidence in US as the safe haven is not there anymore. Bond yields have fallen for pretty much every other country. The currency is going up for every other country. So naturally, non-dollar assets will do better than dollar assets. And if that is the case, then money should flow over there. And India will also be a recipient of that. I am not making a case that India will be something exceptional vis-a-vis some other emerging markets. See, it could be Europe that gets money. It could be some other markets also. But India will also get. There was a point in time where relatively India was very, very unattractive. It's not the case anymore. The relative attractiveness of India has come back. See, people say India is quoting at a premium to the emerging markets. Yes, of course. But, it's like saying that pharma is quoting at a premium to metals. Of course, it is quoting at a premium to metals. It's a different kind of a business. So India is cannot be in the same bucket as some of the other emerging markets, which are purely much smaller economy, far lower ROEs, far fewer sectors, more commodity driven. Those kind of things are the reason why India always gets a premium. And also the biggest reason technically is that almost 40% of the float in India is owned by promoters, which is not the case in other markets. So all these factors mean that India will always remain at a premium until at least we see like huge dilution from the promoters or something like that. But until that time, India will always enjoy some amount of premium at least. And so the relative attractiveness is there. At the lows, absolute attractiveness was also there. Weightage in MSCI and other FTSE benchmark and all has gone up for India. So naturally, the money should flow into non-dollar assets, and India will also get its fair share over there.
Okay. Ravi, my final question, and that is, you must be bored of answering about energy transition because it's well discovered, you guys championed it, so on and so forth. What's the next energy transition theme in India? Something similar to that.
So you will have to listen to me for another 5 years probably. This trend is not going anywhere.
No, that we know.
I think it encompasses probably 20 different sectors. So it moves from sector to sector. Today, the two sectors that we do like are the solar renewable value chain and the transmission power value chain. But will it shift to, let's say, some other sector 3 years down the line, whether it could be hydrogen, whether it could be EVs, whether it could be battery storage, all those kind of opportunities are coming up at some point of time. So I don't think we should say energy transition from any point of view anywhere close to peaking. It's a trend that's going to run for at least a couple of decades, and the sectors within that will keep changing. So I just listed out a few ones to you, which I believe are still some time away from becoming investable because the unit economics are probably not in place for hydrogen or for battery storage systems. So once those comes and there is enough regulatory tailwind is when they become investable. But it's okay. At this point of time, they are visionary investments.
All right. Thank you so much, Ravi, for speaking with us. Ravi Dharamshi, founder and CIO at Value Quest Investment, with some sanguine advice there. Ravi, I don't know if I agree with you completely that there is no concern about geopolitical escalation on the street right now, because if one starts and there will be retaliation from India's end, that's a given. Then we don't know where it will go. That street doesn't like uncertainty. So I don't know. We'll wait and see how that pans out. But Ravi Dharamshi there, markets meanwhile taking a clear tumble. Let's just pull up the intradays to give you that picture about where the Nifty is. Just about 1%, 200 points down right now. Worst performing index among others seems to be the Realty Index, Bank Nifty. Let's see if we can pull up the sectoral heat map just for a second. I also want to see India VIX and see if there is any kind of a spike there. Nifty 50 taking that sharp tumble. The sectoral heat map showing IT the only sector in the green right now, and that too holding on by a thread. Nifty defense actually the worst hit. Logic would dictate you'd see defense stocks going up, but maybe some pressure there which will come in. Let's understand what is really happening factually on the ground, and for this I'm going across to my colleague from NDTV, Vishnu Shom, on what exactly is the sense of escalation. Now Vishnu, this is what happens when you have the drums of war, a lot of speculation, some fact. Let's just understand what the facts are, because I believe there has been some cross-border firing this morning.
Drums of war is an accurate phrase, but I would suggest that we shouldn't assume something militarily is going to happen immediately. It may take some time for anything to happen. Then there is also the option that nothing might happen. But in answer to your question, yes, there was speculative fire by the Pakistan Army on several posts across or along the line of control. What is speculative fire? It's nothing It's not targeted in a sense. It's just, weaponry, including machine guns, light weaponry, being used to test our defenses. So once that takes place, we respond. Sometimes you don't even respond to all speculative fire. Some of it is just, for example, rounds being fired in the air. So the army and the Jawans over there in these posts need to decide if they want to conserve their ammunition or respond. This is not targeted. This is not a major attack. No artillery was used. No mortars were used. And I would suggest that over the next couple of days or weeks, we'll see a great deal of this.
Yeah.
So this by itself is not an act of war or anything that really goes beyond.
You're right. You're right, Vishnu, because the first reports of this came in overnight, right? What is happening across the border. But some of the other things that people are building in. For one, you have the army chief in Srinagar right now. The very, very strong statement which came in from Prime Minister Modi. And then what Pakistan is now saying, that they're not going to recognize the Shimla Agreement. Are these important departures from business as usual when it comes to how India and Pakistan deal with each other?
So there is no business as usual with Pakistan. This is a relationship which has completely gone south. India has told all Pakistani nationals to leave this country. There are a couple of exceptions, but by and large, all Pakistani nationals have been told to leave. All Indian nationals in Pakistan have been told to come back. There is speculative firing on the line of control. The Indus Water Treaty has been held in abeyance. Pakistan says that the Simla Agreement, in which the line of control was actually formed, is being held in abeyance. So if Pakistan doesn't respect, at least on paper, the existence of the line of control, then it is, it's a strong gesture. Not that they have ever really followed what the LOC has to say. When they push across terrorists, they violate it on a very regular basis. The hunt for terrorists is continuing. The army chief is on the ground, but he doesn't need to be in Kashmir to get an idea or know about what exactly is happening in each of the frontline positions. But I think there is, his presence there would add impetus to the hunt for the terrorists who were responsible for the Pahalgam terror, in which 26 civilians were killed. And it's one among several steps which India will follow, and I would suggest that there are many other diplomatic steps still left before we go ahead and do something militarily, if there is a decision to do that.
Okay. Thanks so much for that context, Vishnu Shom there. So, it's not necessary anything is happening right now. There should be no panic, and I think that's important words coming in from, because we're going to be reporting the facts here. There has been exchange of firing across the LOC, but that happens and has been happening on and off, because this is, of course, a very fructuous relationship between India and Pakistan. India has been bearing the brunt of these terror attacks for a while, and this, of course, was the most heinous of the lot that we've seen in decades. Of what happened in Pahalgam was unbearable.
Unbearable,
yeah,
to say the least.
Yeah.
Yeah, but hopefully, Tamanna, actually, I don't know what to hope for, really.
Yeah.
But just let's see how it goes.
Justice. But we'll take a very short break. We're keeping an eye on the markets. Markets in a bit of pain at this point. But we'll come back with our focus on what you should do with your investments in Ask Profit after this very short break.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to the current market price. A premium of nearly 10 to 15% is what the dealers are indicating.
$361 is going to issue these securities to UBS at a deal value of roughly 40,000 crore pre-money and around 42,000 crore post-money.
The second buy pick is in Naukri InfoEdge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
In the last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be
Hi, thanks so much for joining in this morning. Happy Friday to you. This is Ask Profit on NDTV Profit. My name is Alex Matthew, and with me is Mahima Vajrajani, and we'll take you through the next 1 hour of trade. It's a picture that has turned quite dramatically over the course of the last hour and a half, and the markets have actually turned quite negative. Very, very close to the low point of the day for the Nifty 50, down about 300 points as we speak, and broken below that 24,000 mark as well. But more pain in the broader markets, if at all. I think we might have bounced from the low point of the day, but we are still, so the mid-cap index trading with cuts of nearly 3% at this point. Pull up the small-cap index as well and see where it is at. It's now more than 3% lower. So that brief bounce back from the low point of the day was also sold into, and you're seeing quite a bit of pain across the board at the start today. Perhaps some are saying the uncertainty over geopolitics, the tensions on the border with Pakistan playing out. But one might argue also, based on the derivative data, which I'm sure our expert will have a view on, the rollover data pointed to the fact that investors, traders are not willing to hold on to positions as well. And maybe after quite a hot rally over the past 7 days or 7 sessions, some money being taken off the table. Axis Bank seeing quite a bit of a cut today, 4% or thereabouts. A lot of the frontline companies seeing sharp cuts. Joining us this morning is Sameer Dalal, Natwarlal and Sons stockbrokers, as well as Jatin Gedia, technical research analyst at Mira Asset Sharekhan. Gentlemen, thanks so much for joining us as always, and happy Friday to you. Jatin, I'll come to you first on what you're seeing on the screen. And if you have any existing positions, a lot of people seem to have unwound them and not rolled things over into the new series. But what should your strategy be in this current environment?
Good morning, everyone. Yes, as likely pointed out, the rollovers have been on the lower side as against the 3-month average in both Nifty and Bank Nifty. So going ahead, what we believe is that since the second half of April, we did see a sharp short covering rally in both the Nifty and Bank Nifty. Bank Nifty went to an all-time high. The Nifty, however, is struggling to cross the 24,500 mark, which was the 61.8% retracement level of the entire September to April decline. So 24,500 was a crucial resistance, and now until and unless 24,500 is not decisively breached on the upside, we believe that there could be some amount of weakness or consolidation going ahead. Now on the downside, the crucial support levels which are now ready to be tested are 23,870, which was the previous swing high. So as per the role reversal principle, now 23,870 to 23,800 becomes a very crucial support level for the bank Nifty, for the Nifty. So if the Nifty has to, hold on to some sort of this bullish up move that has been happening since the second half of April, then 23,870, 23,800 should be held on, and thereafter we can expect a further up move. So this down move has come in, but we believe that 23,870, 23,800 will hold on.
Okay, so that's the view with regards to where levels for Nifty 50 are concerned. Our first query for the day is from Siddharth, who's writing in from Pune. He's holding 600 odd shares of Tech Mahindra, bought at 1510 a piece. Samir, I'll come to you on this one. Tech Mahindra came out with its earnings yesterday. Numbers largely in line. Deal wins were better than what analysts were expecting. But overall, the top three segments growth has been largely flat. What is your reading of the earnings, and what should Siddharth do with respect to his holdings right now?
Yeah, so good morning, Mahima. We've been saying for some time that the IT sector is something that we have not had too much comfort with, given the fact that growth is in single digits, guidance is in single digits for growth. The best part of the margin expansion that happened over the last couple of years is now behind us. So now we are going to have to maintain at these margins. So when companies are growing at 4-5%, yes, Tech Mahindra had a phenomenal quarter. I will not put that behind because of the cost reduction initiative, and also there were some one-offs. If you take into account, the growth was not that great. It was good, but it was not as spectacular as the 79% that looks like when you look at the numbers optically. But the basic thing is when companies grow at 4-5% and margin expansion is not possible. So we're talking of profitably growing maybe at 6% or 7%, and companies trading at 22 times forward earnings. It becomes difficult to justify why one should invest in the stock. So as good as the numbers were for the last quarter, we don't think growth is going to be anything phenomenal. Order executions are going slow. New orders, even though they're coming, we need to see the light of day. And plus, you also got to remember that if the US is going to go through a slowdown, which everyone's talking about, which is the biggest market for all our IT companies, then you're not going to see good growth, because eventually they are going to cut spends from IT. That's the easiest place. I keep saying it's the easiest place to do some amount of cost saving. So if that is the case, then why should we value companies at these valuations? So I'm not in favor of investing in IT at this point. Your caller has bought it at 1510. If he has a very long-term view, maybe 3 years, he can hold on. But if he's looking at a 1-year kind of view, I think he should exit it and buy something else where the opportunity in the near term might be better.
Okay. So comprehensive view on TechM as well as the IT space. We've got our first caller of the day. Snigdha is calling us from Hyderabad. Hi, Snigdha. How can we help you today?
Hi. So my query is regarding Wilson and Solar.
Sterling and Wilson Solar. Yeah.
Yeah, Sterling and Wilson Solar. Sorry. Yeah. So I have 600 shares purchased yesterday at 328. So I just want to know if I can hold it for next 3 months or should I sell it?
Okay.
So the results were declared yesterday, right?
Yes. They were. A stock under a little bit of pressure, so I'm guessing that's what you are concerned about. So let me go across to Jatin on the chart. Jatin, under pressure today. In fact, no buyers in the stock. It's currently locked in circuit. So what should you do if you bought at levels of 328 with a relatively short-term time horizon?
I think it's time to exit at a minor loss. The reason being it has hit the 330 mark, which is the 20-week average. So a crucial resistance has been reached, and thereafter we are witnessing selling pressure. I know this selling pressure might last for some days, and the stock can drift towards 285 to 278 levels. So that's a decent down move that we are expecting in the stock. So even if at minor loss at current levels, she should exit the position.
Okay, so that's the view with regards to where charts are concerned for Sterling and Wilson. Our next question is from Yogesh, who's writing in from Bengaluru. He's holding Eternal, that is Zomato, 15,000 shares bought at 238 a piece. The stock is currently trading at 231, so he's sitting on a loss of around 94,000 odd rupees. He wants to know whether he should hold or sell at the current levels. Samir, your view with respect to where fundamentals are concerned for something like a Zomato?
The fundamentals are good, right? The quick commerce business, which is there, obviously is loss-making at the moment. But as they keep scaling up and the operational benefits start coming through, and they can start reducing the discounting, to capture some market share, I think that business of theirs will start turning profitable quite quickly. They've obviously been able to show that, once they want to turn profitable, they can, the way they did with the food delivery business. And that business continues to scale up. We believe the opportunity is only going to increase given the kind of consumption increase we are expecting to happen post these tax cuts that the government has given. It will start now. So if order increases on the food delivery side, that will lead to increased profitability. The QSR space, quick commerce space will also grow. And eventually it'll take maybe a year and a half before they can break even. But given the fact that this is a business which requires limited capital investments, can get the operational efficiencies to kick through, and we've seen that in the past. Maybe 2 years down the line, if the person has a 2-year horizon for waiting, I think he can make good money. So stay invested. In fact, I would go ahead and say that if the stock corrects closer to the 190 levels in this fall, whatever's happening in the markets, go ahead and buy some more.
Go ahead and buy some more is the view coming in on Eternal. And of course, your view, quick view, Samir, Swiggy versus Zomato, preferring Zomato over Swiggy?
So I think Zomato, being the larger player, would probably stand to benefit. Swiggy is also good, but if I had to make a pick, yes, Zomato would be the pick I would make at this point.
All right. So that's the view with regards to where Zomato and Swiggy are concerned. Our next caller, Mansing, is calling in from Andhra Pradesh. Mansing, a very good morning to you. How can we help you?
Good morning, madam. I'm holding Tanla platforms.
Okay.
60 shares, average price 590, madam.
Okay.
Yesterday it posted results. How was the results? I will hold for 1 year. I want to know the fundamental and the technical view, madam.
Okay. Mansing, sorry, you were saying something? Okay, I'll take your view, Samir, on this one. Tanla Platforms came out with its earnings yesterday. Well, largely the numbers were flat in terms of revenue growth. It was at 2.4%. EBITDA was down by about 1.5 odd percent. What's the reading like, and what's your view like?
Sorry, unfortunately, Tanla is not a company that we cover. So can you put this to the
Okay, sure. Jatin, on the charts then, do you think this is the right time to make an entry or maybe continue to hold?
I would suggest the caller to wait. The reason being the stock is in a medium-term downtrend, and we believe that on the downside there is still more downside towards 430 to even 400 odd levels. So the stock is in a downtrend until and unless it sustains above 510, 525 odd levels. We don't see the trend reversing as of now. So Tanla solution should be avoided from fresh entry.
Avoid Tanla platform is a view on the charts. Okay, just to follow up then, if that's the case, then if you're holding, would you exit at this point, Jatin?
Yes, I would suggest to exit because the structure that is panning out since the last couple of weeks is not bullish. In fact, it is only suggesting a range-bound price action, and we can expect a breakdown of this consolidation on the downside. So the price pattern is not suggesting a fresh rally on the upside.
Okay, all right. So that's the view on Tanla platforms. Our next question is on Century Ply, and it's a question from Kadir, who's writing in from Nagpur in Maharashtra, and he's bought it at an average price of 370 rupees a piece. He's looking for a fundamental view, long-term view, and he's in the green quite considerably so because the stock is currently trading at 709.
What's the view on this one, on the fundamentals, Samir?
So Alex, yeah, fundamentals for the company are good. We believe the growth opportunity is quite strong given the kind of boost we are getting in the real estate space, which is what drives the business for this company, right? So yes, temporarily there's been a bit of a slowdown, but we believe we will see the real estate cycle seeing an uptick further. And once that happens, companies like Century Ply and all will continue to do well and do even better. But the problem for me is only one, that the valuations are not attractive at this point of time. The stock is trading at about 40 times 1 year forward. And for me, that kind of is like a threshold where I would not want to be recommending a buy. So if we see a correction in the stock, maybe of 20+%, again, like I said, it needs a significant correction, then it would throw up a buy opportunity for me from the longer term, because like I say, I like to make 15 to 20% return with taking not an excessive amount of risk. And when I'm buying something at 40 times 1 year forward, I believe I'm taking a lot of risk, because if something doesn't pan out the way we expect it to, then the downside opens up quite significantly. So from that perspective, as good as the opportunity for Century Ply, Green Ply, any of these companies is, I would avoid them at this point given the high valuation.
All right. I encourage our viewers to ask all their questions related to investments, and even the basic ones. We've got a question from Nimali Puri, I believe that's the name. How many stocks should you idly hold in your portfolio? And it's a pretty basic question that somebody would ask when they're looking to venture into the stock market. Even somebody who's tried their hand. I guess, Samir. So this question obviously is for you. And we've spoken about this in the past, right? With a lot of our viewers taking concentrated positions, some of them as much as 70-80% of their portfolio. The question really is, how much should you hold? The immediate response that I gave was whatever you can track. And so if it's more than 20-25, then you're probably not going to be able to track the stocks that you've bought. Is that a fair answer?
So I would agree with you that 2025 should be up to 30 should be the maximum anybody should hold in a portfolio, because it kind of gives you diversification also, and also leaves some amount of concentration. So you can probably split it up where some of the companies where you're more bullish as 5%, and maybe some of the companies where you are not as confident, maybe 2%. In general, if you have 30 stocks, 100% portfolio would be 3%. So you can vary that around a little bit. But in general, yes, 30 companies should be the outer limit. 20 to 25 would be ideal in a portfolio. But let's put it this, if you can only track 20 to 25 companies, and which is why sometimes it makes more sense to give money to the professionals to manage or take advisory services from the professionals, is simply put that there are over 4,000 companies in the market. And sometimes you may not be able to study something or get an idea which somebody else in the market has. I'm not saying that every broker or every advisor also has the same coverage, but at least they have a little bit more because they have more resources on their thing, and this is their focus. But yes, 20 to 25 to answer the question should be ideal. Try not to cross 30, and no point having less than 10 stocks and having concentration of over 10% in each stock. I think that is a bit of a risk.
Yeah, another way to look at it would be to split your investments, to have, of course, mutual fund investments, as Samir is talking about, and you can have a kicker. You can have a few stocks that you hold individually as well, things that you might want to pass on to the next generation. All right, Madan is calling us from Bengaluru. Hi, Madan. Thanks so much for calling. How can we help you today?
Yeah, my question is on Dr. Reddy Laboratories.
Yes.
I'm holding 500 stocks of Reddy Laboratories. I had bought it for pre-split. Now I'm holding 500 shares of lesser face value at an average cost of 1,300 rupees. With a lot of talk on Trump imposing tariffs on Indian pharma also, how is Dr. Reddy is placed? And can I hold the stock for some time or book out the loss?
It's a good question, Madan. So you've been holding for a while, pre-split, of course. And am I right in assuming that you would be willing to hold for the long term?
Yes, I'm willing to.
Okay. All right. So Samir, the question is pretty straightforward, and I think we've addressed this over the course of the last couple of weeks. But then the nature of the announcements coming or the news updates coming in from the US are such that there are knee-jerk reactions. If there is an announcement, then there is a sharp sell-off, even if it is not really feasible for companies in the US, for buyers in the US of pharmaceuticals in particular, to shift supply chains very quickly. It's not going to happen. That's the fact. It cannot happen. It will take at least 3 years, if not more. So from that perspective, would you continue to hold in Dr. Reddy's laboratories?
So short answer is yes, I would continue to hold. And simply put, all the arguments that you only put up, I'm going to use. Yes, you're absolutely right. 3 years is the minimum before you can shift. A lot of the pharma, medicines is something that people are going to buy, whether it costs more or less. It doesn't matter. If you need the medicine, you need the medicine. Third, a lot of these medicines in the US go through insurance, and insurance is going to have to bear the brunt of it. It's not going to be Dr. Reddy that bears the brunt of it. And lastly, look, what you said about the knee-jerk reaction, I'll say it will not be as bad because Donald Trump has been saying this repeatedly. So the market has to some extent priced in that this is going to come. So when it comes, I think then it could probably, sell the rumor and buy the news. So it could probably bottom out when he actually makes the announcement, because then the worst is over and then things will start looking up. So I would say continue to hold on. That's the long answer.
Okay, continue to hold. DR is the view coming in where fundamentals are concerned for the company. Our next question is from Akshat, who's writing in from Greater Noida. He's holding 10,000 shares of GMR Power at an average price of 90 rupees per share. The stock is currently trading at 123. So he is sitting on a loss of around 3.4 lakh rupees. Gain of okay, since he's bought it at 90 and the current price of stock is at, I think I'm in Friday mood, certainly, at 123. He's sitting on a profit of 3.4 lakh rupees. He wants to know as to what should be the next course of action for him. Jatin, do you think that he should book partial profits and go ahead and continue to hold some, or what's the view like?
See, as far as technically concerned, definitely some partial profit booking is advised. And I would suggest to keep a trailing stop loss of 116 on the downside. So if 116 on the downside is breached, then we can, further expect a downside towards 100 odd levels. So if he is still continuing to hold, then 116 should be the stop loss. However, my advice would be to do some partial profit booking.
And have a good weekend.
Yeah, so book some partial profits and have a good weekend is the takeaway from that. All right, our next caller, Shweta, is calling in from Hyderabad. Shweta, a very good morning to you. How can we help you?
Hi, Mahima. Good morning. Welcome back.
Thank you.
My question is regarding BLS International.
Okay.
I have 125 shares bought at 403 rupees.
Okay.
And I would like to know Sameer's detailed view about this stock.
Okay.
I like how he gives a complete picture of the stock. So I would like to know his review for this.
All right. Shweta, I got your query. Sameer, I'll come to you. I hope you heard that. BLS International is the counter. What's the view like?
So we do have a positive view on the business of prospects, right? So this is a visa facilitation services that they organize all over the world. They have some operations in India as well, and they have operations. We believe with all of these trade wars increasing, what's going to happen is even getting visas in these countries, and for some countries like the US has already started making it difficult, Canada is making it difficult. The requirement of these services are only going to increase in most of these countries. So the opportunity to grow is quite large. Already we have huge waiting lists in places like India so the market is going to keep expanding. You're going to have new centers coming up, and all of these centers are very low cost in nature, in the sense they are all operational costs. There's no fixed cost kind of in nature, because the property is rented, the employees have paid salary. And as the revenue starts flowing through and the operations start breaking even and start making money, I think each of these new centers will add quite significantly. So if you have a 3 to 5 year view, please stay invested. Valuations are not cheap, but corrections, again, closer to maybe 300, 320, I would recommend adding on some more. Fundamentals, very, very good. No problems there.
Okay, all right. So that's a comprehensive view on BLS International. Stock under a tad bit of pressure, but quite a few stocks in the broader markets also under selling pressure right now. I understand, Jatin, that you have to leave us. Thanks so much for joining us this Friday. And as always, have a great weekend. We have to slip into a very quick break. We've got more time on the other side to take more of your questions, so do stay tuned.
That's huge. That is a biggie. It's out of there.
गोल्ड प्लस क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर.
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to the current market price. A premium of nearly 10 to 15% is what the dealers are indicating.
$361 is going to issue these securities to UBS at a deal value of roughly 40,000 crore pre-money and around 42,000 crore post-money.
The second buyback is a Naukri InfoEdge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
In the last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish
Welcome back. You're watching Ask Profit. Now, this show, of course, gets you answers to all of your stock-related questions. But the next one, Know Your Company, helps you understand the stocks that you might be invested in or you might be contemplating investing in. And we've covered a number of companies over the last few weeks. On today's show, we've got Tamil Nadu Mercantile Bank. And you know for a fact that the last couple of weeks have been incredible for the banking space as a whole. Of course, today and yesterday, you're seeing a little bit of profit being taken off the table. Tamil Nadu Mercantile Bank is a relatively small bank, and it just posted its Q4 numbers not too long back. A decent set of numbers. The question is whether or not the offtake in loans is fast enough, and whether the outlook for the next financial year is better than what occurred in the fourth quarter, whether loan growth will finally start picking up. You'll find out what the bank is exposed to in terms of its loan book. You'll find out what its deposit franchise is doing, and all of the key metrics in terms of return on assets as well as net interest margins. We'll discuss the trajectory of all of those aspects as well as speak to the management. You should watch out for that at 11:30. Let's take our next caller. I believe we've got a caller, if I'm not mistaken, and I thought it was on data patterns. I think somebody's called us. Yeah, Sampath is calling us from Bhubaneswar. Hi Sampath, good morning. Please go ahead with your question.
Actually, this query is regarding data patterns. I'm holding 20 scripts of that stock at an average of 2,598.
Okay.
And currently I'm sitting at a loss of 10K. And since this is a defense sector stock, and it has been off recently, it has been under SEBI surveillance for exceeding its valuation. So my query is whether I should hold or should I exit?
Okay, so you've got a relatively shorter term view on the stock, is that right?
Right.
Okay. So I'm joined by Vikas Jain on this side of the break. He's the head of research at Reliance Securities. Vikas, thanks so much for joining in. What's the view on data patterns for the short term? Would you book?
Yeah, if he is bought with a short-term perspective, then it is a good exit point. Because if you look at, he has not averaged it at the way below when the stock directly near to those 1300, 1400 levels. And from 1400, the stock has rallied almost near to 2100. So good 45-50% up move has been happened into the lane. And the stock is near to its 200-day average resistance area. So I believe it should put some out that out at current levels and wait for some more decline to enter into the lane back to near to 1750, 1800.
With regards to where charts are concerned for data patterns, our next question is from Aniket, who's writing in from Karnataka. He's entered Lemon Tree Hotels at the price of 139 rupees. He's bought 50 shares and wants to know as to what's the next course of action for this particular counter. Samir, I'll come to you. Your view on Lemon Tree as well as the entire hotel space. Which counters do you like, and is Lemon Tree one of those?
Lemon Tree is definitely a good operation business. The hotel business, we believe, in India is going to keep growing because tourism from within the domestic markets and also international tourists coming is going to keep growing. So we expect occupancy rates to remain high in these properties. The hotel ARRs, that's the average room rates, are also holding firm. So that is a big positive. And you look, most of these companies are now working through the low-cost operational business, which is where they do management contracts. They brand the hotel up in their name. They're running the show, but they don't own the asset necessarily. The asset is owned by somebody else who's happy to earn a 10% or 11% return on that because they get the capital appreciation along with it. So so what happens is when you have a low cost operation margin business, your ROEs can keep moving up and you can expand a lot faster. So we believe Lemon Tree is also one of those companies that is doing that. So it's looking good. It is a long-term buy, even at this price point. Our top pick, of course, in the space would remain Indian Hotels from the fact that they are the biggest brand and largest. They have presence across all verticals from the very high premium to all the way down to the Ginger Hotels, which they're scaling up at a very fast pace, which is a low-cost business model. So that remains there. And I'm going to go out and say one offbeat stock, which is generally not discussed in the hotel space, which is a company called Sayaji Hotels. Disclaimer, we own it. And what is the beauty of Sayaji Hotels is, apart from increasing the hotels, right now they're about 21, they're trying to scale up to 31 by the end of this year. It may not happen at the end of this year, but let's assume they can scale that up. That will do well. And they own Barbecue Nation. So they are the promoting entity of Barbecue Nation, where they own about 31-32%. And if you just take the value of the holding of Barbecue Nation, you're getting more than the market cap of Sayaji itself. So just the investment is worth more. And then the hotel business is going to be growing, scaling up and becoming even more profitable. So we think there's a lot of value in this company. And this stock could probably run up closer to 450, 500. It's come down from those levels, so it can quickly run up to that once you have stability in the markets.
Interesting. Okay. So, Sayaji Hotel, we were just putting it up, 500 crore market capitalization company, relatively small, but several options available now in the space to pick and choose from. So, bear that in mind. Of course, we tend to speak about the larger ones, Indian Hotels, Lemon Tree, but there are other options available as well. Earnings that came through earlier, not today, but yesterday, Laurus Labs, and Sunil is writing in from Visakhapatnam. The stock under pressure today, 5.7% down. The question, Vikas, is should he purchase at this point? Is this the right moment?
I think we should wait for some more time because we believe the Laurus Labs always witnessed strong amount of volatility post the result season. And when the stock corrects, it corrects more than 10, 12, 15% at a trot. So we believe on the downside, some amount of support area is near to 570, 575 levels. So we can wait on for those 575 levels, and 10 to 12% correction could happen, which is the intraday average. So that should be a good entry point to enter.
Okay, so that's the view with regards to Laurus Labs. Our next caller, Ravi, is calling in from Hyderabad. Ravi, a very good morning to you. How can we help you?
Yeah, very good morning. My query is on Bajaj Housing Finance.
So is it a good time to buy Bajaj Housing Finance, or shall I wait for a couple of days so that the stock gets more correction?
Okay, and Ravi, when you say you want to buy, is it the time horizon is longer term from a longer term perspective, or?
Yes, I can hold for 1 to 2 years.
1 to 2 years. Okay, Sameer, your view with regards to Bajaj Housing Finance, is this the right time to buy?
Quality asset pricing is a little bit expensive. I mean, but look, all the Bajaj finance companies, that is Sanjeev Bajaj Group companies, have been trading at premium valuations for some time. So that makes me believe that probably that's a premium valuation for Bajaj Housing Finance can also sustain. But I mean, since the question is about Bajaj Housing Finance, I say yes, you can go out and buy. But I think there are other companies in the housing finance space which are more attractive at this point of time and may warrant a better buying opportunity. I'll give you one which we are very, very positive on, is Sammaan Capital, which used to be the erstwhile Indiabulls Housing Finance. It's trading at under book value. They've gone through the pain of cleaning up their books. They've taken huge provision. The split in the company has happened for the affordable housing as well as for the premium housing. They're going to be working the model where they do co-lending. So 20%, we've discussed this on your channel, 20% will be funded by them, 80% by another person, meaning a bank, and they will be able to charge a fee to the bank for the collections, for all of the activities that go on. So their ROEs will move up quite a bit. And as the ROEs move up and as the operational efficiency kicks through, I think Sammaan could probably a stock that could go closer to 200. So that would be my top pick in the space at the moment in housing finance. But Bajaj Housing Finance is also a good investment.
Okay, all right. So watch out for Sammaan Capital. The entire pack, in fact, quite a few stocks are trading in the red at this juncture. Tata Motors. So this is a question from Leena, who's writing in from Kolkata, and she's pointing out that she's tracking the company. She's looked at the fact that a demerger is on the cards. She's looking for a potential target from the perspective of 12 months. And Sameer, that overhang for Jaguar Land Rover and the US tariffs, all of that has weighed on the stock, and it's trading at what, 660 or thereabouts, if I'm not mistaken, on the ticker. Is this a good moment to buy? Because I don't know how many opportunities you'll get to get Tata Motors at, I don't know whether it'll go back to COVID lows. Double digits was when it hit then. A lot of people jumped into it, benefited from that. Would you buy right now, Tata Motors?
So I can safely tell you, Alex, that it'll not go back to the double-digit number ever. So that was an opportunity. It was a once-in-a-lifetime. Is this also a once-in-a-lifetime opportunity where the stock has corrected down from 1100 to 600? I would like to say yes, from the simple point of view that the opportunity in India continues to remain very large for the Indian domestic market, which is, of course, a big chunk of their business also. The profitable chunk of their business is Jaguar Land Rover, which we believe will return to normalcy. And it's not only Jaguar Land Rover. When these US tariffs and all of these things impact, it impacts all the other car companies as well. So it's not going to be just Jaguar Land Rover that suffers or struggles. It's going to be everyone, or everyone together figures out a way, including the US government, how they can allow these cars and imports to happen, because you cannot expect everyone to set up manufacturing within the US. There will be selected few that do it. Maybe some offset kind of things can happen, but you cannot expect every single company to do it, and they have to realize that. So unless they want to just increase their costs, like we in India pay unnecessarily high amounts of import duty on cars. I mean, if US does that, that's really bad, and that could hurt Jaguar Land Rover, but we think it'll settle itself out. And from a growth perspective, we think the opportunity is there. So I think, yes, go ahead and buy Jaguar Land Rover. Valuations optically may seem a little expensive, but they're not. We think the operational efficiencies from the India business will start kicking in, the profitability increase, and which we've always discussed before, there's going to be a demerger, which is going to lead to some value unlocking that's going to happen, where they're going to split up the commercial vehicle business and the passenger vehicle business. So once that happens, I think the commercial vehicle business can get similar valuations like an Ashok Leyland or somebody else like that, and the private vehicle business can also start commanding some valuations more like Maruti. If that starts happening, that will itself will lead to a uptick in both the counters. So we think it is a buying opportunity at this point.
Right. I was just speaking to Alex that our auto analyst is going to be very happy about this because we keep sharing memes about how loyal investors have always stayed invested in Tata Motors no matter what.
No, but I know also of people that have gotten in at those double-digit levels and they booked out at. I know somebody who bought a house. Of course, you need to be able to, but you need to be able to deploy that much. We have some of our viewers who've got that kind of capital, sitting on gains of 1 crore plus or 3 crores for one individual. You're talking about which company today? You remember we got a call for DB Realty. It's called Valor Estates now.
Yes.
And what a run it's had, right? He's sitting on 3 crore gains. And he mentioned very clearly, I can't remember his name, but he mentioned very clearly that he's going to hold on to it, even though it's 50% of his portfolio.
Yeah.
So we have viewers like that.
Yeah, absolutely. All right, our next caller, Soma Shekhar, is calling in from Bengaluru. Soma, a very good morning to you. How can we help you?
Yeah, good morning. I'm Somshekhar from Bengaluru, short-term trader.
Okay.
I need advice on buying BHL because it has come down, whether it's the right time to buy it.
Okay, I'll take this up with Vikas. Vikas, for BHEL, what do you think? Are the charts indicating a buy right now?
Yeah, the stock has witnessed some 5% correction along with the broader markets. And now it is been at near to support area of 115 to 118 levels, which is a band of the averages. No doubt there was some amount of negative news flow for fire without it one of its plant. But the stock has not reacted through. So with this major broader market corrective action and the stock down by 4%, it gives a good opportunity to own the name. So we can invest near to those 215 to 118 levels. On the higher side, the first immediate target will be near to 240 to 45, which is the 200-day average.
All right. So the next question is from Revati, who's writing in from Madanapille and asking about Wari Energies, bought during the IPO and trading with gains at this juncture. And well, it's down about 3%, but it moved quite dramatically over the course of the last couple of days. The question is about valuations and where they're whether they're a little stretched at this point. Some people definitely think so. Samir, I'm wondering whether you are one of them.
Yes, unfortunately, I think the valuations are a little stretched. Look, what's happened is they've had a phenomenal year this year because of the growth of the new capacities that came on. Now, that is not going to keep repeating. So when, I'm just giving you a simple example, when you go from say 4 million to 8 million, you're doubling yourself, right? So you have huge growth opportunity that comes up in the top line and the profitability because of the operational leverage. Now, I'm not denying when you go from 8 to 12 also, the operating leverage is still there, but the growth is not 100% anymore. It's come down to 50%. And now Wari is sitting on quite a large base, right? So whatever further expansions they're going to be doing, yes, it's going to be meaningful, but it's not going to be as meaningful as before. So growth is not going to look as strong. And then you're not going to see the profits growing as much. So then the premium valuations of about 45 times current year earnings seems a bit expensive. We believe but actually, if you go look at it, everyone is trading around similar levels, be it Suzlon, be it KPI Green, be it Sterling and Wilson. You can't really take the valuation because they've just about turned into profits this year, and the operational leverage is still to play out. But they're all trading at this. But the point is that Wari Energies also makes these solar cells, which they export. And US, there are two things. One, the import duty that's come, that's going to hurt them a little bit. Is it going to benefit because China is paying more? Probably in the short term, yes. But what is also, second thing that's happened is Donald Trump is not pushing renewable energy in the same way that the Democrats were. So what is going to happen if incentives for setting up renewable energy from the US government go down and that growth does not happen in the same manner, then Wari can see some amount of lower growth in volumes, and that could also affect. So I'm not as convinced on a Wari Energy at this point of time. If you want to make a play in the solar energy space, the two stocks that we are invested in and we like, one is KPI Green, which sets up the solar parks within India for themselves through IPP and CPPs for other customers as well. And there's Sterling and Wilson Solar, which is part of the Reliance Group. There was a question in the show earlier of whether you should hold on. Fundamentally, I'm very convinced that the quarterly numbers that came were very good. The top line showed growth. Their order book is at 9,000 crores. We believe they will be able to do well over the next couple of years. Yet we haven't seen any real orders coming in from the Reliance table. Once Reliance places orders for their solar plants, I think the their growth numbers will see further acceleration. The operating leverage is coming through, and you're getting the stock at a very reasonable price. This is a stock that traded at 800 rupees, which is down to about 310 right now, and had gone down to 220. So this is a chance to buy into a long-term investment. Yes, short-term, you might see volatility, you might see the stock going down again to 280. But for me, these are the two plays that we would make in the green energy space at this point.
Sterling and Wilson at lower circuit at this juncture. Samir, there's a very insistent crow outside your window that seems to be very happy to join us on today's program. Okay, let me take the next caller. Murli is calling us from Bengaluru. Hi Murli, how can we help you today?
Good morning, and thank you for taking up my query.
My pleasure.
Yeah, I bought Canfin Homes, 500 shares,
yes,
at 745 for 799 rupees.
Right. Now,
in spite of good results, I don't know why it is coming down. Not generally market trend, even otherwise it was coming down. In spite of highest ever quarterly profit, all under control.
Yeah.
Can I switch over? Can I retain, continue to hold, or switch over to Canara Bank?
Canara Bank. All right. And you've got a long-term view on this one, Murli?
Yeah.
Okay.
Yeah,
it's an
yeah.
interesting question. All right. We did look at the numbers. Canfin Homes, Samir, since this is a fundamental question, coming back to you, numbers weren't bad. My only question is, while the entire system is seeing a little bit of an anemic kind of a loan growth phase, in that context, there are a couple of entities that are growing faster than others. We already discussed Bajaj Housing Finance, but then valuations are a bit maybe uncomfortable for a few people. In that context, Canfin Homes was being suggested as a top pick by a few brokerages. I don't know what you think. 799 is a buy price. Would you switch over to something like a Canara Bank?
Look, if you're buying Canara Bank is not exactly a only pure securitized lending business. It has banking operations and all of that, which I always prefer from growth opportunity, because they have multiple sectors to look at, and they can ensure that if one segment, for example, I'm just giving, say, housing were to slow down, they can focus on other spaces to grow their loan book, whereas a Canfin Homes has to focus on the housing and then maybe even look at, to increase their spread, because it's a very competitive space. Look at giving developer loans, and developer loans is where the big pain point lies. So if you're asking between a switch, Canara Bank is obviously a better bet than a Canfin Homes at this point of time. But housing finance is a very secure portfolio. So that is the beauty of it. As Canfin Homes has been able to grow at a very decent pace and been profitable over this growth. They really haven't had too many hiccups. They maybe had one maybe in the last 3 years, if I can remember. But barring which, I think they've had a very relatively clean go ahead. Whereas LIC Housing Finance has also been growing, but in a similar, it's again a PSU kind of a housing finance company. But they've had more hiccups along the way with certain corporates turning default or certain developer loans not working, their margins not being able to maintain over a period of time. They've been having fluctuations. So Canfin has actually done a very good job. So if you want to stay invested, I think you can stay invested from a housing, if you are looking at a pure housing finance. If you are not hell-bent on a housing finance, then you can obviously look at Canara Bank, because I think banking operations are great. And they can scale up quite quickly. So the call eventually has to be what you want to do. But yes, Canfin is a good hold-on opportunity if you have interest in housing finance.
Okay, that's a comprehensive view on Canfin Homes. Thank you for that, Samir. Our next caller, Suresh, is calling in from Hyderabad. Suresh, a very good morning to you. I believe you have a question on NALCO.
Yes, I'm holding around 300 shares on at 163.
Okay.
So I'm in loss. Just I wanted to know whether a short term and long term view for this NALCO. Short term within 1 or 2 months, and long term is more than a year.
Okay, I'll take this up with Vikas. Vikas, what are the charts indicating for something like a NALCO? He's sitting on a loss of around 2,000 odd rupees right now. What's the view like?
You can continue to hold on because it is almost near to its purchase price. No doubt with the broader market correction, today the stock is facing some amount of pressure. But we believe the stock has the potential to move higher near to 180, 180 odd levels over the next 2 to 3 months for the time he's been holding through. There is some amount of good support area near to 148, 149, which should hold on. So we can continue to hold for a target of 180 odd levels.
I'm coming back to you on this next one, which is on Lloyd's Engineering Works, and we've got Viresh from Bengaluru who's asking this. He's bought at levels of 66.83, 1,493 shares, and it's just about where the market price is. So would you hold or sell?
In terms of Lloyd Engineering, nothing substantially moves like from current levels. So we believe we can exit and wait for some more opportunity in the broader market corrective action what has been taking place too. Because the stock has also multiple bound of resistances near to 70, 73 or band. And it has been moved up sharply higher from those 40, 45 base levels. So the risk to reward ratio would not be favorable.
Okay, so that's with regards to where charts are concerned for Lloyd's Engineering. Our next caller, Siddharth, is calling in from Andhra Pradesh. Siddharth, a very good morning to you. How can we help you?
Very good morning, madam.
Go into the query.
Tejas Network, 900. Tejas Network, madam.
Okay.
My query regarding Tejas Network.
Okay.
I'm holding 100 shares, average price 98, madam.
Okay.
Today it will post results. It is nearer to support zone. Should I accumulate more shares right this level?
Okay.
Is it right strategy? My investment horizon 2 to 3 years, sir.
2 to 3 years. Okay. All right.
It's showing good center with the volumes, madam.
Okay.
So, right strategy to accumulate now.
Okay, got your point, Siddharth. I'll take this up quickly with Vikas. Vikas, with respect to the charts, Tejas Networks, is this a good time to add?
Yeah, you can certainly do so, because if you look at the stock has witnessed good rebound from the lower part of the range of those 750, 780 levels with huge amount of volume and price action. No doubt the stock made a recent high of around 960, 980, and from there again the stock has declined. So it's near to the support area of those 50-day averages and of 30% retracement of the entire move. So it's a good entry point to enter. As he has a long-term view of 1.5 year, we believe the stock should have the potential to move higher near to 1,050 to 1,080 levels. So we can invest.
Okay. All right. So it's time now to hit the rapid fire segment. Gentlemen, you know what this means. We'll throw as many questions at you over the course of 2 minutes. And we request you to keep your answers as quick and cogent as possible. The first question is on Yatharth Hospital with a longer term view, and this is for the period of 5 years. 400 is the level that Bikram has bought. Would you hold? What's the view on the fundamentals, Samir?
No view, no coverage.
All right, SBI is the next counter. Tushar from Bhopal is asking whether this is the right time to enter the counter or not. Vikas, your view on the charts?
Yes, certainly can do so. A good entry point after this correction of 4% from the recent high.
Okay. Can Indian hotels be bought at this price? Gul has already bought at levels of 752. Would you add more the current price, Samir?
Yes, you can add.
Okay, Bajaj Finance is the next counter. Siddharth M has bought 3 shares yesterday. What's the view like on the charts, Vikas?
Some weakness to be persist would hit 8,800 to 8,750 over the next few days.
Okay. Sami Hotels, I know we've spoken about another hotel, but would you pick this one? If you bought already at 194, 3,000 shares, would you hold on, buy more? What's the view? Samir?
I think you can hold on to Sami. It's also a good investment and a good company doing well.
Okay, LTI Mindtree is the next counter. Aditya from Pune has bought 50 shares. He wants to know whether he should book loss or keep holding. Vikas on the charts?
The IT sector is being completely oversold and showing some amount of strength in these falling markets. The results have been out, so the price volatility would not be there, so we can hold.
Anant Raj bought at a price of 564. Surya wants to know if you want to hold for 2 to 3 years, would you continue to hold, Samir?
I would say go out and add some as well.
Okay, Maharashtra Bank is the next counter. Darshan wants to know whether he should go ahead and buy it before the results are announced. Samir, your view?
Not the top pick in my banking space, so no, I would not.
Okay, coming back, CESC, we've got Rakhi who's got 50 shares. I do not know the buy price. Would you hold, Samir?
Yes, hold on.
Okay, all right. We're out of time on the rapid fire segment. We've covered quite a few stocks on that round as well as over the course of the show. Gentlemen, thanks so much as always for taking the time.
Thank
Pleasure
you.
having you.
Thank you, Alex. Thank you, man.
All right, that brings us to the end of this edition of Ask Profit. As always, it's been an absolute pleasure from myself and Mahima and the team that put the show together. Thank you so much for watching. Up next, as we've pointed out, is Know Your Company, so do stay tuned.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to the current market price. A premium of nearly 10 to 15% is what the dealers are indicating.
$361 is going to issue these securities to UBS at a deal value of roughly 40,000 crore pre-money and around 42,000 crore post-money.
The second buyback is in Naukri InfoEdge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
In the last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the
Today on KYC, we have a bank which has an ROA of 1.8%, but is available at 0.8 times price to book. That's why it's interesting, and that's why we've taken up Tamil Nadu Mercantile Bank. The stock was up yesterday on the back of numbers, and this is why it's a proposition which we are considering on KYC today. Is this really a proposition that you want to take a bite of? And that's what we'll try to get perspective on. Growth concerns, well, this is where there's been a bit of a challenge, at least over the last few years. Should we continue to be worried is really the question, and we'll quiz management on this, and try and get perspective. And last off is with regard to the general downside risks that banks have. One is with regard to margins. Second is therefore where to expect ROA to come from. If the current ROA is 1.8%, if that ROA were to fall, will it dramatically change things with regard to the bank? And asset quality? How comfortable is the bank with regard to that? So we'll speak about all of that and try and get perspective. But let's first take a look at what the bank has in terms of the past history, as well as what it does in terms of its lending. And I'm going to start off with a little bit of background with regard to the bank. It was founded as Nadar Bank in 1921, opened to the public on November 11th, 1921, renamed Tamil Nadu Mercantile Bank on 27 November 1962. It had 4 branches in 1947 in Tamil Nadu, became an early adopter of technology in 1984, introducing ATMs in 2003. It operates 578 branches currently across India, and has a branch and has an ATM network of around 1157 ATMs. It also has 358 cash recycling machines. So that's just some perspective on the size and the type of bank that we're looking at. In terms of loan portfolio, it's into retail, agri, MSME, and a lot of this is actually corporate. And this is all INR crore. That's how it stacks up. In terms of the size of the book, not too large. It's just about 45,000 crore in terms of book size, around 6,000 crore in terms of market capitalization. So that's broadly how this one stacks up. Let's look at, and let's break this up into percentages if we can. Retail is around 21%, agri is around 42%, MSME is around 31%, and 7% is others, which is largely the corporate book. So retail, agri, MSME, largely focused. 93% of the book is concentrated on retail, agri, and MSME. Let's try and break the NPAs up as well on each of those. Look at the NPA ratios in terms of asset quality on each of those. MSME is 1.54, but really others is where the pain has been, and that's just 7 to 8% of the book now. What are they going to do with the corporate book is the other piece I would want to know when we speak with management, and we'll quiz them on that count as well. But let's look at the metrics that we'll look for, and we'll speak with Mr. Sally S. Nair, who's the MD and the CEO since August of 2024. He's taken charge of Tamil Nadu Mercantile Bank. A few changes as well he's made with regard to processes on the lending side of things and strategy as well, and we'll quiz him with regard to all of that. Let's quickly look at the metrics that we'll be tracking today on Tamil Nadu Mercantile. We look at income statement, balance sheet. We look at operational metrics, asset quality, return ratios, shareholding, street cred, and valuations. We'll try and break Tamil Nadu Mercantile on each of these metrics. Let's start off with the income statement. And mind you, it's a small bank in relative terms, and therefore in terms of size, given that it's small, you would expect that it grows at a faster clip. So let's look at the income statement, see whether they've been doing that. They've been growing net interest income at just about 8% 3-year CAGR, so not impressive. 5% on operating profit and around 13% on profit after tax. The 13% on PAT doesn't look as bad, but compared to the single-digit growth in net interest income, that's a lot of that profit after tax is also coming from the lower provisions number. The provisions number has gone down from around 700 crore in FY22 to just 171 crore in FY25. So it's the lowering of credit costs which has led to that profitability spike. But when you're looking at the overall growth numbers, if you can pull those numbers back up, it's just about single digit with regard to top line, which is net interest income. And that is not very, very, lucrative from a growth perspective, given that the size of the bank is extremely small. So an 8% growth, 3-year CAGR, well, doesn't look impressive at all. We've given this a thumbs down, therefore. Let's look at the balance sheet, though. And in terms of balance sheet metrics, we've seen gross advances go up by around 10% on a year-on-year basis. Deposits is up 6% and CASA is up just about 1% or so. So that's how it stacks up. Again, from a balance sheet growth perspective, not looking extremely lucrative. You want better growth from a bank of this size. We'll quiz them on a couple of these factors. Largely, what we are seeing, therefore, is slow growth with regard to how this bank is playing out. That's where the worry or the concern is. Let's look at key ratios, though. Let's look at yield on loans. We've seen a bit of an inch up versus FY23 in FY25. So we've seen some of those metrics get a little better. Cost of deposits also we've seen an inch up and expected, right? We've seen the repo rate go up all the way to FY25. Now we've started to see a taper. So we'll start to see some of those metrics play out as well. Net interest margins, we've seen a taper down, understandable again. Cost to income ratio is actually between the 42 to 45% mark. So largely in line. When I'm judging Tamil Nadu on the basis of margins as well, it's not a very bad margin number. You've got peers which are doing 3.5%, something like a DCB bank is doing maybe 3.7%, a City Union Bank as well, and then you have certain peers which are doing higher margin. So I wouldn't be too concerned with that margin number of Tamil Nadu, I'd call that a thumbs up for sure. But essentially, it's the ROA number which governs all of these metrics, and it all comes together with that ROA. And look at the ROA, it's been fairly steady in that sense. You look at the ROA for FY23, it's at 1.97%, FY24 is at 1.84%, and FY25 is at 1.88%. So fairly steady ROA. Even within FY25, the last 3 quarters, you can see on your screen, 1.94, 1.89, 1.88. So fairly steady with regard to where the ROA metric is. So clearly a thumbs up with regard to the ratios that it's clocking, both in terms of margins as well as ROA. But what I want to see is growth along with this ROA. If that were to get balanced, things would change quite dramatically with regard to this bank. Let's look at asset quality, because that's the other metric that one would want to look for. One is the operational side of things, one is the asset quality side of things. And you're seeing a steady performance in terms of GNPAs, at least over the last 3 years. Even net NPA ratios fairly steady over the last 3 years. So both of those metrics doing well. We'll give this one a thumbs up as well. Let's look at return ratios now, because when you're looking at a bank, your return ratios of course matter. So from 15% in FY22 and FY23, return ratios have fallen to around 12.5% in FY24 and FY25. I would believe that some part of that would be because there is no growth coming through. If growth were to kick through, you could likely see return on capital also improve substantially with regard to where this bank is. So something to look out for is that growth number for sure. But nonetheless, we'll give this a neutral, given the fact that you're still clocking an early teen kind of return ratio, nearly an early teen. And if growth were to come back, you could see an uptick in terms of return on capital. So which is clearly going to be a positive if it were to play out. Now let's look at shareholding pattern. Now generally in banks, you might have a promoter or two holding maybe 15% or maybe 20%, 25%, depending on how the RBI has enabled that ownership. Or you may have a large set of institutions holding small chunks of the bank. In this, it's neither. There's a public holding which is large, around 94%. Outside of that, it's FIs, DIs dominated. And therefore, we'll give this a thumbs down, because there could be some bit of drag with regard to where the shareholding is. No large ownership owned by any one set of individuals or parties, and therefore something to look out for. Let's look at street cred now. It's a recently listed bank. It's listed at around 525 rupees. That was the IPO price. Thereafter, currently, the stock price is at 450. So not looking too good from a shareholder return perspective from an IPO standpoint. Even now, you've got really muted returns coming through last 3 months, 6 months, etc. But nonetheless, we've not seen this get beaten down in a significant fashion over the last 6 months. Mind you, small and mid caps have really faced pressure, but the stock is up 8% in the last 6 months. So it's a fairly balanced setup in that sense. You're not seeing too many large downsides to this where the stock price performance is concerned, while we're not even seeing very large upsides. So we'll give this a neutral for now, while IPO holders will still be holding the stock, and therefore you might believe that you've not got any returns whatsoever, but also you've not seen too many downsides to what you've seen, and therefore we'll give this a neutral, at least with regard to street cred. Now to the most interesting part with regard to valuations. Let's quickly look at that, and why is it interesting? Because let's first look at the journey of the book value per share. As you can see, from 321, it's gone to 374, which is roughly a 54 rupee EPS. From there, it's gone to 437. From there, it's gone to 500. Now it's sitting at 569, right? That's how the EPS journey has been for Tamil Nadu Mercantile Bank, and how the book value journey has been. The current market price of this stock is 450 rupees. So it's trading at 0.78 times price to book trailing 12 months. What we've done is we've assumed that the same EPS will continue for next year as well, FY26. Mind you, there's no analyst coverage here, so we've had to rely on some bit of judgment and some bit of what management has said over the last few quarters as well. And of course, we'll get management commentary coming through to you as well. So couple of those factors is what we've built into our assumptions. Let's assume the FY26 EPS to be at rupees 75 and no growth in EPS between FY25 and FY26. In that case, your FY26, which is your 1 year forward price to book, is 0.7 times. That's super cheap for a bank with an NPA ratio, if we can pull those ratios up with regard to NPAs and asset quality. If you look at the NPA ratios, they've been fairly controlled. Your gross NPA has been below 1.5% for the last 3 financial years. Your net NPA has been below 0.9% for the last 3 financial years. So for that kind of a setup to be valued at 0.7 times 1 year forward, it looks slightly anomalistic, and therefore we're going to give this a thumbs up because valuations definitely supporting the kind of play that's happening with regard to this bank. You may want to have a look at that as well. But you know what we're going to do? We're going to understand this better. But before that, let's quickly look at our KYC ratings and we'll break it all up. We had a thumbs down with regard to the income statement. Why? No growth. Balance sheet as well, very, very slow growth. Remember, it was just 9.5% 3-year CAGR on the loans and advances that this bank has. The operating metrics were quite positive, 4% plus on margins. Asset quality as well was holding up fairly well, at least over the last 3 years. So we'll give it a +1 or rather a thumbs up with regard to both of those metrics. Return ratios, we'll give it a neutral because from 15% they've come down to 12.5%, can inch up if growth were to come back. We'll also give a thumbs down to shareholding because largely held by public shareholding. Street cred, we're going to give this a neutral, and valuations, we've given it a thumbs up as well, and we've explained that metric and our assumptions within that valuation metric, and we've given this a 4.5 on 8, Tamil Nadu Mercantile Bank. But can some of those metrics change? Can there be a positive bias? And what could the downside risks be? Let's try and understand that a little bit better. We have Sally S. Nair, who's the MD and CEO at Tamil Nadu Mercantile Bank, joining us. You know, Mr. Nair, I'm going to start off with the key concern for me at least. The last 3 years, advances and deposit growth CAGR is just about single digit. Can that change? Can that improve? And what's the likelihood of that?
Yeah, thank you. It's indeed a pleasure to talk to you today. Yes, Tamil Nadu Mercantile Bank's growth has been muted both on the deposit side and the advances side in the last few years. But I think that's a trend that we are trying to arrest. A lot of initiatives have been taken. And if you look at the results of FY25, which I'm sure we will talk in a little more detail, it sort of reflects the kind of initiative that we have taken. On the deposits front, we have doubled what we had in previous year. On the advances front, we've almost doubled. Right? If I look at the numbers, in FY24, the growth in deposits was 3.66%. And in the current year, the year under scrutiny, FY25, it is 8.43, more than doubled. And in advances from 6.35% the previous year to 11%. So we are not still there, but we are almost getting ourselves aligned to the market. And the initiatives that we have taken, like is going to bear fruit. It will take, I think, another couple of quarters for it to bear fruit. We have taken a number of initiatives to sort of kickstart the growth, to move the needle up, to generate the kind of profits that we are looking for, that we are entitled to. I think it will take a couple of more quarters. But you notice the numbers that we have delivered in FY25 itself. is beginning to be aligned to the market. And I expect in FY25, FY26 going forward, it would be fully aligned with the market, perhaps even a tad better than the market. That's my reading of the return from the initiative that we are taking.
Got it. So where will the growth number lie in FY26 therefore?
See, FY26, as I see it, is going to be a year of a bit of a disruption for us, because the number of initiatives that we have taken is resetting the bank into a growth trajectory. Change is never easy. But despite that, I expect the growth in the current year to be somewhere in the 13 to 14% range.
Okay. And where will the growth come from? Where would the loan mix be at? How would there be any major shifts to that?
If you notice the FY25 numbers, I think our RAM, the retail, agri, and the MSME sector is at 93%. I don't know if you go back in history of the bank, we did have a sizable corporate book where we took a serious hit. And thereafter, we changed course and we have been looking at the RAM portfolio, and that's where consciously we have been growing, and that's reflecting in the numbers. In fact, in FY24 we were at 91%. We have moved up to 93% on the RAM. So total portfolio, the RAM share is now 93%. So that shows the kind of focus that we have. It's not that we will not be getting into the corporate sector back, but that will be in a very, very limited way. After, like I said, the initiatives that we have put in place, the risks, the appraisal system, the risk management practices that we are putting in place, after it takes root, we will maybe look at a corporate book in a limited way. But at the moment, the focus would continue on the retail, agri, and the MSME sector. The retail would be a focus, and the MSME would be the other focus. To just mention that we have just started a credit management center. We are sort of centralizing the credit delivery and the credit appraisal systems in the bank. And I think the focus there is going to be the retail and MSME in a large way, and agri in a limited way. Yeah, that will continue to be our focus.
Point taken. Your yields, sir, haven't gone up substantially. When I'm looking at it, FY22 versus FY25, not seeing that very sharp movement that we've seen versus how the repo has gone up, and now of course we are starting to come back down. So where should we expect that yield number to be at, and just explain this phenomena to us?
The yield, if you look at the yield, I think the yield has slightly moderated in FY25, and yield on the advances, and perhaps the cost of deposits may not have moderated to that extent. So one of the reasons why we see a bit of a moderation happening on the net interest margin. Like I said, the kind of portfolio that the TMP was managing earlier, slight ticket size was a challenge. We were on the lower side of it. We are trying to ramp up the ticket size on the MSME particularly. But when you look at the ticket size, moving up the ticket size, and when we are looking at sort of improving the quality of the portfolio per se, and if you look at the GNPA numbers, if you look at the overall stress numbers, you will realize very clearly that we have delivered some of the best numbers in the market. So when we start, ramping up the quality of the portfolio and aligning the prices to the market, we anticipate a bit of an yield sacrifice there, and we are fully prepared for it. And I think, having said that, in FY26, we would still be defending a 3.80 kind of net interest margin. I find the yield on the advances going down marginally, and despite the rate cut, the deposit yield may not move down to that extent. I'm looking at a deposit cost of deposits in the 5.9 to 6% range in the current in FY26, not significantly going down. We'll see how the rate cuts take shape, but we will certainly see that the NIM in the 3.8 to 3.90 range is sort of defended for us.
What gives you that confidence, sir? Because because you will see a downtick with regard to your yields, and you won't see a downtick with regard to cost of deposits. So what's giving you that confidence?
One, of course, is the CASA that I just mentioned about, the initiative that we have put in place, and the kind of strategies that we have sort of initiated in the month of April itself for the year. We are looking at a CASA growth in percentage terms at least 1.5 times of our the term deposit growth. I think that's the kind of call that we have given to our ground force, that to ramp up the CASA. And of course, the ground force is also being put in place to support that. So that should help us, in moderating, in sort of ramping up the low-cost funds, and giving us some kind of a leeway to keep it at 5.9. I'm also mindful that the industry, industry itself is having a bit of a challenge in getting the deposit. So 5.9, I think, is something that we were hoping to sort of steer the bank towards in terms of cost of deposits. But when on the other side, yes, I think there will be a bit of a moderation on the MSME, particularly as we ramp up the portfolio. But we also have a significant jewel loan now. 40% of our asset side continues to be jewel loan. Jewel loan will also continue to grow in tandem with what we are expecting in the MSME and the retail side. There we expect some kind of a I don't think yields there are going to go down as the others we expect. So overall, I think on the other side, on the deposit side, with sort of the CASA supporting us, and the other on the asset side with the jewel loan portfolio somewhat insulating us from rate movements, I think we can get to a 3.8%, 3.8 to 3.9% kind of NIM. And that's our expectation for the current year.
Okay, and on the ROA number, and I'll break this up into two. One is FY26 and then in FY27. So FY26, what should the expectation be like? And thereafter in FY27, as you mentioned that there'll be a bit of a kicker thereafter, what should the ROA expectation be?
ROA is at 1.88. I think fairly good. I'm sure you'll acknowledge that it is good. See, there's this, like I said, significant amount of initiatives have been taken, and part of that is on the IT side. IT is something that we see a significant ramp of capex happening. Like I mentioned earlier, we are putting in the LOS, LMS. We are completely revamping the internet banking, and a whole host of IT initiatives have been taken to modernize the bank. So that is one aspect that is going to take a bit of cannibalize the profit a bit. The other aspect that we are also looking at is how do we reorient our branches towards strengthening the liability franchise. So a bit of an investment is going to happen on the branches side also. We are looking at something like 50 branches to be initiated in the current year, to be opened in the current year. I think that, and that we'll try and see whether we can sort of speed up in the first quarter, first half year itself. I think we'll be looking at how most of this can be opened in the first half year. So some bit of an uptick will happen on the capex side in terms of where we see expenditures happening. But I am confident that we can still control the cost to income ratio to well under 50. So that's where we will be. And the expenditure we are and our own initiatives internally discussed and initiated would see these additional expenditures coming from additional profits. So 10 to 12% of profit is something that we have given ourselves, and we.
Okay, 10 to 12% PAT growth. Anyway, the point taken, sir. Thank you so much, sir, for joining us this afternoon, giving us all of those insights. Wishing you all the very best for a very successful FY26. But out of time on this edition of KYC. I hope this was helpful, and stay tuned to NDTV Profit. More action on the other side.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to the current market price. A premium of nearly 10 to 15% is what the dealers are indicating.
$361 is going to issue these securities to UBS at a deal value of roughly 40,000 crore pre-money and around 42,000 crore post-money.
The second buyback is in Naukri InfoEdge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
In the last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
Markets tumble as tensions escalate between India and Pakistan. Fears of war resonate in the Nifty and Sensex, which are down over 1% each. Defense stocks are the worst hit. The Indian Army hits back at Pakistan. Provocation along the line of control. Homes of Lashkar terrorists destroyed by India as the Pakistani army opens fire at multiple places along the LOC. A meeting is scheduled to be held at 4 p.m. today at the Home Minister's residence to finalize how to withhold Indus River water to Pakistan. Margins of FMCG companies remain under pressure as urban demand remains slow. Nestle India and HUL will lose over 1% each. Oil and gas heavyweight Reliance Industries is expected to post flat operating profit thanks to a slowdown in its oils to chemicals and retail businesses. Auto major Maruti's margins and profits are expected to fall. China is mulling reducing tariffs on some goods from the US to control prices, according to Bloomberg. China is also considering reducing 125% tariffs imposed on the US. Hello and welcome to Markets at 12. This is Malika Mishra. Now, before we talk about markets, yes, they're jittery too. Let's turn our attention for a bit to the pressing developments unfolding on the national front. The terror attack in Pahalgam, which left 26 civilians dead, has ignited a firestorm between India and Pakistan, pushing our already strained relationship to the edge. Attributed to Pakistan-based Lashkar-e-Taiba terrorists, this tragedy has triggered a cascade of diplomatic salvos, border clashes, and an anxious spotlight on Jammu and Kashmir. So what's happening now there, and where is this heading? We have NDTV's Shiv Arur reporting from Ground Zero.
Here at the nerve center of Srinagar, Lal Chowk, there is
a palpable mood of anticipation over what's going to come next. And this is happening across two tracks. One, the larger zoomed out context. What kind of action is the Indian government planning to take? Because any action it takes will have a bearing on Jammu and Kashmir. There is no doubt about that. The other track that is obsessing minds everywhere here, and not everyone is really willing to talk, is about the economy of Jammu and Kashmir. In the aftermath of the Pahalgam massacre, people are wondering what livelihood is going to look like. After the Article 370 abrogation and the huge pickup in tourism and economic indicators here in Jammu and Kashmir, things were on an uptick. There was a buoyancy about life in Jammu and Kashmir. There was a cultural resurgence, and people seemed to be on a comeback trail, if they could even call it that. Here in Lal Chowk, which has always been a barometer of Srinagar and Jammu and Kashmir's mood, that was definitely the case. But now, as the vacationers have fled and as uncertainty fills the air, it remains to be seen which path ahead is actually chosen.
Right, and with that, moving on to how the markets are performing at the moment. Benchmark indices, as I've already mentioned, have shed a substantial amount of weight since morning, with the Nifty slipping below 24,000. As you can see, it's trading around 23,800 at the moment, and the Sensex has dropped by over 1,000 points as well, trading around 78,600 levels. The broader markets excruciating too, with the mid cap 150 and the small cap 250 both axed by over 3%, now around 3.5% down. In fact, the small cap 250 index. The top contributors to the pain in the Nifty 50 basket at the moment are a couple of banking names like Axis Bank, HDFC Bank, ICICI Bank, Bharti Airtel and L&T are contributing to the pressure as well. Axis Bank, in fact, bet its estimates on lower credit costs. If you look at the Nifty 50 heat map, apart from a handful of IT counters, you'd notice that Tech Mahindra, Infosys, like Tech Mahindra, Infosys, TCS, HCL Tech and SBI Life are the only ones in the green. Apart from that, the entire Nifty 50 basket is currently in the red and is shedding a lot of weight. In fact, if you'd see a similar reflection of this in the sectoral heat map as well, where you'd see only the IT index performing, with a lot of others majorly in the red. Media, defense, realty, energy, metal, pharma, PSU Bank are currently the top losers. Let's take a look at the advanced decline ratio as well to get a sense of how the market is currently breathing. And you will see that just about 121 as compared to 2,099 stocks. That's almost the entire market is currently more favored towards the declines, sort of representing a pressured market breadth at the moment. But moving on, viewers, a host of consumption stocks reported their Q4 earnings yesterday, namely Tata Consumer, HUL and Nestle. Overall, a steady show across the list. However, margins remain under pressure. My colleague Mahima, who closely tracks the space, is here with the details.
In terms of overall view for all of these three Nifty 50 earnings, Tata Consumer numbers were pretty much largely in line, HUL numbers largely in line, and Nestle was a slight beat in terms of what the numbers came out to be versus its estimates. Now, in terms of where revenue and PAT growth is concerned, Tata Consumer saw a double-digit growth of 17% in revenue. PAT growth was 59%, but there was a one-off item of exceptional gain of around 120 odd crores. For HUL, this growth was 2.4% in terms of revenue and 3.6% for its PAT. Nestle saw 4.5% growth and a negative PAT of 6.6% growth, but that was still better than what the street was expecting. Street was expecting a negative 8% growth in PAT. So overall, in terms of revenue and PAT growth, Tata Consumer fared out to be better than what HUL and Nestle came out with. In terms of volume growth, well, Tata Consumer saw a volume growth of 6%. This is the first time that Tata Consumer did come out with its number with respect to what its underlying volume growth was. HUL and Nestle both saw a volume growth of around 2%. So here also Tata Consumer was better placed than Nestle and HUL. In terms of common trends being observed, margins definitely still under pressure. Higher tea costs have highly affected margins of HUL as well as Tata Consumer. Gross margins will remain under pressure in first half of FY26 is the commentary that management has commonly said. And in terms of growth, revenue growth was led by pricing for all of these three companies. E-commerce growth has strengthened and faster growth has been seen in lower end products as compared to premium products. So that's a new trend that is coming out in FMCG. In terms of demand, rural recovery is taking place, but it is gradual. Urban still under pressure. In terms of the last metrics, dividend has been declared by all of these three counters. Tata Consumer 8.25 per share, HUL at 24 rupees per share, and Nestle at 10 rupees per share. So this is the overall view as to how so far FMCG earnings have fared out to be.
Right, Mahima. Thank you for giving us a perspective into those very important three major FMCG earnings. Now, we spoke to Abneesh Roy from Nuvama Institutional Equities about how the overall consumption story is currently poised, especially in the backdrop of these earnings. Listen into a slice of that conversation.
People are fairly down and out about this entire basket. We were speaking with Deepan a short while ago saying that those who have generationally inherited these stocks should cash out. How are you looking at the numbers?
Sure, thanks. Good morning. So we don't think things are as bad as some people are saying. One is, of course, from an outlook perspective, things will improve in FY26. Second successive good monsoon. Food inflation has also cooled down and we expect more correction there. Interest rate also 2 cuts have happened. Salary also April will be the first salary where the tax rebates will kick in. So FY26 definitely looking better. From a investor interest perspective, also defensives are coming back in favor gradually because of the overall global uncertainty and global slowdown. Now, coming to this quarter results, as your reporter also highlighted, numbers are in line with expectation and urban slowdown will continue at least for one more quarter. So even in Q1, we don't see a dramatic recovery for the staples companies. Currently, our topics in the broader consumption space will be essentially the liquor stocks, United Breweries, United Spirits. We also like Pidilite and Marico. So these will be our topics. FMCG staples, as you rightly said, currently because of the urban slowdown and because of the raw materials inflation, which is currently still there. Palm oil is still 20-25% up. It has corrected from the peak. Tea is up again 25%, and a lot of the copra, etc., are still up. So Q4 and Q1 margin pressure, urban slowdown will still continue. From Q2 is where the recovery should start for staples. Till then, we'll be more positive on the liquor companies, Pidilite and Marico.
So Q2, there are other people that are talking about H2 FY26. So point well made, Abneesh. Hi, Alex here. One of the points that Mahima was talking about after looking at the numbers that she reviewed yesterday is that down trading is evident for these companies. Is that a trend that is likely to continue, and what are the implications therefore for the margin picture? And I know that you're saying that staples will improve second quarter onwards, but then are we likely to see subdued margins? I think that's why HUL took a hit as well.
So yes, HUL yesterday post results, in fact, stock was up. But when the outlook statement on margins was seen, then investors did get worried. And that's why there is a cut in terms of the EPS for FY26 by most of the street. Because company earlier outlook was 23 to 24% EBITDA margin and now 22 to 23. Now, where is this 100 bips going by Unilever? I think they are clearly investing in 2-3 spaces. One is they want to make 3 more challenging brands, Lifebuoy, Glow and Lovely and Horlicks. They want these growth to come back. Second is they have noticed the improving macro food inflation and second successive good monsoon. They want to invest now because you have to do it before the macro really turns. If you delay that, then other competition will catch up. We also see the global CEO of Unilever driving some of this because he is very positive on India and he is more aggressive than the earlier CEO. So we see that also possibly could be one of the reasons. Coming to other companies, as I said, Tata Consumer, next tea crop is very important. We'll get clarity in the next 3 months. So Q1 margins will remain under pressure. For Nestle, if you see, wheat crop is looking better. So Nestle and Britannia, my sense is wheat crop is very very important, and that is looking better than last time and better than initial expectation. So I will say every company you have to take one by one, but Q2 is where I think clearly we'll see the demand situation start improving because that comes into the base, and as I said, some of the tax rebates will kick in, food inflation. But from a competitive intensity, I think clearly the legacy companies will acquire a lot of the D2C companies. So we'll see that trend continue.
So overall, the second half of the year might turn out to be better for FMCG in the consumption space. Moving on, viewers, Reliance Industries may most likely report a flat operating profit sequentially in the March quarter due to weak earnings in its dominant oils to chemicals business. It is also expected to display a muted growth in its retail business. Let's bring in my colleague Somit to give us a better idea of what the street is expecting out of these results.
Well, yes, Reliance Industries' fourth quarter on a consolidated basis is expected to be quite muted, though revenues of the company would be higher by around 26% as per the estimates. But EBITDA is expected to be down by nearly 1%, and this will result into very sharp drop in the EBITDA margins. It could come in at close to 14.3% as against 18.2% reported by the company in the previous quarter. Net profit is expected to be flat at close to 18,500 crore rupees. Now, segment-wise performance, if you look at, it's the O2C business which will be the main drag on the financials, and that will be largely on the back of lower gross refining margins and weak petrochemical margins. O2C segments EBITDA is expected to be 3% lower on a sequential basis. EBITDA of retail is expected to drop by nearly 9%, but that is largely on account of the fact that Q3 is a seasonally strong quarter because of the festive season, and hence we are seeing this drop. When it comes to the oil and gas exploration business, that is expected to be around 5% on a sequential basis, and this is largely on account of lower gas volumes in the fourth quarter as against the third quarter of FY25. The only segment that is expected to report a growth is the telecom business. Now, if you look at Reliance Jio, which is the telecom arm, revenue, EBITDA and net profit is expected to be higher by anywhere between 1.5 to 2%. The ARPU is expected to be 1% higher. Subscriber number is expected to come in at 48.76 crore, and entire growth for the telecom business will be led by ARPU and on the back of the tariff hike and because of the subscriber addition that the company has done. However, do remember that the ARPU growth is slowing down, and this is the slowest growth that will be seen in the last 3 quarters. Now, a company had taken a tariff hike 3 quarters back, and that's the reason we are seeing this kind of a growth on the ARPU and the tariff front. Now, the key things to watch out from the Reliance Industries earnings would be margin outlook in refinery and petrochemical business, their outlook for the new energy business, what is the commentary that comes in on ARPU post tariff hike, Jio Fibers growth, and any commentary on capital expenditure outlay and how they plan to reduce their debt now going forward would be important to track from Reliance Industries earnings.
Right, Samit, thanks for that. And speaking of more expectations from other counters, Maruti Suzuki India is set to announce its Q4 results today as well. What can we expect from the auto giant? Well, I have my colleague Puneet joining us for more. Puneet, how does the expected picture look like?
Well, thank you for that. So Maruti definitely is one of the biggest earnings and the first one in the auto pack to come out with earnings today. Largely, revenue is expected to rise by roughly 12% to come in at 40,900 crores in this particular quarter, and margins are expected to rise by 5%, but the overall margin is expected to fall in this particular quarter, and that's largely because of commodity prices as well as larger investments that the company has done over the last 90 days. In this particular quarter as well, we saw some discounting as well in March, which is generally a month where discounting is very limited. So might see some impact of all these factors, and we're expecting the overall margins to fall by 80 basis points to come in at 12% versus 12.8% the same time last year. Now, in profit as well is expected to be largely flat to a negative bias, coming in at 3,856 crores. And if you look at the quarter gone by, the company's main highlights was that while there was some volume growth seen in this particular quarter, we are seeing that higher realizations should support revenue growth, but because of these incentives that the company gave in terms of sales, that's affecting the margins as well as net profit. Depreciation also might be on the rise in this particular quarter because of new plants and costs which have been coming, so watch out for that as well. In terms of sales, the company sold 6.04 lakh units in this particular quarter compared to 4.84 lakh units. The share of SUVs has gone up, but the smaller car share has fallen. So, and that's the reason why there's a discounting impact coming in as well. Finally, in terms of price hikes as well, the company's actually announced 3 price hikes between January as well as April the January price hike of 4% as well as the February price hike between 1,500 to 32,000 rupees per model has been something which is not something that the company usually does. So it's a January price hike is quite common, but the two other price hikes has shown that the commodity cost has been impacting as well. We will be looking out for some commentary into demand for FY26. So overall, while we're expecting growth in terms of revenue, I think margins will be something to watch out for in this particular quarter for Maruti Suzuki.
That definitely sets the picture right for us. Now, Tech Mahindra also came up with its Q4 results yesterday, posting numbers that were largely in line with estimates. Now, brokerages have a mixed view of Tech Mahindra. Kotak and Investec have maintained a buy rating, whereas Citi and Macquarie remain a bit bearish on the counter. Puneet, what do you gather from all of this on Tech Mahindra?
Well, Tech Mahindra, very interesting results to say the least, because while the numbers were largely in line with estimates, we actually saw the stock tank in trade at the start of roughly about 4%, and we'd given it a thumbs up. We've seen a recovery in the stock prices as well, and that's largely on, a multitude of factors in the results as well as positive brokerage notes that have come in now. So when you look at, the top three segments for the company largely reported a flat to low single-digit growth of banking as well as, TMT. So hence, it was a good quarter for the company. We've seen revenue largely being flat at 0.7% growth, while, the margins have come in at 10.5%. compared to 10.2% the same time last year, with estimates being around the similar range as well. Net profit was also up 18% this particular quarter, largely baked into estimates because of a higher other income portion, coming in at 1,167 crores. Now, company had deal wins of $798 million in this particular quarter, taking the total of $2.7 billion for the year of FY25. And very interestingly, it's higher than analyst estimates as well of 750 million. Finally, when you look at brokerages, as you rightly mentioned, we've seen something like Kotak being very positive. Target price was 1,650 rupees per share for Kotak. And there are three key points that the brokerage is making. First one, deal wins provide a much needed portfolio boost to margins over the next 8 quarters of the company's vision of FY27. They've also mentioned that the company, they believe that Tech Mahindra is on its way to maintain and achieve the 15% EBIT margin target for FY27. Currently, they are between 10 to 11%. So it's a steep jump expected in the next 8 quarters. But Kotak is very positive on the brokerage as well as the company as a whole. Investec as well. Target price 1,672 versus 1,510 earlier. And they've also maintained a positive view, saying that the deal wins have grown 42% in this year compared to FY24, and this is the highest amongst peers. While they've also mentioned ROC has improved to 22 from 14%, they believe that Tech Mahindra is the only tier 1 company who could potentially deliver the highest growth in this decade compared to the previous one. And just a couple of lines on the two brokerages such as Citi as well as Macquarie, largely maintaining that the EBIT margin could be something that's a very steep target for the company, and they feel that there could be some EPS cuts going forward. But overall, it's a positive result for the company, and a few brokerages maintaining the stance that they could achieve the target of 15% EBIT margins in FY27.
Right, Puneet. Thank you so much for those updates. And staying on quarterly earnings, viewers, Axis Bank also reported its Q4 earnings and their profit bet estimates, but loan growth disappointed. Let's go across to Harsh for more on the results.
When you're looking at the overall set, it looks like a decent set that's coming from Axis. Margin expansion of 4 basis points, that's a bit of a surprise. Didn't expect that coming from Axis. The NII number was a slight miss, but that's largely driven because loan growth came in lower and not because margins were compromised. So margins actually have gotten better, which is the positive surprise. But where your NII number is concerned, it's a slightly softer number, but that's largely led by loan growth. Loan growth was extremely soft. Something to keep in mind, again, just 8% up YOY, the loan growth. And missing estimates, maybe by around 1.5% at the very least. So maybe that's something to keep in mind. The other piece is with regard to OPEX. OPEX was elevated, operating profit largely in line. You saw provisions number largely lower, in fact sharply lower when you're looking at it sequentially as well. Credit costs were down around 30 basis points, came in at just 0.5%, and profit after tax therefore got a lift. Your ROA hit 1.8%, your ROE hit 17%. Both of those metrics extremely strong, given the fact that that's the aspirational ROA, ROE of Axis, and they haven't been able to do that, and therefore clearly a positive. But disappointing in a big fashion with regard to growth. Just 8% on loans, just 10% on deposits, not looking good from that perspective. 7% QOQ deposit growth looking very impressive. So on the QOQ number, it's very solid. But on the YOY number, loans, overall disappointment, deposits also disappointing.
Right, Harsh. Thanks for that update on Axis Bank. And there are some other companies that have been buzzing today in the stock market as well. Aavas Financials, IEX and Tanla Platform in fact came up with their quarterly results, and my colleague Varsha in fact is standing by to explain how the results of these three companies have been so far.
Yeah, thank you for that. Let me start with Aavas Finances, wherein NII growth was up 10% quarter on quarter. Best margins for FY25 clocked in. A protected ROA in FY25 versus 24. Despite margin decline, asset quality was solid. What didn't work for the company? Well, the growth, there was a dip in the growth and at 18%, slowest in 8 financial years. Next on my list is Indian Energy Exchange, wherein net profit did meet estimates, achieved highest ever quarterly traded electricity volume of 31.7, which is up 18% year on year. 68 lakh RECs were traded during the quarter, which more than doubled, highest ever RECs traded in quarter. Last on my list is Tanla Platforms, wherein revenue growth that you are seeing, that is up to 2.4%, was led by OTT, and the OTT contribution to the overall revenue, if you see, was at 29%.
Thank you so much for that. And Kashmir, a region known for its breathtaking landscapes and cultural charm, has long been a symbol of resilience and beauty, as 2025 ushered in record-breaking tourism numbers. Optimism for the valley's recovery blossomed after years of challenges. However, the devastating terror attack has shaken the foundation of Kashmir's tourism sector. Let's take a look at this report that delves into the profound impact on the region's economy and the livelihoods that depend on it, and the immediate repercussions on bookings, cancellations, and traveler sentiment.
An endless lineup of empty houseboats, no customers, no tourists, because they've all completely left Srinagar. They've left Kashmir, and who can really blame them?
This is Dal Lake, Kashmir's crown jewel, vibrant and bustling just days ago. Now, a haunting stillness blankets these same waters in the aftermath of the brutal terror attack that claimed 26 innocent lives. 2025 began with tremendous promise for the valley. Nearly 8 lakh visitors flocked to Srinagar's iconic Tulip Garden in just 26 days following its late March opening. But this resurgence, a hard-won victory after years of struggle, now faces a devastating setback. The gruesome terror attack has struck at the heart of the state's tourism sector, which had only recently celebrated a historic milestone with 2.35 crore visitors in 2024.
टूरिज्म सबसे पहले हिट होता है और कैंसिलेशन आ रही हैं, जो कल तक 15 से 20% थी, आज 40% के करीब से ऊपर चली गई हैं और नई बुकिंग कोई अभी आ नहीं रही है.
Tourism isn't merely an industry here. It's the economic lifeblood of Jammu and Kashmir. Pahalgam, the site of this tragedy, stands as one of the region's premier destinations and serves as a crucial gateway for the sacred Amarnath Yatra pilgrimage scheduled for July.
चीज़ें रिवाइवल इसका हो जाएगा जल्दी एंड आई एक्सपेक्ट कि अगले 15-20 दिनों में थिंग्स शुड स्टेबलाइज.
The immediate economic impact has been swift and severe. Cleartrip reports a 40% plunge in future Kashmir bookings. Flight cancellations have multiplied 7-fold. Cancellation requests surged by 25% in the first 24 hours after the attack. Safer Himalayan retreats in Himachal Pradesh and Uttarakhand are seeing increased interest as travelers redirect their plans. The attack on Pahalgam represents more than a tragedy for the victims and their families. It's an assault on Kashmir's economic recovery and the livelihoods of thousands who depend on tourism. While government officials and industry leaders express cautious optimism about resilience, the valley now faces a critical test. Can the hard-won peace and prosperity of recent years withstand this latest challenge? As summer approaches, traditionally Kashmir's peak tourist season, the answer will determine not just vacation plans, but the economic future of a region fighting to move beyond its troubled past.
With that, that's all the time we have on the show, but do stay tuned to NDTV Profit for more news and updates.
That's huge. That is a biggie. It's out of it.
गोल्ड प्लस क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर.
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to the current market price. A premium of nearly 10 to 15% is what the dealers are indicating.
$361 is going to issue these securities to UBS at a deal value of roughly 40,000 crore pre-money and around 42,000 crore post-money.
The second buy pick is a Naukri InfoEdge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
The last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Jaggi brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To India specifically, I really think India has a fascinating opportunity, because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
Hello and welcome to NDTV Profit. You're watching Profit Buzzers. A very good afternoon to all the viewers. I'm Hiral Datia and with me is Mika Barve. Firstly, a very happy birthday to Mika.
Thank you so much.
On a Friday. So it is going to be a party weekend for all, at least with regards to where Mika's birthday goes. But what's happening in the Indian markets and what's happening in the country, the Indo-Pak tensions is something which is impacting the domestic markets as well so far. The sentiment and the morale is something which has been impacted so far, and that's why you're seeing this kind of a sell-off in the stock markets as well. If you see in terms of Nifty 50, a very mild recovery from the day's lows, but the pressure continues. We're seeing cuts of almost around 1.3% in trade that is coming in. Let's quickly pull up Bank Nifty, and after that, I beg your pardon, if we can have the sectoral heat map as well to understand what's happening with regards to the sectors as well. There you go, 1.4% is the kind of cuts that you're seeing in terms of Bank Nifty as well. You just have Nifty IT, which is trading in the positive, but apart from that, it is a sea of red. IT as well, seeing marginal gains of around 0.6%. What's losing? Media, the top loser today, followed by defense. It's very interesting to see how defense as a space during these times of tensions is drooling under pressure, because usually the trends that we've seen is any war-like situation that comes up across countries, across the world, it's the defense pack which is always on an upstill. But this is the time where it has been trading under pressure. Let's quickly look at the Nifty 50 heat map to understand the trend in terms of individual stocks, what's happening in the large cap space. There you go. It's just SBI Life is an interesting one on the back of earnings, the top gainer in today's day of trade. Apart from that, Infosys, TCS, these are two other stocks which are also seeing some smart moves. Axis Bank on the back of earnings is trading under pressure, the top loser in trade today. Mika, so that's with regards to where, you know, the benchmarks go. The pressure has continued. Broader markets, last couple of trading sessions, we are seeing a stock-specific action.
Yeah.
I mean, but clearly you are seeing the pressure there as well.
Yeah, and the picture is very much leaning to the bear side on the broader markets as well for this Nifty small cap as well as the mid cap indices. We've seen some recovery. Intraday lows were over 3%. Right now, the indices are trading cuts of 2.3 to 2.6%. But if you just pull up the Nifty small cap 250, which is down 2.7% right now, 229 stocks on the counter are currently trading in the red, while only 14 are advancing. Something that's seen as the top loser in the Nifty small cap 250 is Ajay Balaji. The stock is down almost 8%. This is followed by Motilal Oswal seeing cuts of almost 7% right now. And then you have a defense player, Garden Reach, down about 6.5%. You also have some weakness in counters like Keynes Technologies, Blue Star, MMTC, all seeing cuts of over 5%. On the positive side, something that you are seeing positive movement is a Sterlite Technology. It's up 5%. But this is after the stock fell almost 25% yesterday after a spin-off of one of its arms. Navin Fluorine up 2.5%, Novama, IEX on the back of results. But even the strength in these counters has weakened. IEX was up 4% at the start of trade. Now it's trading just 1.5% above here.
I mean, a lot of stock-specific action, but it's mainly the Indo-Pak escalation. And the fears around it is what is gripping the Lal Street, and that's what is keeping the markets under pressure. A lot of selling that's coming in as well. People are not really looking at building long positions as well, taking into consideration it's the weekend and what could transpire out of the geopolitical crisis right now. But let's address the big story this afternoon, the Pahalgam terror attack, which has left 26 civilians dead, has actually ignited a firestorm between India and Pakistan, pushing their already strained relationship to the edge. Indian Army has retaliated to the firing initiated by the Pakistan Army on the line of control. In fact, firing from multiple Pakistani posts across the LOC was reported.
Two houses of two Lashkar-e-Taiba terrorists linked to the attack were destroyed overnight, attributed to the Pakistani-based Lashkar-e-Taiba terrorists. This tragedy has triggered a cascade of diplomatic salvos, border clashes, and an anxious spotlight on Jammu and Kashmir. Eyewitnesses said that the heavily armed terrorists emerged from the pine forest and opened fire at unarmed tourists.
In fact, the Indian Army Chief General Upendra Dwivedi has reached Srinagar also to take stock of the security situation in Pahalgam. He will hold a meeting with top commanders in Srinagar and is also likely to visit the Baisaran Valley. So what's happening now there and where is this heading? We have NDTV's Shivaru reporting from Ground Zero. Over to you.
Here at the nerve center of Srinagar, Lal Chowk, there is a palpable mood of anticipation over what's going to come next. And this is happening across two tracks. One, the larger zoomed out context. What kind of action is the Indian government planning to take? Because any action it takes will have a bearing on Jammu and Kashmir. There is no doubt about that. The other track that is obsessing minds everywhere here, and not everyone is really willing to talk, is about the economy of Jammu and Kashmir. In the aftermath of the Pahalgam massacre, people are wondering what livelihood is going to look like. After the Article 370 abrogation and the huge pickup in tourism and economic indicators here in Jammu and Kashmir, things were on an uptick. There was a buoyancy about life in Jammu and Kashmir. There was a cultural resurgence, and people seemed to be on a comeback trail, if they could even call it that. Here in Lal Chowk, which has always been a barometer of Srinagar and Jammu and Kashmir's mood, that was definitely the case. But now, as the vacationers have fled and as uncertainty fills the air, it remains to be seen which path ahead is actually chosen.
Thank you, Shiv, so much for getting us all the ground report as well. And that is what NDTV will be continuing throughout the day as well. But let's also welcome in our guest, Pramit Pal Chaudhary at Head South Asia Eurasia Group. Pramit, you have been covering the geopolitical scenario specifically with regards to India-Pakistan as well since quite some time. What is this actually telling you with what's happened and the kind of steps that the Indian government has taken so far? Because when we're relating that to what's happening in the Indian markets, it seems there is fear that is gripping investors as well.
Well, I think investors are right to look. They probably look back at what happened when we did the Balakot strike in 2019 after the Pulwama attack, and you saw there was almost a 2 weeks of buildup in India, was carried out diplomatic action, some economic activity, but more important, primed the international system as to what was going to happen, that there would be some sort of a reaction, but explained India's case. And then, of course, put together the military option that was eventually carried out with the airstrikes against the attack in Balakot. So there's an assumption that a very similar path is now being practiced. You've seen India announce the obvious easier diplomatic and economic actions, including suspending the Indus River Treaty. We're also seeing, of course, diplomatic action where Modi has been talking to world leaders and ambassadors from various G20 countries are being briefed. So you see that similar kind of path. And Modi, and notice Prime Minister Modi, when he was speaking in Bihar, switches to English and says that he promises significant and stringent action against the terrorists in a manner that they would not expect. So it seems a very similar glide path, a steady escalation towards some sort of violent retaliation, military or otherwise, by India, and possibly within, again, over the next 2 weeks. Although I'd say the window probably maybe opening by the end of next week. So understandably, this is a degree of uncertainty. Can you control the escalation, I think, is one. It's less about the idea of a military retaliation than the question of escalation. I think that's a crucial element in this. Last time, as you remember, Pakistan responded to the symbolic bomb attack in India on some empty ground. There was a dogfight between a couple of fighter aircraft, and then it was basically over. We assume a similar kind of game right now, but until it actually happens, These are, after all, two nuclearized nations. It will be difficult for anybody in the market to assume that this is going to happen.
Pramit, Mihika joining this side, the tensions remain high. You've seen certain economic as well as diplomatic steps taken by India and retaliation from Pakistan. But what would be the logical next steps from an Indian perspective?
I think the next step would be diplomatic preparation. I mean, the real accomplishment, I would argue, in the Balakot strike was not whether or not they actually hit targets on the ground. Normally, after terrorist attack, terrorists vacate their camps because they expect a retaliation. And in any case, an organization like Lashkar-e-Taiba, no matter how many hundreds you kill, can recruit a similar number virtually overnight. Pakistan has over a 45% unemployment among young men. What really was interesting was Pakistan's complete diplomatic isolation. The four countries that I would argue have traditionally been their supporters, Saudi Arabia, the United Arab Emirates, the United States, and China, historically the ones that have been most friendly with Pakistan. Three of them basically said, we support India. India has perfect right to retaliate for a terrorist strike. And China, the fourth one, and the strongest and really the only remaining ally of Pakistan today, basically said, we're neutral. The two of you work it out yourself, but we have no position to take on this. So for Pakistan, I think it was a bit of a shock. I met Pakistani diplomats who said we were surprised because there was simply no support for us anywhere in the world. And remember, unusually in that attack, India did not hit POK, Pakistan Occupied Kashmir, because we always had this little loophole where we would say, we're not striking Pakistani territory, we're attacking occupied Indian territory, which therefore is not a violation of international law. In Balakot, we struck Khyber Pakhtunkhwa. The Balakot is not in Kashmir, it is in Khyber Pakhtunkhwa, in territory that is undeniably Pakistani as far as India is concerned, and we don't make any claims to it. So in effect, you hit Pakistani territory. Pakistan rightly went and complained to everybody, hello, this is an act of war. And everybody says, we don't care. So for us, making sure that a similar situation happens, I think is crucial at this point. And then weighing what are the options. I would argue we not only have a military air option, to this day, and we are much better armed than we were in 2019. The Rafales are now in play, which they were not in 2019. They actually just began arriving from their factories at that point. We have much better standoff missile capacity, means long over the horizon ability to hit targets, much better targeting technology. But we also have developed, to some degree, it seems, some covert capacities. If you've looked over the past 3 or 4 years, India there have been at least roughly 20 assassinations of Pakistani terrorists, especially those associated with the IC-814 hijackers, hijack in Pakistan by unknown groups, which the Pakistani military has accused India of accomplishing. And that seems very likely, which indicates that we have developed something which we did not have before, which is covert action capacity inside Pakistan, which potentially could also be brought to bear on this.
Right. So, Pramit, do you think something like this could lead to a full-fledged war? And if so, what would it mean for India? Because, you're talking about the Indus Water Treaty. That is something where the meeting will be held today at 4 p.m. as well. And if that is taken into consideration, I mean, how do you expect Pakistan to then, come out with it? I mean, it's a very chicken and egg situation right now.
See, the Indus Water thing, I think, is more symbolic right now. There is a little bit, India may control the headwaters of a number of these rivers. In fact, most of them originate inside Indian territory, some as go far as Ladakh. The problem is that the terrain of Kashmir has been so difficult to work with that building dams, the necessary dams, tunnels for the water diversion and so on, is more or less has proved to be almost impossible. We have some sluice gates, in some of the tributaries of some of the rivers, and we could potentially cut that off a little. But what would happen, that would have the potential for disrupting hydroelectric capacity in some of Pakistan's generators, but not enough to affect agriculture. And in fact, I think they've already harvested their wheat, so there isn't much capacity. In other words, if you were to dam those rivers, you would flood India. You would not flood, you may deny river water to Pakistan, but you would flood India because there's no reservoir capacity there on our side, and it's very difficult to develop here. So that's a symbolic action, but it does open the door for us to do things later in the future. But I think that's more about rattling the cage and reminding Pakistan that they are wildly dependent, in fact, wholly dependent on water, both for power and agriculture, and for their cities from water that comes from India. But I think the real issue will be, and economically we don't do much, we do virtually nothing with each other anyway. So that's why I think eventually some sort of kinetic action would have to be considered. Diplomatic isolation, of course, is already there, and I think that will continue. I think the timing of the attack was remarkably bad from Pakistan's point. Not only was US Vice President J.D. Vance in town, and his officials were very strong in their condemnation of the attack while they were on Indian soil. I was in the room with some of them when it happened. Second, there was very strong, Modi was meeting MBS, the king of Saudi Arabia, the crown prince of Saudi Arabia, at the time the attack happened, and had to cut short his trip. I don't see the Saudis being particularly pleased about that. And then finally, it's a time when China is trying to do a rapprochement with India for its own reasons. Again, something to not push by.
Pramit, I will interrupt over here. So clearly, the timing, as you're saying, is incorrect. The Indus Valley Treaty does give us some power in terms of retaliatory measures. And if you have to look at the Pakistan Army Chief's speech, categorically he's saying that our stance is absolutely clear, where Kashmir was our jugular vein. It will continue to remain our jugular vein, and we will not forget it. And you will not leave our Kashmir brothers in their heroic struggle. A lot of commentary that's coming from there as well, and the clear picture is the speech a trigger for the terrorists as well? Because if that is going to be the situation, and if we are also going to retaliate to protect, where does this lead, number one? And two, the kind of financial losses that you're seeing, not only from a Kashmir Valley perspective, but overall from investments as well in the Indian markets. During Balakot, Pulwama, yes, you did see markets go down and recover in the span of 2 days. Do you think that's going to be the scenario here? Or because right now equity markets are seeing a sell-off?
Well, equity markets will tend to respond to almost any degree of uncertainty, but the sell-off is not strikingly very high. And there are other elements globally of uncertainty right now. So I'm not overly surprised or concerned about that. The likelihood of a full-scale war is very, very minimal because, one, we're nuclear, both of us. And second, it's only India that could precipitate that attack. India's defense budget, even though India has actually reduced defense spending over the past 10 years as a percentage of GDP, in absolute terms, it continues to rise and is now something on the lines of 10 times that of Pakistan's. Pakistan's economy, as you will know, it's just undergone the worst financial crisis in its history. It has virtually no foreign exchange, about $6 or $7 billion, and it has had to actually sell ammunition to, let's say, Ukraine to raise funds for its own military. It has no capacity to wage a war right now. So therefore, I don't expect that to be the path. And India still has, if you wish, other goals, both economic and fiscal, which are in many ways more important in the long run than fighting Pakistan. So I think the real issue, therefore, long-term war doesn't make any sense for either side. So I think the real story, therefore, is what do you do over the next 2 weeks to teach a lesson to Pakistan, inflict a degree of cost on Pakistan that keeps that in mind. I mean, the Balakot attack in 2019 gave us basically almost 5 years of peace with Pakistan on the terrorist front. But you're right. General Munir's statement. General Munir is a very hardline Islamicist. He is a Hafiz al-Quran, which means a man who has memorized the Quran and tends to see the Quran as the answer to almost everything. And there are presumably many benefits in the Quran, but it's not a good document for modern strategic thinking. So he very clearly has that point. And Pakistan has been very unhappy that the abrogation of Article 370, the move to make Kashmir a normal state in the Union has been basically, worked excellently, and after the last elections in Kashmir has been legitimized by the Kashmiri people itself. But they have simply lost almost all influence in what happens in Kashmir. And nobody in the rest of the world cares.
Yeah, got it.
So they need to do something to show we are still a player in that, but it's going to extract a high price for them, I think.
Thank you so much, Pramit, for joining us and giving us a perspective on what's going on and what could happen next. And thank you for joining us.
Thank you.
Yeah. Well, in an update to arguably one of the toughest diplomatic actions taken by India, an important meeting will take place later today at the residence of the Home Minister Amit Shah on the Indus Water Treaty issue. Several union ministers are expected to be present in this meeting. Let's get in NDTV's Aishwarya Jain, who's tracking this closely, to tell us more.
Well, and many senior experts are stating that this will break the backbone of Pakistan, specifically in the regions of Punjab and Sindh of the Pakistan, that there would be the water crisis and the food crisis as well. The CCS decision under the chairmanship of Prime Minister Narendra Modi that Indus Water Treaty should be suspended from the immediate effect had now come down to implementations, and therefore the reason yesterday it was the Water Resource Minister C.R. Patil who conducted a meeting with the MHA and the MEA officials at the ministry and had prepared a blueprint. It is today, later in a day, when it would be Home Minister Amit Shah, External Affairs Minister S. Jaishankar and Water Resource Minister Mr. C.R. Patil, along with the officials of the Jal Shakti Ministry, will be sitting and will be preparing the blueprint and also the technical aspect of it, as to many experts suggested that the provisions of Indus Water Treaty, that's the western rivers that flows towards Pakistan, the water needs to be stopped. And to stop that water, India needs to again function. Those canals that had been constructed, the reservoirs, the dams height should be increased, and all of that needs a time, which is certainly difficult, but it is not impossible as being stated by many senior experts, and this will happen in a definite period of time, is the task behind the government of India, and therefore the reason to come down to the nitty-gritties, the technicalities of it. An important meeting is to be held today evening at Home Minister Amit Shah's residence. All eyes will be on that particular meeting.
Thank you so much for getting us the details. So this is an interesting update, and it's absolute, a diplomatic war that being unleashed so far. But let's quickly slip into a short break. Lots more lined up on the other side. Please stay tuned to NDTV Profit.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to the current market price. A premium of nearly 10 to 15% is what the dealers are indicating.
$361 is going to issue these securities to UBS at a deal value of roughly 40,000 crore pre-money and around 42,000 crore post-money.
second buy pick is in Naukri InfoEdge. It's a bit of a conditional buy that we're seeing. So if it's able to cross a 67.70, 67.80 odd range for the day, it can give you a good range breakout. And the targets would be towards 6,900 to 7,000 levels.
In the last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Jaggi brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of everyone's list, I would think.
Do you really know the company you invest in? What is the real picture behind presentations and claims? Is the outlook as rosy as the company claims? Know Your Company, powered by NDTV Profit Research, shines a light on the biggest stock market movers.
Markets near day's low. Nifty breaches the 24,000 mark. Sensex down 800 points. Axis Bank and Shriram Finance down almost 4% each, dragging Nifty.
The Indian Army hits back at Pakistani provocation along the line of control. Homes of Lakshar terrorists destroyed by India as the Pakistani Army opens fire at multiple places along the LOC. A meeting is scheduled to be held at 4 p.m. today at the Home Minister's residence to finalize how to withhold Indus River water to Pakistan.
And Laurus Labs stumbles more than 4% in trade despite posting a stellar fourth quarter. The net profit triples, beats estimates, margins above 20% for the second quarter.
Axis Bank down 5% post Q4 results. The net profit beats estimate, but loan growth comes in below expectations.
And oil and gas heavyweight Reliance Industries is expected to post flat operating profit thanks to a slowdown in its oil and chemicals and retail business. Auto major Maruti's margins and profits expected to fall.
Forex heat on Genzol. ED issues lookout circular against the promoters. Summons Anmol Jaggi in foreign exchange violation case.
Welcome back. You're watching Profit Buzzers on NDTV Profit. Now, Reliance Industries may most likely report a flat operating profit sequentially, and this is with regards to the fourth quarter, mainly on the back of weak set of earnings in its dominant oils to chemicals business. It is also expected to display a muted growth in its retail business. The stock is currently pretty much flat. I mean, it's cooled off from the day's highest levels as well. Let's bring in Somit to give us a better idea on the expectations. Somit, over to you.
Well, yes, Reliance Industries' fourth quarter on a consolidated basis is expected to be quite muted, though revenues of the company would be higher by around 26% as per the estimates. But EBITDA is expected to be down by nearly 1%, and this will result into very sharp drop in the EBITDA margins. It could come in at close to 14.3% as against 18.2% reported by the company in the previous quarter. Net profit is expected to be flat at close to 18,500 crore rupees. Now, segment-wise performance, if you look at, it's the O2C business which will be the main drag on the financials, and that will be largely on the back of lower gross refining margins and weak petrochemical margins. O2C segments EBITDA is expected to be 3% lower on a sequential basis. EBITDA of retail is expected to drop by nearly 9%, but that is largely on account of the fact that Q3 is a seasonally strong quarter because of the festive season, and hence we are seeing this drop. When it comes to the oil and gas exploration business, that is expected to be around 5% on a sequential basis, and this is largely on account of lower gas volumes in the fourth quarter as against the third quarter of FY25. The only segment that is expected to report a growth is the telecom business. Now, if you look at Reliance Jio, which is the telecom arm, revenue, EBITDA and net profit is expected to be higher by anywhere between 1.5 to 2%. The ARPU is expected to be 1% higher. Subscriber number is expected to come in at 48.76 crore, and entire growth for the telecom business will be led by ARPU and on the back of the tariff hike and because of the subscriber addition that the company has done. However, do remember that the ARPU growth is slowing down, and this is the slowest growth that will be seen in the last 3 quarters. Now, a company had taken a tariff hike 3 quarters back, and that's the reason we are seeing this kind of a growth on the ARPU and the tariff front. Now, the key things to watch out from the Reliance Industries earnings would be margin outlook in refinery and petrochemical business, their outlook for the new energy business, what is the commentary that comes in on ARPU post tariff hike, Jio Fibers growth, and any commentary on capital expenditure outlay and how they plan to reduce their debt now going forward would be important to track from Reliance Industries earnings.
Somit, for getting us the views as well so far. But let me just pull up a long-term chart. If we can just have a 2025 chart in terms of YTD for a Reliance Industries. I mean, today it's absolutely flat, but if I can just have the YTD chart. There you go, a 7% up move, but it's been absolutely volatile. Let me welcome in our guest, Mr. G. Chokkalingam, founder and MD at Economics Research, and Akshay Bhagwat from JM Financial. Welcome to the show, gentlemen. Mr. Chokkalingam, how are you looking at a Reliance Industries now, taking into consideration the kind of volatility it has seen in terms of 2025? The pressure the oils and chemicals and the retail business is expected to see, as per what Somit was pointing out, how would you watch out for it?
Yeah, definitely. I do agree with your team's presentation on short-term outlook of Reliance. It would be subdued, no doubt. Oil and gas and retail, physical retail stores will pull down the performance. But still, the medium to long-term outlook seems to be good. As you also mentioned about telecom, which is remaining a very promising area of growth. And last quarter itself in FMCG, they built a turnover of around 8,000 crore. That is another trigger point. And third trigger point would be the buildup of new energy business. So these are the 3 triggers which will help the stock to do well in medium to long term. But investors have to prepare themselves for, expecting a very subdued performance in the short term.
Right. Akshay, what are charts indicating with RIL? I mean, in the last 12 months, a 10 to 11% is the kind of cuts that you're seeing. Is there any opportunity, or would you say this is the best time to avoid?
Good afternoon. Well, if I were to look at the longer term charts, in the monthly charts, clearly there is a strong trend line support, and Reliance hasn't reacted much. It has been on the trend line support. It has spent around 5-6 months trading in a range of 1200 to 1300 as it stands right now. So the trade trigger will be once the levels of 1330 spot or cash levels of Reliance are taken out. Whatever the result may be, if these price levels are breached on the upside, you can can expect a 6-month breakout of a range, which can easily see the stock selling up for levels of 1470. So overall, it's more of a conditional buy call. If you want to take a trade on Reliance, it is above 1330. In case you're holding on to the buy trade, then continue to the hold. Only below 1160 does this trend break, and we have a negative trend in that case. Right now it is neutral, but still in the positive zone as it stands on the monthly charts.
Got it. Well, that's the view coming in from the technical charts of Reliance. But another Nifty 50 company that is set to announce its Q4 results today is a Maruti Suzuki. Now, what can we expect from the auto giant? Let's bring in Puneet for more on this.
Well, thank you for that. So definitely the first big earnings in the auto space, and it's expected to largely be, in the mid-single digit in terms of growth. Revenue is just expected to rise by 12%, but that's largely price-led and not volume-led in this particular quarter. Margins expected to actually fall by 80 basis points on EBITDA, and that's because of higher commodity cost as well as discounting that the company has done in this particular quarter, similar to what's been the industry trend, as well as investments that the company has been ongoing in increasing the manufacturing facilities across India. So those will be hampering margins, and that will be one of the most important numbers to watch out for. It's expected to come at 12% versus 12.8% in the same time last year. This will lead to a net profit being almost flat to a negative bias, reported expected at 3,856 crores. Now, we mentioned that, there is some higher realization because of, price-led growth in this particular quarter, and that will be led by SUVs, specifically while the small car share has fallen. Depreciation is also expected to go up in this particular quarter because of, increasing the manufacturing facility in Haryana. Now, in terms of sales, the company recorded roughly 6.04 lakh units sold in this particular quarter. That's a growth of 3% from the same time last year, while the company has announced 3 price hikes actually between January and April. So we will see effect of that. So I think January price hike of 4%, as well as in February, the company took a price hike of roughly 1,500 rupees to 32,000 for across models. That will help the company's margins in this particular quarter, but largely offset by, as I mentioned, discounting as well. The other key factor to watch out for will be the demand environment from the next year. FY25 was a really flat year for passenger cars, just roughly 3 to 4% growth in terms of sales for FY25. So definitely that, and some commentary essentially on key raw materials going forward like copper will be something to watch out for Maruti Suzuki.
Got it. Thank you, Puneet, for giving us those details. Mr. Chokilingam, I'll come to you. The first auto numbers in the Q4 pack due today. What are your expectations for something like a Maruti Suzuki?
I would avoid Maruti Suzuki. The whole passenger vehicle industry is growing in a poor single digit. In fact, a couple of weeks back, the industry conference, many large players have mentioned that in FY26, the PV sales volume could be in poor 1 to 4% year-on-year basis, which is not at all encouraging fact. And secondly, when the whole industry is going through tough time, hiking prices a couple of times also is going to work against the demand for PVs in the industry, particularly for Maruti vehicles. And if at all one wants to invest in the large cap, I would prefer banking sector. If somebody is interested only in looking at the automobile, I believe M&M is far superior. It is able to outperform the industry growth in automobiles, and tractor business also doing very well. And its exposure to export is also quite limited. On standalone basis, the predominant portion of the income is from the domestic market. So therefore, I prefer M&M to Maruti.
Right. So that's with regards to where the auto names are concerned. In fact, Akshay, how are you looking at any of the auto majors, or even if you have to look at the auto ancillary pack?
Recently we had a strong bout of recovery in most of the auto names, and specifically if on the basis of price reading on charts, I were to pick names, I think I would go with Tata Motors and Ashok Leyland as the top bets on basis of price chart reading. Now, Tata Motors has been one of the beaten down names till now, and there has been a very strong recovery which I see on the charts. This happens from a very massive support zone of 600. So I believe 600 is a support which is there to stay for long, and it's a good chance if you want to buy from an accumulation perspective, buy and hold with a minimum 2 to 3 month time horizon, where my target projection will be a recovery till 800 to 850. Now, Ashok Ashok Leyland is the other name, which is a strong momentum name here. It has fallen less, even the auto pack was correcting. And here, with the support of 200, this stock is setting up all the way for revisiting its all-time high levels of 260, and further targets open up after that. So momentum based, if you're choosing, it's Ashok Leyland. Bottom fishing, if you are looking for an auto name, it has to be Tata Motors.
Ashok Leyland or Tata Motors looking better when you compare it to something like Maruti Suzuki. But the next stock we're talking about is Gensol Engineering. Another day, 5% lower circuit. If you look at the last 5-day chart of Gensol Engineering, it's like a staircase. It's just falling down. And troubles have mounted again after the ED has issued a lookout circular against the company's promoters. Shrimi joins us with more details.
Yeah, so furthering its forex violation probe against Gensol and its promoters, Anmol and Puneet Jaggi, ED learned to have requested, a Bureau of Immigration to issue a lookout circular against both, Anmol and Puneet to prevent, any possible flight risk as investigation deepen into the suspected fund diversion, which ED is investigating at this point. They registered the case yesterday. So Anmol Jaggi, who is reportedly in Dubai, has been summoned for questioning. So ED has actually issued summon on his registered email and address. And in case he doesn't turn up to the summon, the ED can explore even legal options as well, is what source is indicating us. And while his brother Puneet Jaggi was interrogated for over 7 hours at Delhi office of ED yesterday, and in fact, sources tell us that he was grilled on the alleged siphoning of fund of about 300 crores. So yesterday, ED official in fact also conducted searches at premises linked to the company and its promoter across multiple locations. Agencies at this point of time suspect that a portion of term loans, availed by Gensol may have been illegally remitted abroad. Officials also examining at this point that some of the funds were routed through promoter-linked entities, and if cryptocurrency was used as a medium to divert the money is what indication we are getting. So authorities are probing that digital asset like cryptocurrencies were involved in the diversion process or not. And this investigation is still ongoing, and further action is expected as the ED, expanded scrutiny into financial dealing of Jaggi brothers and its associated entities.
Right. Thank you so much, Shrimi, for getting us the details. And this is going to be a developing story as well, which NDTV Profit has been bringing you pretty closely in terms of coverage. But moving on, IEX, that's another stock that is in focus. The profit is up around 18%. However, it has missed street estimates. Now, the stock, in fact, opened the day with good gains. 1.7% is the kind of up move that you're seeing right now as we speak. Varsha standing by us. So, Varsha, overall, it's a pretty flattish quarter, but what is it that actually worked for the company that is keeping the stock on the upside?
Yes, so Hiral, the interesting part over here is they've achieved highest ever quarterly traded electricity volume, which is up almost 18% year on year. And when it comes to REC, so 68 lakh RECs were traded during the quarter, which is an increase of almost 100. So more, it doubled actually. And the highest ever RECs were traded in the quarter. Similarly for FY25, if you see, company logged the highest ever traded electricity volume, which is 121 billion units, which is up almost 19% year on year, and 178 lakh RECs were traded during FY25, which saw an increase of almost 136%, and it was the highest ever RECs traded in a financial year. Just to speak on the numbers, revenue were up almost 17%, EBITDA was up 16%, and margins were 86.3% versus 86.5%, whereas the estimates of the EBITDA margins were at around 89%, and the net profit was up 18%.
Right, so that's with regards to where IEX goes. Mr. Chokalingam, how are you looking at IEX taking into consideration the way commodity prices have moved right now?
Yeah, for two reasons, I would maintain a sell call on IEX, especially if the stock is able to move close to around 200. Reason A, the profit growth in the latest quarter is around 18% year on year, but the P ratio is around 38 for FY25. So I would not, pay this kind of P for when the company is able to grow only at around 18%. And the second point is that quite a while ago it has lost its monopoly status. The competitors have started operation and they are backed by strong, other businesses other than the power exchange businesses. So therefore, I have my own apprehension whether IES would be able to maintain fabulous growth in the near future. So therefore, I would give a sell call on IEX, especially if it is moving close to 200 rupees.
Got it, Mr. Choklingam. And Akshay, on the charts, how does an IEX look?
If I were to look at the short-term charts with a time horizon of under a week, we are right now trading at an important resistance zone, which is around 195 to 200. If you recollect the last 6 months, this stock has time and again met resilience, some selling pressure once it nears levels of 180, 190 zone. So right now, it's at the upper end of the band. So I would wait for either the stock to settle about 200 if I were to take a fresh buy position in the stock, or if it corrects from here, the correction may again extend down all the way till 175, which will be the second buying point. So right now it's more of a neutral view, and only about 200 things change, and post that the stock gets back into a strong footing.
So the 200 level, a key one for an IEX. But Aavas Financiers is also in focus post its Q4 numbers. The company's margin and asset quality is looking strong. However, the stock is under pressure. Vaishal joining us with the details of the results.
Yeah, so let us just split this into what worked for the company and what did not work. Starting with what is in favor with the company. So if you see, the net interest income growth was up 10% quarter on quarter, and company had a best margins for FY25, which they clocked in Q4 FY25, and the ROE is the ROE is well protected in FY25 versus 24 despite margin decline. The asset quality remains solid for the company. While what did not work for the company, if you see, the growth has dipped at 18% slowest in the last 8 financial years. Just on the Q4 highlights, net interest income was up 14% at rupees 271 crore. The impairment was up 25% quarter on quarter, and the net profit was up 7.7%. And the AUM grew almost 18% for the company. On NPAs, if you see, GNPA were at 1.08% versus 1.14% last quarter, while NNPA were at 0.73% versus 0.81% in quarter-on-quarter basis.
Right, so that's with regards to Aavas Financiers. Akshay, what are charts indicating with this stock? And apart from Aavas, anything else that comes to your radar from the sector which looks interesting?
Well, Aavas Financiers has seen some bit of profit taking or kind of a sell-off from the levels of 2200. Primarily, my understanding is this was a bit overstretched on the short-term charts. That's the reason you have a cool-off phase. Broadly, this stock is still strong on the price patterns. 1980 zone is a strong support if you're a short-term trader, and my sense is that you will have another round of short-term recovery from the supports which I mentioned. So in case someone has a buy position, the view continues to be positive. Roughly 1950 is the support zone. You can place your stop losses below the support and continue to hold. The target projections roughly work out till 2200. That's the short-term target with a time horizon of a month, and longer term you can continue to hold the stock till it trades above 1950.
Okay. Mr. Chokalingam, your view?
I would give a sell call. Yes, the quality of asset is fabulous, no doubt about it. But price to book value is around 3.6 times. In this market, I am not comfortable with 3.6 times, valuation multiple. One can consider a maximum around 3 times. So which means anywhere around 650 to 1700 would be fair price in my view for Aavas Financials.
Got it. Moving on, let's focus on Aloris Lab, which is a stock we should focus on. The stock recovered its intraday after falling 5% despite posting a good quarter. Now, the profit tripled on a yearly basis due to a boost in the other income. And we spoke to the founder and CEO, Satyanarayana Chava, about the quarter gone by and the outlook for FY26. Listen in.
How do you rate the quarter, sir? Because when I look at the exit margins that have come in into quarter 4, I'm starting with the minutiae first, the margins, because it was such a big talking point, right, all through FY25. What do you do? Do you end at 20%? Do you do higher? The exit margins are good. even though your average margins are not 20 but 18, but the exit margins are very strong. What went into that quarter for the exit margins to be what they are? And what's the color that you can provide for the quarters ahead, sir?
Neeraj, good morning. As we were talking in the previous quarters, we guided our investors. The H2 FY25 is going to be good, and we delivered those numbers. When we delivered 20% in Q3, then people were thinking, unless we do over 25% EBITDA for Q4, we'll never be able to get an average of 20. Interestingly, we did that, and that was because of higher revenue share coming from CDMO, and we could see some leverage happening in our asset utilization.
Right, so that's with regards to Laurus Laboratories. Mr. Chokalingam, how are you looking at the pharma space, taking into consideration what's happening on the domestic front? Plus, you have, the impact that could be coming in on the back of tariffs and the kind of opportunities are lying for the CDMO place as well. How are you? What's your view?
Yeah, I'm a little cautious on exporters, extremely bullish on the domestic pharmaceutical companies. Yes, this morning also we saw in the media that the US Secretary of State has mentioned that India is the first country to come to negotiate table and do talk on bilateral trade relations. So which is a very big positive. I believe that 26% reciprocal tariff may not happen for Indian pharmaceutical products, but still, even if it is hiked by 10%, I think the exporters will have a significant hit, because last 2 years we know the pharmaceutical companies which were exporting to America have been under a little stress in terms of the realization and the demand growth. So therefore, I am more bullish on the domestic pharmaceutical companies.
Got it. And Akshay, Laurus Lab on the chart, how does that look?
Well, since the beginning of this year, it's been a choppy, rough ride for this stock. The stock tries to break past its swing highs, but again, there is another round of sharp correction. So roughly what I understand right now is 540 and 660 is more of a short-term trading zone. It's more of a neutral stance. But if you look at the all-time high levels for this stock, it roughly coincides around 690 to 700 zone. So I believe that in the coming months, this stock may make a revisit for levels near 700, which should be a good level to take out your profits in this stock.
That's the view coming in for a Laurus Lab. But another stock I want to talk about is the Patel Engineering. It's buzzing in trade, an intraday high of 5% at the start of trade. It has cooled off as the markets have come off, but this is on back of 2 order wins that the company notified this morning. It was declared the lowest bidder for a 1,300 crore odd contract, which will construct a dam in Maharashtra. And this project is expected to be completed in 42 months. The second order was a 718 crore contract that was received for a 240 megawatt hydroelectric project located in Arunachal Pradesh, which will generate 10,000 million units of energy annually. And the project is expected to be completed in a period of 44 months. Now, since its Q3 results, we've not seen any order win releases notified by the company. So, assuming taking the Q3 FY25 order book, which stood at around 16,396 crores, and if you add the 2 new latest orders that the company has notified, the order book value could be taken to over 18,400 crores. And that's why Patel Engineering is buzzing. But Akshay, Patel Engineering on the charts, how does that look?
Patel Engineering, well, the price structure from a medium-term 3-month perspective is in a falling channel or a trend line, where it means that the stock is still in a weaker trend. So as of now, right, 35, 38 is the short-term support zone, which is it is trying to cement, still no confirmations as yet. So I will give this stock a miss, because technically still there is no price confirmation about any major directional move. So I would give this stock a miss to buy. In case you are holding, I would recommend to take an exit.
Got it. Thank you, Akshay, for giving us that outlook. And I want to thank both of you all, Mr. Chokalingam as well as Akshay, for coming on the show and helping our viewers with views on the stocks we spoke about. But with that, viewers, that's all we have on the shows. But do stay tuned to NDTV Profit. Lots more lined up on the other side.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to the current market price. A premium of nearly 10 to 15% is what the dealers are indicating.
$361 is going to issue these securities to UBS at a deal value of roughly 40,000 crore pre-money and around 42,000 crore post-money.
In the last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Jaggi brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India.
Hello and welcome. You're watching Top Trades on NDTV Profit with me, Somit Sarkar, and my co-anchor Puneet. Well, Puneet, markets have fallen, but then we are seeing a soft recovery. In fact, a strong recovery. Nifty PSU Bank Index is up 1.7%. Nifty Small Cap has recovered nearly 1.6% from day's low.
Well, definitely, and we highlighted in the morning that we've seen the PSU Bank Index fall for the third straight day. And stocks like IOB was one of the key losers in trade today. So definitely seeing some recovery there. Still in the red today, but we're seeing a very strong recovery on that aspect as well. Let's also pull up the Nifty first, as well as the contributors for the Nifty. It has been doing, it, as mentioned, a strong recovery that we've seen. Stocks such as Infosys, TCS are in the green right now. SBI Life on the back of its strong Q4 earnings is also back. We're seeing some pressure on stocks like Axis Bank after the company's Q4 earnings yesterday. They did host the analyst call and did mention about provisioning as well in terms of the credit card as well as the personal loans, and that is something that the street is not taking too kindly. Among other things, that the results was largely flat. Let's also look at in terms of the mid cap and the small cap performance, if that has improved a bit compared to the benchmark indices, not so much at all. We're seeing just some recovery from the day's low. Days was about 200 odd points on the mid cap, 150 on the small cap, 250. We have seen currently down 2.28%, and again a 200-point recovery on the small cap as well. Let's also pull up the BSE 500 as well, because we've seen a whole host of stocks today that have been buzzing essentially on the back of Q4 earnings as well. Sterlite is up 5%, and yesterday we did see a big 25% sharp downtrend on Sterlite on the back of the demerger of the business. Restaurant Brands Asia is also up about 4.5% up. Emphasis on the back of, as well as Persistent, if I can highlight that, on the back of strong Q4 earnings for both of those players. Very decent commentary as well to go looking forward into FY26. On the loser side, Some pressure on SBI Cards after earnings as well. Cyient, another one, as well as L&T Tech on the back of earnings. But overall, we've seen a day today that has been largely, dominated by news flow in terms of quarter four earnings as well. And, we have Lancelot also joining in. But before I go to Lancelot, let's pull up Tech Mahindra first, because that's the company which is also in focus on the back of its quarter four earnings. Now, very interesting what's happened with Tech Mahindra in today's trading session. Started with a 4% down move. We've seen a stellar recovery on the stock, and that's largely on the back of its quarter four earnings that came in yesterday, as well as some of the key commentaries that the company mentioned in its conference call as well. So first, in terms of earnings specifically, we have seen just about a 0.7% growth in terms of revenue, but EBIT margins come in at 10.5%. Expectation was about 10.3%, so definitely a beat there. We've also seen the profit was up 18% in this particular quarter, coming in at 1,167 crores in terms of profits, largely supported by the other income segment, but overall the services business has been growing. The IT segment revenue was at 11,327 crores. And one of the key strong points in this particular results was the deal wins, $798 million in terms of deal wins for quarter four. This takes the consolidated TCV to almost $2.7 billion in FY25, and that's up 42% compared to the previous year. So it's a big deal win that the company has managed to do in this year. We've also seen its top three verticals, which is communication, manufacturing, and BFSI, all either contribute flat to positive growth in this quarter. So hence, that was one of the key things. The other aspect which might have led the stock to be under pressure was in terms of EBIT margins. Now, FY27, the company's vision is to go to 15% EBIT margins. Currently, between 10 and 11% is where it is. And in terms of brokerages as well, that's the reason we saw some, in terms of brokerages like Macquarie as well as Citi being bearish. But I want to pick up Kotak first in terms of, the brokerages specifically, because we did see some in terms of three key points that they are making. They've mentioned that, deal wins is providing them the much needed portfolio shift to high margin businesses. The second point they are making is that they believe that the company is on track because of these, high margin deal wins to reach that 15% EBIT margin target. And finally, they're saying that a successful turnaround, which is the base case scenario, should lead to a re-rating in the multiple. And similar view coming from Investec, they actually have a target price of 1,672 rupees per share as well. And again, they mentioned that, they believe that this is the highest growth in terms of deal wins versus peer group, as well as, that company could potentially be the highest growth in the next decade. But Lancelot, good afternoon, and thanks so much for joining in today. I just wanted to start off with the IT space as a whole. We've seen Tech Mahindra come in with good earnings today. Emphasis also strong earnings, but some pressure on stocks such as LTTS after earnings as well. What do you make of the, and Cyient as well, another one which is under pressure because of earnings. So how are you viewing these 3-4 companies in terms of earnings, and any pick that you have to look out for, at least in IT?
I think, these companies are in different spaces because, L&T Tech is actually providing engineering services software, whereas Tech Mahindra are more into the telecom as well as, the general software that we are seeing, software services across various categories like banking, financial services, insurance, etc. So they are mostly in the implementation services as well as in the maintenance services. Now, I think that space, while Tech Mahindra did get significant deal wins in this quarter, whatever we hear from the commentary is that maybe going forward, things are taking a little bit of a pause from most of the companies in the light of what's happening globally. So we may see the subsequent quarters, things may slow down a bit. And so given that background, I think, Tech Mahindra is probably fairly valued at this point in time. And yes, you might see if the growth does continue, then it would mean a kind of a re-rating as far as Tech Mahindra is concerned. And as far as the space is concerned, I think, at the end of the day, AI, cloud services, digitization, these are all the areas where there is a lot of work still that needs to be done, and there is integration of various platforms that will be required. And most of these companies are poised to provide services in those spaces. So I do believe that, it's just a matter of some time before, work gets allocated and these companies are able to then grow their their book size accordingly. So the space is good. Valuations are not that high at the moment, so one can look at slowly adding to the sector and to the good companies in the sector over a period of time.
Another stock that remains in focus is Axis Bank. Now, the bank's Q4 profits were ahead of the estimates, but the loan growth number was a bit disappointing. Let's go across to Harsh with more details on the Q4 numbers.
When you're looking at the overall set, it looks like a decent set that's coming from Axis. Margin expansion of 4 basis points, that's a bit of a surprise. Didn't expect that coming from Axis. The NII number was a slight miss, but that's largely driven because loan growth came in lower and not because margins were compromised. So margins actually have gotten better, which is the positive surprise. But where your NII number is concerned, it's a slightly softer number, but that's largely led by loan growth. Loan growth was extremely soft. Something to keep in mind, again, just 8% up YOY, the loan growth. And missing estimates, maybe by around 1.5% at the very least. So maybe that's something to keep in mind. The other piece is with regard to OPEX. OPEX was elevated, operating profit largely in line. You saw provisions number largely lower, in fact sharply lower when you're looking at it sequentially as well. Credit costs were down around 30 basis points, came in at just 0.5%, and profit after tax therefore got a lift. Your ROA hit 1.8%, your ROE hit 17%. Both of those metrics extremely strong, given the fact that that's the aspirational ROA, ROE of Axis, and they haven't been able to do that, and therefore clearly a positive. But disappointing in a big fashion with regard to growth. Just 8% on loans, just 10% on deposits. Not looking good from that perspective. 7% QOQ deposit growth looking very impressive. So on the QOQ number, it's very solid. But on the YOY number, loans, overall disappointment, deposits also disappointing.
Lancelot, coming to you on the Axis Bank number, yes, deposit growth has been a bit slower, loan growth has been a bit slower, but how are you looking at the overall numbers given the fact that things are expected to improve now going forward?
So I think, everybody knew that we were coming off a difficult year for the banking space because, you had seen interest rates high. Most of the banks were struggling to attract CASA deposits. And because of which, they were forced to borrow at higher rates and margins were impacted. So while the bigger banks like, ICICI, SBI, etc. have been, and HDFC have been able to probably expand their loan book a bit faster because they have a larger access to, corporate lending. We have seen that, companies like Axis have struggled to do that. But going forward, I think the environment has changed, and that is also evident in the last quarter loan growth. So you can see that the environment having changed to a lower interest regime should spur some amount of loan growth, as well as companies, as well as individuals will start to borrow a lot more. So I think going forward, you expect to see maybe a higher loan growth going forward, and that should compensate, and if valuations are like down because of the stock is down, that gives you an attractive opportunity to enter into, the stock and hold it for the upside when it comes through.
Got the view, Lancelot. Another stock that's in focus is Macrotech Developers. Now, the company recorded strong Q4 earnings. They also beat its FY25 pre-sales guidance of 17,000 crore rupees, and its net debt also reduced by 320 crores. What were some of the other key highlights from the earnings? My colleague Anushi joins in with more on this. Anushi.
Shares of Macrotech Developers are in focus after they have posted a strong set of Q4 numbers. Now, some of the key highlights, if we see, of the quarter, firstly, it's the pre-sales which were in focus even after the business update that we've seen. The company has beat its FY25 guidance of pre-sales, which was at 17,000 crore. In fact, if you look at the FY25 picture, they've registered about 30% of growth of pre-sales from its new launches in 2025. Along with that, they've added 10 new projects with a GDV size of 23,000 crore, which was against the guidance of 21,000 crore as well. So strong beat here also that we are looking. Net debt to equity continues to remain at 0.2 times, which is below the ceiling level of 0.5x that we've seen. Now, if we just talk about the four general numbers of the quarter gone by, revenue was up around 5%, margins on expansion of 284 basis points to 28.89%. Net profit saw growth of around 38%. But do note, for real estate companies, it's the key operational numbers which are in importance, wherein we saw about a 14% of a pre-sales growth in the fourth quarter. Collections also strong growth here at 26%, and they added 2 new projects in Pune with a GDV value of 4,300 crore. What's interesting to note is the kind of outlook that the company came out with for FY26, wherein they expect a 19% of a growth in pre-sales in line with their target of seeing around a 50,000 crore of pre-sales in the next couple of years that we are seeing. So pre-sales expected at 21,000 crore for FY26. Operating cash flow is expected at 7,700 crore, so 17% of a growth here as well. And they expect net project additions of 25,000 crore as compared to 23,700 crore, which we saw in this financial year. Net debt to equity to continue remain below 0.5 times of level that we are seeing. So this is the overall roundup of Macrotech developers in Q4 and what's the outlook for FY26.
Well, thanks for that, Anushi. Lancelot, coming back to you, how do you view specifically Macrotech developers' earnings, and if you have any preference in the real estate space, what are your topics?
So I think, I did look at Macrotech developers with the earnings coming out, and it seems like they have a lot of traction in the lower income segment, which is, probably in the less than 1 crore segment. And then there is a lot of traction in the super luxury segment. So in these two segments they've seen, but there is a bit of a slowdown maybe or a lower growth rate in the middle segment. And that should, probably indicates that with maybe interest rates easing up, we could see some improvement coming up in that segment as well. But for the company to maintain the strong growth rate that it has, shown so far in the past, is also going to take a lot more, effort, and acquisition of new projects and land will also be key in how they grow. From a valuation perspective, stock is reasonably well priced. I think most of the positives are already in the price. So there's not much one can do at this point in time.
Moving on, speaking on the sidelines of the India Steel Conclave 2025, my colleague Sajid spoke to the Steel Secretary Sandeep Pondrek. He talked about the road ahead for the India's steel sector. Listen into that slice of the conversation.
We're in a very exciting times globally as well as domestically, because the kind of targets which Prime Minister has set for the industry is also a big challenge in terms of how to scale it up to that level. How do you see the Indian production and the capabilities going from 2025 to say 2030 and then to 2047?
So basically, as you know, that India is the only major economy where consumption is growing very fast. And that is primarily because, number one, the economy is growing fast. Secondly, that the government is pushing a lot on the infrastructure. Private sector development is also taking place. So there's another factor that we have just crossed about 100 kg per capita benchmark. And it has been seen that when a country is around 100 kg, then the elasticity of steel demand with respect to GDP growth, it goes up. So right now, if you see the data, our elasticity has been above 1.5 for last 2-3 years. So basically, the consumption is expected to grow. Now, to match that consumption, we have to increase the capacity. In last year alone, we have added about 21 million ton of capacity in the country. From 179, we have reached 200 million tons. If you see in last few years, we have doubled our capacity from 100 to 200 million ton in a period of about 6-7 years. What is expected is, if you take into account the plans of ISPs like Jindals or Tatas or SAIL, they have ambitious plans. About 30 million ton is already under implementation. Another 50 million ton is under planning. And then the secondary steel sector is also growing. So our expectation is that by 2030, we should definitely cross 300 million tons. That is, we should add up about 100 million tons in next 6 years.
Well, in the same event as well, my colleague Sajid also spoke to Amarendu Prakash, the chairman at SAIL, who talked about achieving 75% steel capacity by 2030. Listen in to a slice of their conversation.
We are at the India Steel 2025, and there is a good target which has been given for the domestic industry of PSU as well as private sector. The first being the 300 million tons target for 2030. How geared are you as SAIL, India's largest, one of the largest public sector firms, to meet that kind of challenge?
So you see, Sajit, if we look at India's capacity today, it is around about 200 million ton, and it's trying to get to 300 million ton in another 5 to 6 years time. SAIL is currently at 20 million ton, and we are trying to get to 35 million ton by the end of this decade. So 75% increase in capacity by 2030.
So where is that capacity coming in? It will be a capex, and will it be greenfield or will you use doing a brownfield expansion?
So as you know, we have 5 steel making locations at Bhilai, Rourkela, Bokaro, Durgapur, Burnpur. 4 million ton is coming at Burnpur. 3 million ton is already in motion at Bokaro. 3 million ton is brownfield across all these plants. That is stretching the old capacity to bring in brownfield expansion. And further 5 million ton is planned for Rourkela.
And what is the kind of capex allocation that you're looking at?
That's the pain point. The capex naturally, as you know, in the steel industry is high. So this 15 million ton, we expect to take about 1,30,000 crores.
And do you see today, as we speak, the industry pricing of steel, which is there, is good enough to generate enough cash flows to fund that kind of cash flow capex?
As if I take the average prices of last 1-2 years, no. But we hope government has announced a safeguard duty based on data. See, we are a pretty competitive industry in India. When we make steel in India, it is pretty competitive. We are efficient. However, when steel from some countries where there is excess capacity, low consumption, comes into India at not the right price, it's below cost prices. And also in some countries, the subsidies given to the steel industries are quite high. So it is a well-known fact, and it has been calculated by government agencies, Niti Aayog also. We see $80 to $100 is a margin which in some countries steelmakers enjoy on their cost. So all that Indian steel industry is looking for is a level playing field. We are not saying that we are not competitive, somebody should cover for our inefficiency. What we are saying is we will be most efficient, but these subsidies should not allow cheaper steel to come into India and low quality steel to come into India. So if the safeguard duty is a step in that direction, and if the government policies consistently support us, we feel we should be able to pull through.
Sir, you've put out an ambitious capex target of 1,30,000 crores. What, according to you, should be the appropriate or optimal pricing of steel so that you can generate cash enough within the operation and can sustain this entire capex?
If you look at fundamentally, if you look at the steel industry is a high variable cost industry, that will mean that the inputs that go into making of steel make up a large part of the cost. For example, you see today coking coal is 40% of the cost of steel for a steelmaker. So to answer you get a cue that what should be the right price of steel will depend on what should be the right price of coal. So the price at which you get coal will dictate the price.
Coming down a bit, right?
Yes, over the past 2 years, there has been a decline in coking coal prices. It is currently at around $170 to $180. If it persists at this point, I think we should see stable prices of steel in the market too.
And what about how do you replace that with an alternative fuel? Because the Prime Minister was talking about coal gasification. That's the one substitute for coking coal imports which is there.
Yeah.
Are you looking at those kind of projects as well?
So we as a steel maker are the only ones in India who actually use some of the domestic coking coal to produce coke. So we are already into it. We use about 17 to 18% of the total coke making comes from domestic coal for us per se. we have also looked at possibility of using domestic coal as a form of pulverized coal injection into our blast furnaces. So we
Lancelot, coming to you on the entire steel space, yes, the government of India has announced safeguard duties to protect the domestic industry, and SAIL is looking to increase their capacity by 75%. How are you looking at the entire steel sector, and what are your top picks when it comes to the steel sector? JSW Steel, Tata Steel, SAIL or JSPL?
So I think, the steel sector, when you look at it, is going to be driven by the high consumption that we have in this expected in the country over the next 4-5 years, with a significant thrust on, infrastructure development, real estate. So that is going to drive basically the growth of steel consumption. And on the back of that, anticipating this rise, a lot of the companies are expanding their capacities. Also, the expansion in capacities brings in a certain amount of efficiency in the cost of making steel, which actually adds to the strength of the companies going forward. So the availability of raw materials also being, most of them, being locally available, provides them with a natural hedge or a cushion against, high prices. So yes, steel industry is an area of growth. The question is, what can be the return on capital that is invested? And generally, the gestation period for the steel plants is a longer duration. So while we're looking at almost 50-60% capacity addition in the next 4 to 5 years, the returns on that investment will take a little longer. So my view at this point in time is, rather than looking at this at a point when the return on capital is going to be relatively on the lower side, it's probably a better option to look at other commodities or other companies where the return on capital is far higher, and such businesses would generate higher value. But if you had to pick a company from the steel sector, yes, JSW Steel is a good option, opportunity to look at. Tata Steel, as well as the JSPL is also a good steel company to add to the portfolio. But whether one should do it right now or wait for a fall in the cycle for steel and then look at investing is a call where investors need to consider and take a call at that time.
Thank you, Lancelot, for joining us and giving us your perspective on the markets and the stock that we spoke about. Moving on, Dheeraj Rally, the MD of HDFC Security, told NDTV Profit's Charu Singh that the first half of this fiscal would be volatile due to the global tensions and tariffs, but there's light at the end of the tunnel. He's expecting the second half to be much better. Listen to what he has to say.
I think if we look at the global environment, it's still volatile. We have seen the unprecedented volatility due to the tariffs coming in from the US, and also geopolitical tensions are still growing, and we've seen recent escalation in cross-border activities from neighbor. So to that extent, short term, these will have its own overhang, but Indian macros are very strong and compelling. To that extent, we believe that India will be an outlier. We'll continue to grow at 6.5% plus minus. Our high frequency indicators are clearly showing that we are doing well. Monsoon predictions are also good. So, and last year was a tough year in terms of an earning after good 4 years of earning between 20 to 24. I think that is behind us. We are looking forward for a good earning growth in the fiscal 26. Interest rates are also coming down. So to that extent, I believe that we will have financial year 26 as a tale of two halves. First half, you will see a significant volatility in the market. Second half will be better.
Well, with that, it's an end on this edition of Top Trades. Stay tuned and keep watching NDTV Profit.
That's huge. That is a biggie. It's out of it.
गोल्ड प्लस क्लियर ग्लास, पार हो या नियर, सब कुछ दिखे क्लियर।
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to the current market price. A premium of nearly 10 to 15% is what the dealers are indicating.
$361 is going to issue these securities to UBS at a deal value of roughly 40,000 crore pre-money and around 42,000 crore post-money.
The last 1 month, if you see, the share prices of Genzol Engineering has fallen more than 58%.
Why are the rating firms calling the debt payments as default?
We have two credible credit rating agencies on March 4th coming and downgrading the stock to D.
Statements are consistently being proven wrong, and transactions are being taken place which are different from what they were originally pictured to be.
The company claimed it would roll out 6,400 electric vehicles. But what it has rolled out is a shocking scam. Funds meant for the project were funneled allegedly back to the promoters, the Junkie brothers. What did the money buy? Not EVs, of course, but a lavish flat in Gurgaon's luxurious DLF Carmelias.
To India specifically, I really think India has a fascinating opportunity because in a fracturing world, everyone wants to be friends with India. We're all trying to make new friends a little bit, right? So we're all trying to think about the remapping of the global trading system. For sure, India is on the top of
Hello and welcome. You're watching India Market Close here on NDTV Profit. I'm Harsh Saita, with me is Neeraj Shah. In terms of where we are placed on the Nifty, we're seeing a bit of a recovery at play. We've bounced back well above 24,100 as we speak, just about 0.5% or so lower on the Nifty. Par for course is broadly the way in which we're seeing it, at least for the moment. Let's look at the intraday chart because we've bounced from the lows. We've bounced a fairly good bit. We were below the 24K mark for just a wee bit, but thereafter a steady recovery is what we've seen, at least on the benchmark. Let's look at the heat map as well on the Nifty, and SBI Life, the top gainer on the back of numbers. That margin recovery very, very solid, and Axis Bank, the top laggard. So both sides we are seeing financial names dominate. In terms of outside of that, look at the way in which some of the IT stocks are moving in trade today. Really supporting markets, if at all I can call it that. But any support whatsoever is coming from IT and the big boy Reliance, which will declare numbers later today. You have a Shriram Finance under pressure, a Trent under pressure. So plenty of stocks which are under pressure as well in trade today. It's a mixed bag in that sense outside of IT. Because you're largely seeing a mixed trend across the board. You're seeing red. Let's look at the sectoral heat map as well before we look at the advanced decline, and I toss it to Neeraj for how broader markets are appearing. If you're looking at how this is playing out, defense is down nearly 2%. Media is the other laggard. Realty down nearly 2% as well. Pharma, metals are the other two pockets which are not doing as well. IT is the only one which is up 1.4%. And then you have something like a Nifty Auto, which is also down around 1% thereabouts. Nifty Bank largely in line with how the Nifty is doing. Let's pull up the Nifty IT in terms of constituents and thereafter look at the advanced decline. There you go. So that's how it's looking with regard to the names on the Nifty IT index. Infosys, one of those, which is one of the top contributors even on the index as we speak. TCS2 doing fairly well for itself. Let's look at the advanced decline on the NSE, and that's how it's stacking up. Clearly, breadth of the market is looking difficult, much more difficult than what it was yesterday for sure. But nonetheless, from the lows, a mild bit of recovery, right, Neeraj?
Yes, you could argue that, but the small cap index is still down about 1.85%. So in the broader end of the spectrum, not too much, but there are specific pockets of strength. You look at them, you wouldn't even feel that the markets would be so much pain. So SBI Life, amongst the best of the names with the results, is up 5%, yes, but the broader end of the spectrum, Archean Chemicals up 4%. Then look at the not mid-cap really, but the non-Nifty IT cohort, Coforge, Emphasis, Persistent Systems, really strong showing there. Naveen Fluorine is up another 2.5%, and I think even Gujarat Fluorochem, if I'm not wrong, was trading in the green the last time I checked. So some gains out there for the broader chemical space. I spoke about RKN too. That one too is up about 4% in trade. On the flip side, what is not doing well, Motilal Oswal is down about 6%. SBI Cards down about 6%. Berger Paints, Blue Star are amongst the others. And Sterling Wilson, despite YOY looking very good numbers, but I think slightly below the whisper number. A lot of buying done ahead of the results. And maybe this whole cross-border geopolitical stress is leading to some bit of downtick there too. Richard Jain, Vice President, Equity Technical Research at Wealth Management at Motilal Oswal Johnson on the show. Richard, good having you. Thanks for taking the time out. You can look at this as a day with some stress because of all that's happening geopolitically, or you can look at it as an afternoon which is of recovery, because after hitting the day's lows, there has been a bounce.
Yeah, very good afternoon, Neeraj. So Neeraj, if I just keep that geopolitical sentiments aside and just look on the charts, then in the month of February and in the month of March, if you remember, then 23,800, 23,850 was the zone where the market was resisting. And from that levels, we had corrected and formed the bottom that around 21,700, 22,000 range. Now, this resistance of 23,800, 850 has recently been surpassed at the start of the April month. And what we have seen today, after an up move, we have seen a pullback move today, where the 23,800, 850, which was the earlier resistance, has acted as a support. So, technically, only if I see technically, then this 23,800 becomes a make or break level. And many times it happens that whenever we see a breakout, after post the breakout, the market or any stock corrects, test that resistance becomes a support and again resumes the momentum. So I think as of now, we are in that stage where 23,800, 23,850 remains a very crucial support. Until that is intact, I think the broader trend is not negative yet. But yes, if 23,800 gets broken, then I think this entire theory will go for a toss. So good, better thing is that better to stay with the trend. Now the only thing is that if you look at the market breadth, we have already seen a good run up in last 15 days without any meaningful correction. And the market breadth since last 3 trading sessions have deteriorated significantly. If you look at the Nifty mid cap and the Nifty small cap indices advanced decline ratio, day before yesterday, while it was positive for so many days, day before yesterday, the advanced decline ratio turned 1:1, where we had equal advances and declines. Yesterday, we saw declines were more than the advances. Right. So, and today we have completely seen that declines are much more than advances. So the market breadth is deteriorating. So this is an indication that even if you are a short-term trader, this is not the kind of market now what we had seen in that 15 days that everything will go up. You need to be very selective, right? Until the market sees a resumption of the positive momentum and that 24,500 gets surpassed, you need to be very selective, and 23,800, 24,500. This would be seen as the range for the market for next few days. So I think certain pockets which we can see where relative outperformance has started. One is IT, much beaten down sector, which we had seen that more or less a lot of uncertainty which was there related to the tariffs in the US. So I think that uncertainty is coming down, and that is why we are witnessing some pullback move in IT. So I think those sectors which are today relatively outperforming or falling less in this market correction, I think one needs to choose stocks within the sector. But on the index front, as I said, 23,800, 24,500 still remains the range, and 23,800 should be kept as a stop loss on any long positions.
And what about the Nifty Bank, Ruchit?
Yes, so I think Nifty Bank is witnessing more of a profit booking at higher level. We have clearly seen that since the month of mid-March, the banking and the NBFC space had taken the leadership, and there was a significant outperformance, compared to other sectors. So that broader trend has not changed for the banking index, but the index rallied from 49,000 to 56,000, 56,500 without even a single days of correction, I think. Right. So due to that, the momentum readings were quite overbought, and hence we are witnessing some cool off. So we believe that this momentum reading should get cool off either with some sort of price wise dip where a higher bottom structure would be formed then, or a time wise correction where the index would stay sideways for some times and until this overbought setups get cool off. So I think just for next few trading sessions, we won't see that kind of fireworks coming in the banking space, but rather more of a consolidation could be expected.
Yes, Ruchit, for the afternoon.
So as you spoke that looking for certain sectors or stocks which are not falling, and IT, of course, we can clearly see a relative outperformance is there. So I have just one buy recommendation today, which is a Coforge within the IT space. The stock has managed to make a good recovery from the recent lows, and that too with improving volumes. So there are some stocks which are showing a recovery because Nifty IT index is going higher, but the volumes are missing. Coforge is one of the stock where the price move has been supported by good volume. So we believe that Coforge should relatively do well. One can go long over here from a trading perspective with stop loss below 7,300, expecting a retracement targets towards 7,850.
Okay. Actually, follow up that, Ruchit. I know you've chosen Coforge, so that's your favorite. But today, the performance from Emphasis has also looked pretty okay. How does that look on the charts?
Even Emphasis seems that could be a good pullback move. But what we have observed that there was a positive divergence in Emphasis when it was around 2,100. From 2,100, it has came up to about 2,550, and the 200 DMA resistance is coming around 2,650. So almost, I think, about 100 rupees up from current levels. So for fresh buying, the stop losses are much deeper for Emphasis until it surpasses that, gives a breakout above the 200 DMA now. So because of that risk reward ratio being a bit unfavorable, we prefer more of Coforge. But yes, if any existing long positions are there which are bought at lower levels, then I don't think there is much worry for them. They can continue to hold on the stock. But for fresh buying, either if we get any dip or a breakout above that resistance, then only we would get some favorable risk reward.
Okay, that's a fair point, and thank you for that view. In fact, speaking of Emphasis, and the reason I asked is also because we spoke to the management today. Here are what the management has to say about the outlook ahead. It's not too often in this quarter that we've seen an inline set of results in a weak environment, save for maybe a handful of 2 or 3 companies that I've seen. Not too many have done that. Emphasis has managed to do that. Net revenue is largely in constant currency growth in line with most estimates. Segment growth driven by insurance, I believe, BFS and TMT, while logistics and transportation vertical continued to decline for them. Let's get in the management. Nitin Rakesh, CEO of the company, Arvind Viswanathan, CFO, joining right now to talk about the numbers and the outlook ahead, more importantly. And gentlemen, thanks so much for joining in, and congratulations on what's turned out to be, in the current times, an inline set of quarter or number is not a reasonable quarter, but a good quarter. So congratulations on that. Nitin,
thank you.
Let me try and understand what is the environment around you telling you with regards to deal wins, with regards to the change that you have to contend with both at the client side as well as internally, and how do you mix all of this to try and hypothesize what you can do in FY26 or beyond?
Thanks, Neeraj. I think it's an interesting environment because there's a lot of volatility and noise around just the macro, right? All forms of things that go in the macro, whether it is interest rate cycle, tariff uncertainty, geopolitics, recession fears, and a whole host of second order impacts from there. So that's definitely, a bit of a headwind because that makes everybody nervous. It's not easy to get decisions done. 90-day pause means let's wait 90 days to make a decision because we don't know which way this is headed and so on and so forth. The other interesting thing that's underway also right now for the last 2 years or so, but it's starting to pick up absolutely in the last, I would say, couple of quarters, is what does really AI mean to customers? And as they've gone through a phase of experimentation and piloting and proof of concepts and use cases, I think there's a pretty much consensus that this is something that really means they can have a big impact to their customer experience and their cost to serve. So efficiency using AI and adoption of AI to actually get better with their customers and their overall business. In that environment, I think if you combine these two, we basically took a call about, 12, 18 months ago that in an uncertain macro, with this kind of change that is driving through the underlying business, let's get focused on the micro. What that means is, on one hand, we are very focused on client by client, account by account, understanding what their priorities are, what their journey looks like, what phase of evolution they're in, and what we need to do to them what we need to take to them to actually align with their strategic priority and become a strategic partner. Even if we already were, how do we become a partner in the next phase of the journey? On the second hand, what that focus on micro means is evaluate where we need to invest in, within our business, both in terms of not just people and upskilling, but more importantly, what does this mean to the model of our business and our industry? I think
plenty happening, all of that flashing at the bottom of your screen. Maruti's numbers looking largely in line. We'll quickly have a take on those numbers coming through. EBITDA at 4265 crore versus 4897. That seems to be a miss. 10.5% margin versus 12% as per NDTV Profit estimates. Profit after tax though, largely in line. All right, so maybe a 4-5% miss on the PAT number as well. This one looks pretty okay, maybe 2-3% of a difference there, but EBITDA, okay. So the EBITDA number 4287, 10.5% margin versus a 12% margin number. What we'll do is we'll take a quick view from Nischal Maheshwari joining us, CEO, Institutional Equities, Centrum, who's joining us right away. Nischal, one is you have Maruti's numbers, but more than that, it's the other piece of news which I also wanted to address, and it's good having you here first off. Good afternoon. We've just received news saying that there's firing across the entire 740-kilometer line of control between India and Pakistan. Indian Army is responding to some firing coming from the Pakistani side. Nischal, at this point, what is your sense? Things are heating up, obviously. How should and how would you reckon markets respond, and how should investors respond therefore?
So afternoon to you and all your viewers. I would request you if you can update your records basically. I left Centrum 6 months back. I know I am no more with Centrum. So please update your records. I am an independent market analyst.
We'll do that. Sure.
Yeah. So yes. So I think yes, in the short term, you will see this kind of nervousness, what we've seen in the market today happening. Maybe a quarter, maybe a week or so till we get to something more concrete. But beyond that, historically, we've seen this kind of skirmishes, or even we have seen basically the Ukraine-Russia war also have very little impact on the markets. I think in the short term, basically, yes, there is nervousness, but after that, I think the market just takes it in its strides and moves on. So I do not see much worry. In the short term, basically, if the market corrects, I think it would be opportunity to buy.
Okay, so if the market were to correct, it's an opportunity to buy. Also joining us is Mayuresh Joshi, Head of Research, MarketSmith India, to address the Maruti numbers. Nischal, we'll just put you on hold for maybe a minute or two while we address this and close this. Mayuresh, how are the numbers looking?
Afternoon, Raj. I think more or less in line with estimations. So prima facie, I think the numbers seem to be in track with what the street was expecting.
Okay. Mayuresh, the numbers in terms of margins slightly on the softer side in your opinion? Any concern around that?
It is soft, but I think generally for the auto universe, it was expected that margins will remain under some sort of a pressure for a combination of two factors. Demand remaining a little bit weaker and input costs going higher, which would probably mean that pricing that was probably elevated would have also crimped margins to a certain extent. So to that extent, I think if you probably look at the cost of materials that have got consumed or the input cost, the inflation is clearly playing out in terms of numbers if you compare it sequentially on a year-on-year basis as well. I think a combination of these two factors is something which has created a dent in margins, but that was always expected from auto numbers, including Maruti.
Puneet Javeri joining us to give us perspective. Mayuresh requesting you to be on hold. Puneet, quickly, with regard to how you're seeing the numbers and how it's stacking up against expectations.
Well, Harsh, it's a disappointing set of numbers, and when you look at the consensus Bloomberg estimate, revenue was expected to be 40,929. It's coming just about 300 crores lesser, but that's fine because the EBITDA number is a key disappointment in quarter 4. EBITDA has come in at 4,264 crores. In the same time last year, EBITDA was at 4,684 crores. So definitely a miss there. We are also anticipating EBITDA was expected to be around 4,800 odd crores, backed by pricing trends in this particular quarter. So when you look at the overall EBITDA margins specifically, it's coming at 10.5% in quarter 4. Last year it was 12.8%, and that is one of the key disappointments because while margin was expected to fall by roughly between 80 to 100 basis points, it's actually more starker than that, and I think that's a key negative for Maruti. When you look at the fine print and the net profit also coming at 3,711 crores versus estimates of 3,856, so about 150 crore gap in terms of net profit. And when you just look at some of the key numbers, the other expense factor is quite high this quarter. It's up 14% compared to the same time last year, and while we don't give a breakup of that, we'll have to look at the fine print of what led to that, and I think some questions will be answered in the press conference scheduled at 3:30 today. But other expenses being high is one of the key negatives. Apart from that, when you look at the one-off expenses, some increase in employee expenses has been seen as well, coming in roughly at 1,500 odd crores versus 1,300 crores. And in this particular quarter, we just had about 3% growth in terms of sales. So at least in terms of the first fine print, the numbers are below the Bloomberg consensus estimates, as well as, EBITDA has fallen by 9%. That's a key negative.
Okay, so couple of negatives more than positives. Mayuresh, do you view it the same way or something different? In the sense, how is your view stacking up as you're looking at this in more granular fashion?
No, so as I said, right, it's a combination of two factors. If you probably look at the P&L, input costs have gone up significantly quarter on quarter, year on year. And the inventories have also probably stacked up a tad bit, which is creating some element of pain on the margins front. Now, how recovery happens in terms of demand, how competition plays out, and how pricing can support the elevated costs is something to be seen. So yes, I think a combination of these factors is something which has pulled margins down. But I think commentary on all these aspects would be keenly awaited on how they probably look at the next few quarters.
Mayuresh, if I were to quiz you with regard to how should you play consumer discretionary at this time, especially vehicles, two-wheeler, PV, are there any favorites in your bag?
I think two-wheelers might be a tad bit better. Again, two reasons. One, I think holding out in terms of volume, inventory levels seem to be a lot better than the four-wheeler and the commercial vehicle space. And at the same time, if you're looking at a consumption recovery expected to play out, specifically rural consumption, as well as parts of urban consumption over the next few quarters, my own sense is that two-wheelers might fare a tad bit better compared to the four-wheeler or the PV and the CV pack.
Okay, Mayuresh, thanks for that, Mayuresh. Really appreciate your time. Nishchal, it's not that we've heard from a clutch of auto names thus far, but because that's a sector that's still to come out with the larger set of numbers. But what's your sense, Nishchal? I mean, I heard you say that the markets will digest the geopolitical tension and move on. What happens to autos, which are right in the middle of consumer sentiment as well as tariff impact?
So at the moment, I think the demand is still very weak, basically, if we look at it in autos. But incrementally, what I'm seeing here is two things are happening on the macro front. One is obviously the liquidity in the system has improved quite a lot. Secondly, the interest rate cuts have happened, 50 basis point. And third, I think the tax cut which the government have given. I think all of these things is going to show up in the second half of this current year. And you are going to see once again the demand coming back. So I think two-wheelers are definitely going to be a beneficiary of that because the tax cut is not a very large amount in the hands of people, basically. So I think the two-wheeler is one thing which is going to be a beneficiary, but PVs also are going to get benefited because of the interest rate cuts. 50 has already gone. I think another 50 to 75 basis point for the current year is what most of the economists are penning in. So I think that would be a good thing for the whole sector. But I think in the short term, M&M looks good because the outlook on rainfall has been by IMD has been announced as quite positive, and I think tractors are going to do well in at least for the next 2 quarters.
Well noted, Nishchal. The other piece is, Nishchal, at 22,000, a lot of things were looking very good from a valuation perspective. At circa 24 half, what looks, let's say, a very high probability of success sectorally or thematically or from a specific stock perspective, as the case may be?
So I think the best way to play, as you know, is the interest rate cut scenario. That is the one basically which is a much more definite thing happening. Domestic and interest rate cut. I think these are the combinations you should go out. So autos is what I was telling you earlier. It is a domestic industry. It is an interest rate cut beneficiary. Similarly, banks, both these situations are there. I'm not sure about the FMCG as yet, basically, because the demand at the lower end is still not recovering as what people were expecting. Possibly after this current rainfall season, you might see some improvement happening. Some of the valuations or some of the sectors which have corrected quite a bit, I think maybe IT is one of them. One should start looking at it. I think a couple of these companies, especially yesterday, I was listening to the call at Tech Mahindra, and I think they are talking good numbers. They are talking good outlook. I think the order book is pretty strong there. So I think some of these IT stocks also start looking interesting, basically, given that they have fallen quite a bit. So I think focus on two things. One is the theme has to be domestic because this tariff thing is not going away in a hurry. And second thing is interest rate is definitely going to get cut further. So these are the two themes which I'm playing.
What about the entire PSU basket? We've seen a large re-rating now. Valuations, at least in certain pockets like PSU banks, don't look egregiously expensive. But it'll now shift, the onus will shift towards performance and execution because a lot of the re-rating has already played out. How do you view both the PSU overall theme and PSU banking in particular?
I think PSU as a theme has already played out quite a bit. So I don't think so now PSU as a theme is going to really matter much. But I think within the PSUs, I think two sectors really stand out. One is the banking and the other one is defense. Given that what is happening the world over and possibly things are not very good with our neighbor. So I think these things are, the defense names are also going to be in a very good spot for the next maybe whatever time frame. So I think those two themes within the PSUs one wants to play. I think that could be good themes, the defense as well as the banking.
Understood. What about metals, Nishchal, at this time? How would you view the sector as a whole? Any names in particular?
So metals I would want to avoid at the moment because world over, basically because of this tariff thing, I think everybody from IMF to World Bank to most economists are cutting the GDP growth numbers. So I do not see basically how in this kind of a scenario when you have a GDP growth which is getting cut, metals are going to do well. And secondly, basically out of this tariff issue also still, I think the minimum number which people are still talking about after all this negotiation, which is also going to take a lot of time, still the American tariffs are going to be something like a 25% kind of a number. So that is going to disrupt a lot of stuff, basically, whether it is trade, whether it is a growth. So in this kind of a scenario, I think it's best to avoid metals.
Okay, all right. Nishal, thanks so much for coming in, giving us that perspective today on a day like this and speaking with us. And you know what we'll do? We'll slip into a very short break. On the other side, we'll obviously get you perspective on specific stocks and plenty of numbers, all of those flashing on your screen, lots of movers as well, and Atul, Dr. Lal coming out with numbers. We'll talk about that. We'll also talk about Laurus Labs. Stock has recovered quite a bit. And we will get you all heard on the street as well. So stay tuned.
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to the current market price. A premium of nearly 10 to 15% is what the dealers are indicating.
361 is going to issue these securities to UBS at a deal value of roughly 40,000 crore pre-money and around 42,000 crore post-money.
It's an interesting debate here in office, but or rather in the studios. But it's 2:30, so that time of the show. But let me tell you what's being heard on the street, in the dealing rooms, across fund management houses, and more. Somit puts in this effort to try and talk to as many people as he can, and he joins in today. And Somit, I'll be really surprised if too many people are talking about too many specific individual stocks today.
Well, not much stock specific action, to be very frank, and
So
basically the thing is there is cross-border tension plus bit of profit booking also. Market has recovered from 22,000 to 24,000 in just like 7 to 8 trading days. But now there is this India-Pakistan cross-border tension also, which has also led to this weakness in the market. And dealers are suggesting that large HNIs or smart investors are not keen on carrying on their trades over the weekend. They're looking to keep it very light, given the fact that there is a fear in the market that something could come over the weekend. So the basic what the information or what the trade that dealers are suggesting is that they are better off to not gain something rather than losing something on Monday, and hence they are looking to keep it light and not carry much of trade. But on the flip side, some dealers are also indicating that there is buying action in select few names, and FIs in fact are buyers in some of the small and mid cap names. That is what the dealing room is suggesting, and some companies that dealers have indicated that one should keep an eye out for, based on the fact that the numbers are expected to be strong, or rather they are not much, they won't get much impacted because of any cross-border tension. Few names that dealers have indicated that they are keeping on the radar on the back of either stable or strong set of numbers, like RBL Bank. Laurus Labs is one stock that dealers have indicated. In fact, the stock was down at one point of time 5%, but now it has recovered very smoothly, and that is one stock again on dealers' radar. Apart from that, it's IndusInd Bank. Tata Consumer, in fact, dealers are indicating that there was a large mutual fund which was a buyer in trade yesterday and continues to buy today as well. Other stock is JSPL, OFSS, Indigo. So few of these stocks are on dealers' radar, but broadly the consensus view that is coming in is to go light over the weekend and not carry too much long or too much short in trade, at least today.
Interesting. Thanks for that. For those insights, Somit. Always good having you here. And speaking about that, joining us now this afternoon is Neeraj Diwan, independent market expert, and Kunal Shah, senior technical and derivative analyst at Mirae Asset Sharekhan. Let me first come to Kunal. Kunal, what are you looking at in terms of technicals? How are you viewing charts at this point? What levels are you looking at, and what can you suggest?
Yeah, good afternoon, everyone. See, firstly, what we have seen the rally in Nifty from 21,735 to 24,350 on the higher end, what we have seen. So this is broadly a 2,400, 500 point kind of a rally, what we have seen on the higher end. Now we are going to see a retracement of this entire rally. Nifty in today's trading session has again shown some selling pressure and has breached the 200 DMA on an intraday basis. So we expect this move to continue on the lower end. So the first support for the index is at 23,800, and once that is taken on the downside, you expect 23,400, which is where the 20 DMA for the Nifty index is played. So we expect for the next couple of trading sessions the move to continue on the downside for the Nifty index. Similarly, for the Bank Nifty index, this had been the outperformer in this entire rally from 50,000 to 56,000, the 6,000 point rally what we got. We will see some profit booking kicking into the Bank Nifty index here. So the Bank Nifty index downside support stands at 54,000, 53,900 mark. So currently we are trading at 54,700. Expect more 700 to 800 point correction on the downside for the Bank Nifty index. Probably there we'll find a support, and then we'll see some pullback on the higher end. So overall, for the next couple of trading session, at least for the start of the week, next week, we expect both the indices to consolidate or have a downward bias. So any bounce, what you get in Nifty and Bank Nifty, that would be an opportunity to at least book profit or initiate fresh sell positions for short term.
And what about IT, Kunal? Because that's the one pocket which is shining in trade.
See, I think Nifty as an IT index, if I talk about, it's already trading in a larger term downtrend. This is a pullback of the entire downfall what we had. So we have witnessed this pullback, which can extend towards 35,000, 36,000 levels on the higher end. So we are currently for the IT index trading at 35,600 mark. So 36,500 to be precise is the gap area from where this entire recent fall had started. So we'll witness that pullback towards those levels, and probably then we'll see again the correction resuming in the IT space. So our view is negative on IT. Utilize pullbacks to exit your positions or to create fresh sell positions on the IT index.
And what are the ideas that you are brave enough to initiate today, Kunal?
Yeah, I think definitely Neeraj, what you pointed out, the market has to be quite volatile, and even the market breadth is where what you look at clearly indicates the weakness in the market. But I have two ideas, one on the buy side and one on the sell side. So first I'll discuss the sell side idea. Already today, when we saw the rollover data as well, the stock which had come into my radar was Voltas. Already in the May series, we saw a significant amount of rollovers which have happened on the short side. On the technical chart as well, the stock is looking weak, where you are seeing low top, low bottom formations, and the stock is not able to sustain above its 20 DMA. So Voltas is a sell for me. So main futures you can sell 1240 is currently where it is trading. Keep a stop loss of 1285 on the higher end, and I'm looking for targets of 1200 to 1180 on the downside for Voltas. So Voltas is a sell. The second call which is there on the buy side is from the chemical space. I think within this weak market, we need to find relative strength, and that is what is clearly visible on Navin Fluorine. The stock had already given us a breakout, is sustaining at high levels today. Also, there have been volumes above average volumes in today's trading session in a weak market. So clearly indicating strength into the stock. So this is a buy for me at the current levels. Keep a stop loss of 4,300 and look for target of 4,700 to 800 on the upside.
Okay. Neeraj, been asking this question to almost everybody today about the kind of performance that the non-nifty IT names have put up, right? And what Emphasis has done and said, and what Persistent did a few days back. And I think those stocks are doing well. Emphasis, Persistent, Coforge maybe, or some others. What is your sense? Is there merit in trying to fish in the non-large cap, non-nifty IT bucket?
Yeah, good afternoon. Yeah, actually, it's again a very stock specific in IT because, still now there's no clarity, but there is definitely bounce back which is happening. So even a couple of IT, non-nifty, the non-large cap IT name, couple of results are also very good. So there is definitely some merit in looking at these names on dips. But as far as, general, if you generalize and see that, you look at the non-nifty IT space, I think there, again, it will be very stock specific. So we can't really generalize the space, but I think there are some names which are very expensive. So there, even if the buying comes, they will have to be wary of the valuations which they're trading at. So some of them didn't even correct to that extent where, valuation merit was there. So whenever you get some valuation merit, for example, I'll take one small example. I'm not recommending the stock like Birla stock, which in the fall corrected to, I think, 300, or it really came down a lot in the recent fall. So at those kind of levels, where valuation become very attractive based on your last 10-year average, then you definitely look at buying those stocks at those levels. So I think that would be the strategy for most of the stocks which are into the non-large cap space in the IT space.
Point taken, Neeraj. We'll talk about the stock of the day. It's SBI Life, the way the stock has moved today versus how the market's really moving, surely is one that's standing out. The numbers too were very, very solid. You saw a good margin uptick. In fact, the margin improvement surely was better than expected, but 3.5% in absolute terms. So your margins went up from 26.5% to 30.5% on a sequential basis. So that was extremely strong. The second piece which was extremely strong as part of the management commentary was that they categorically denied the regulator, who they said is in any case, keeps taking views from participants, from market participants. And they said that the regulator has not initiated any conversation with regard to banca channel restrictions. This will be big because SBI Life derives a large chunk of its client base from SBI. And therefore, this will be very, very significant for both SBI Life as well as something like an HDFC Life and other life insurers as well, but more so SBI Life. And therefore, what they said was that the sector has been in an overhang due to this, and there could be a gradual clear up of that overhang. So that's something to keep in mind. What hasn't worked is the fact that growth was slightly on the tepid side. It was slightly disappointing. And therefore, maybe that number, once growth starts to come back, you'll see a bit of bit of margins being given up to push towards growth. But why the margin uptick? One is there's change in product mix. Clearly, that's what's improving margins. Non-par has come to the fore, which is the one big positive. The second one is, let's have a look at how non-par firstly is looking. The product mix for non-par is at 35% this quarter versus 22% in Q3 versus 26% same time last year. And that is evident from the kind of margin uptick that we've seen. So non-par was the better performer this time around. ULIP sales have declined sharply again, so participating products are seeing declines. And lastly, the new products in non-par have also aided growth. So they've come out with a couple of new products which have actually aided the growth numbers. Neeraj, I wonder if you have a view with regard to SBI Life specifically, or the life insurance space overall. Is there a view that you have?
Basically, as far as the life insurance space is concerned, my view is quite neutral there, because even if you see last 4-5 years, the kind of return that we got from other sectors is much more than what we got, like HDFC Life also. You haven't got that kind of return which you've got from non-insurance, other financial space, whether it's NBFC, whether it's capital market related, or whether it's the large banks. So the return there is much better, even if someone looking at financials or the related sector. So that's why my view is pretty neutral there. If you get opportunities for trading, these stocks correct because of any regulatory news flow or any reason, you get those trading opportunities where you can make some money for trading. But otherwise, they haven't given that kind of return. So I would say neutral in this space.
Okay. What else? I think there is some serious downticks that are coming in Motilal Oswal stock. That's down 9% now, and now overtakes VST as the top loser. The surprise loser today, and I found it surprising, is ACC. That one shouldn't have been down today, according to me, because I think unitary EBITDA did well. Brokerages largely have been sanguine, but clearly there are some issues there. Adani Green is down 5.5%. Network 18 down about 5.5%. So a clutch of disparate, completely different, but media names and non-media names, of course, have all cracked. In fact, Vodafone has a very large deal today, 108 crore shares, if I'm not wrong. That stock is down about 5% as well. So a clutch of names not doing all that well. Neeraj Diwan, the capital market plays. Now we know that this quarter will not be a good one for them. So one would assume that some bit of it is discounted, but there is some serious pressure on some of the capital market plays today. Motilal Oswal, Angel One, MK, and the others. What's happening? What do you do there?
Yeah, definitely the ones which are pure brokerage houses, there is pressure there. The volumes have not picked up. March was still okay because of the year-ending volume, but April again volumes are not so good for them. What I am positive on in this space is the mutual fund operators. Something like NAM, Nippon Asset Management, or something like a CAMS, which are in the mutual fund space and or support to the mutual fund space. That is where I'm more positive on. Pure brokerages, definitely there is pressure. Volumes have come down because of regulatory changes in F&O lots which had happened. Plus, the markets have not been doing well. So people are stuck with their mid caps and small caps at higher prices. So they really don't have too much of leeway to right now even sell those kind of stocks, so they can generate some volume. So that is what is going to keep the pressure on for these kind of companies.
Yeah, but clearly some pressure there onto all of those names as well. ACC, Kunal, 6.5% down today. The other one is SBI Cards, which is about 6% down today. Anything on the charts for both of these?
Yeah, I think firstly for ACC, if you look at already the larger term trend has been on the downside, where lower high, lower low formations were there. In today's trading session for ACC, two things have happened. First, the 20 DMA has been breached and the 100-day moving average has also been breached at the same time. So clearly a negative crossover on the momentum indicators. This could accelerate the selling pressure on the downside. One can expect the recent low that was made around the mark of 1800 to be breached on the downside. So whatever bounces you get, that would be an opportunity to exit. 1800, 1760 is what I'm looking for the stock on the downside.
And what about a VST Industries, Kunal? What's the view there?
So for ESG Industries, again, the stock has been sustaining below the 200 DMA. So again, we are facing rejection at the higher level. We need to surpass that 200 DMA for the change in trend, which is placed at 340 on the higher end. So the for short term, the view remains negative till the time it sustains below 340. This fall can extend towards the mark of 280, 270 on the downside.
And Neeraj, specifically with regard to SBI cards, the numbers weren't particularly bad. After quite a few quarters, we saw credit costs actually improve in comparison to the last quarter. And this was possibly a moment which a lot of participants in or investors in SBI cards were waiting for, because that turnaround with regard to unsecured and SBI cards being that pure player in that space. Also, the margin tailwind that we will likely see for something like an SBI cards, given the repo rate cut that we've seen, will likely just aid the numbers, right? So today down 6%. What's your take with regard to this space? I also understand it's up 15%. It was up 15% as of yesterday's close from maybe the 10th of April-ish. So maybe a bit of that, but what's your sense?
I think what you're saying is right, that going ahead, the numbers will improve only for them. So this quarter also the numbers were good, and even next going ahead, the numbers will be better with the, even the interest rate cut and even the, income tax benefit that people are going to get from this year. So their numbers will improve, but then the thing is that you see most of the stock which have got results which are as per expectation. So SBI results were also as per what the street was expecting. There wasn't too much of a outperformance from the expectation. So wherever there is, like even Axis Bank, you see that wherever there is numbers have come, but they are just as per expectation or slightly above, there is profit taking which is getting visible. So I think people are not ready to hold their stocks for longer time because there is a lot of volatility as far as the market is concerned. So that may be the reason, I think, why you've seen this kind of a correction after a run up that we saw from the lower levels just 2-3 weeks back.
26% up despite this 6% downtake in the last 6 months, which have been quite painful for broader markets. Kunal, is there a view with regard to an SBI cards?
Again, for SBI cards, we are seeing initial signs of the stock getting top out, and already there has been a lot of bullish trend, but that has been fizzled out. So clearly, some weaknesses were visible in the stock. In today's trading session, again, the stock has breached the 20 DMA, so the short-term trend becomes negative. We can slide down towards the mark of 820 in the very short term.
So, Neeraj, if I can come straight back to you with regard to microfinance as a pocket, your constructive SBI cards, unsecured loans, and therefore maybe Bajaj Finance as well is my guess. But what about some of the microfinance names? Something like a Spandana is down 6% in trade today. Even an Aavas, despite a decent set, is down 4.5%. Maybe not microfinance pure play, but some of those microfinance names have been buzzing in recent weeks, right?
Yeah, I think the pressure which has been there in microfinance, though maybe some uptick, some improvement there, but still, I think it will take a quarter or more from these levels. I think it is only from the, last quarter of this year, you'll get to see some improvement, because I was speaking to one of the banks which have a large presence in microfinance also. So they were also the view that there is still another 2 quarters of pain, which maybe there the things will start improving from these levels. They'll not deteriorate, but improvement, visible improvement will be seen only towards the end of the year. So I think that is what will be visible in the results of this quarter also. And that is why, till you see actual number improvement in the quarter, you won't see these stocks doing that well. So you may get these stocks, they may correct at times which will give you desperate valuation where it will make sense to add some of them based on numbers or whatever reason. But otherwise, I think the pain is not gone totally as of now.
Okay. All right. Now, the top 3 stocks of the day, and there are plenty of buzzers on the back of numbers as well, and we'll try and cover those as well. But some stocks, again, on the back of results. Varsha's here with the top 3.
Yeah, let me start with Axis Bank, wherein let us just split into what worked out for the bank and what didn't. Net interest income slightly below estimates. Credit costs declined, aided the profit beat that the company has seen. And the ROA was at 1.8% and the ROE was at 17%. Deposit growth was extremely strong at 7% quarter on quarter. While what didn't work for the company was loan growth was well below expectations. Macquarie and Bernstein both have given outperform rating on Axis Bank, with Macquarie giving target price of 1,440 and Bernstein giving target price of rupees 1,300. Then on my list is IEX, wherein net profit did meet estimates, but they've achieved highest ever quarterly traded electricity volume, which is up 18% year on year, and 68 lakh RECs were traded during Q4 FY25, which is increase of almost 108%, and the highest ever RECs were traded in this quarter. Last on my list is Nestle, wherein Investec has downgraded Nestle to sell from hold, though they've hiked target price. What they're saying is that valuations have been outpacing growth expectations and top line growth remains soft. Raw material pressure weighs on operating margins, and they've cut EPS of 2 to 3%, and the risk of revenue has actually what led to downgrade by Investec.
Okay, thank you for that, Varsha. Again, we'll stick with the lending pack. Neeraj and Axis Bank and Aavas, housing financiers, as well as one of the larger private sector banks. How do you view the numbers, Aavas, if you've had a chance to look at it, or how do you view the sector as a whole at this point from an investment standpoint?
Yeah, as far as the private sector banks are concerned, the numbers that were declared by HDFC Bank, ICICI Bank were very good, and that's why we saw the kind of rally in those stocks and even the bank Nifty. Axis Bank numbers are just as per what the street was expecting. So I think because of that, the stock is seeing the kind of correction, but then valuation comfort is there in Axis Bank. I think if Axis Bank is correcting because of these numbers or because of profit taking, I think it should be an opportunity only based on the valuation they trade at. So that is as far as Axis Bank is concerned. So housing as another sector, I am positive on. So Aavas numbers I haven't seen, so I can't give a view on Aavas. But generally we've seen that the kind of interest rate scenario we are in now, where a couple of cuts have happened and a couple of more cuts are bound to happen going ahead. So I think there is going to be improvement in demand for housing finance. So these companies should do well going ahead. So housing finance, I'm positive on that sector.
It's interesting because one that Aavas Finance's asset quality was okay, but I thought mostly Harsh, brokerages by and large gave a fairly decent verdict on Aavas numbers. At least, if I'm not wrong, I read the Citi note, if I'm not wrong, which actually spoke maybe relatively okay about Aavas.
Yeah, just maybe Neeraj, it's also the valuation comfort a little bit, right? I read a note, I believe it was Morgan Stanley in the morning, which said that, while the numbers were okayish and largely in line, valuation comfort not there at this point. Is pretty much fully priced in that sense. The one thing that possibly put me off a little bit, if at all, I can call it that, 18% YOY growth on a 20,000 crore base for a housing finance or related company. Maybe you may expect
But haven't they
more.
said that they will do 20% next year?
That's right. So they've said they will do 20% next year, and they're aiming for a 50,000 crore AUM shortly in the next 5 years maybe. So positive on that count. But I'm saying performance this year, when you're looking at it, and maybe that's how the street also looks at it.
Possibly.
That maybe just the performance this year in terms of growth hasn't come through. And the other piece is also the fact that you'd want some of these smaller names to grow a little faster. And maybe that's the only possible concern, at least the way I looked at the numbers.
Down today for sure, and multiple reasons why stocks could be down today, by the way. But onto some source-based information. Sources tell us that the Information Directorate issues lookout circular against Gensol promoters Puneet and Anmol Jaggi. Shrimi has these exclusive details. It's a saga which will probably last for a while. But Shrimi, what are you learning?
See,
furthering its probe, the Forex probe into Gensol Engineering and its promoters Anmol and Puneet Jaggi, ED learned to have reached out to Bureau of Immigration, which is a nodal department, to issue lookout circular against the duo. And in fact, this is to prevent the flight risk as ED deepen its investigation into possible fund diversion. In fact, Anmol Jaggi, who is reportedly in Dubai, has been summoned by Enforcement Directorate on his, email address and the correspondent address, and they are awaiting reply from Anmol Jaggi. And if he didn't respond to the ED summon, ED can also explore legal options. Meanwhile, Puneet Jaggi, who is brother and co-founder of Gensol Engineering, has been questioned for almost 7 hours by ED officials, and the center of that grilling is around, the possible and the potential fund diversion of around 200 to 300 crore is what indication we are getting from sources. In fact, ED suspect that some of these, fund has been diverted, remitted outside by using, digital asset like cryptocurrency, and that angle is also being explored by Enforcement Directorate. Meanwhile, the searches almost concluded what they started on Thursday following the FEMA case registration in the matter, and they have collected a lot of evidences, including the physical documents and the digital devices from the premises, which is linked with the Jaggi brothers. So they are examining all those documents as well. So they are looking at that the term loan, which is being flagged by SEBI, the market regulator. How much is the amount? How much is the money has been actually remitted outside India, and under FEMA they will look into that. Meanwhile, they are also set to file PMLA case in the matter as well, but that will be a separate investigation from the FEMA investigation. So overall, the investigation is ongoing, and we will see more action from the Enforcement Directorate in the upcoming weeks.
Well, so that's the latest coming in from Gensol. Just every day, this case just getting a little bit more murkier. And thanks so much for bringing us that update, Shrimi. Of course, clear concerns in that sense with regard to corporate governance. Neeraj Diwan, I want to take your view with regard to everything that's happening with regard to corporate governance and all affected companies. You have Gensol, PFC, IREDA, so 3 of them. And I wonder what your view is with regard to some of those, PFC and IREDA, because they also saw a bit of a correction post this Gensol saga, or as this Gensol saga played out. And the other piece I want to also talk about is an IndusInd Bank. Are these, maybe outside of Gensol, are these opportunities to buy some of these counters, quality versus value versus the kind of governance that's at play? Or would you completely avoid at this point all of these?
Yeah, I would avoid, because you should go for quality with the kind of market scenario we are in. And, you saw last year also these stocks run up like anything, then they collapse. They come down 30, 40, 50, 80% from the high. So it's not very easy for an investor to take these kind of losses. So go for quality names. You've seen, still now after the correction also, you're seeing good names available at decent valuation. So go for quality and avoid these kind of names. Like, for that matter, I've been saying about Vodafone also. The stock has been into losses. They've been losing market share. They've been losing subscribers. But every time some news comes up, the traders want to make those quick, 20, 30, 50% in the stock, and they get stuck again. So it's better to stick with quality, see where you have the valuation comfort. That is what investment is all about. Investment not about investing in a stock where you can get a lottery and make 50% in 2 weeks or 3 weeks. Those kind of bets may be good for 1 or 2 stock out of 10, but in the other 7, 8, you lose a good amount of your capital. So I think I would avoid and just stick to quality names.
Okay. Avoid this, stick to quality. Kunal, do you have a quick technical view with regard to an IndusInd? Plenty of movement on the stock. Stock is in the green today as well. Can you give us a quick technical view?
Yeah, I think overall, if you look at technicals, the larger term trend is on the downside. So whatever pullbacks, what you are getting, it could be towards the levels of 850, 860, which is the gap area where it could fill in. and probably there would be the levels where one can look to exit the stock or book some profit at those levels. So 860 is what I'm expecting in a very short term. But again, from those levels, I'm expecting again correction back towards the mark of 750, 740.
Okay, all right. You know what we'll do, Neeraj, thanks for joining us. We'll let you go on that note. Believe we need to do that. And what we'll also do is we'll slip into a very short break. On the other side, we'll get you the top buy today, sell tomorrow picks, and we'll get you a bull versus bear segment. And that one is on Tech Mahindra. It's an interesting one which Puneet has put together, so stay tuned.
Stock specific, what I'm hearing firstly is on 361. Tomorrow is the board meet where the company is looking for a fundraise, and dealers are indicating that a preferential issue to the UBS India might be announced tomorrow, and the deal is likely to happen at a premium compared to the current market price. A premium of nearly 10 to 15% is what the dealers are indicating.
361 is going to issue these securities to UBS at a deal value of roughly 40,000 crore pre-money and around 42,000 crore post-money.
The last one.
Back with India Market Close right here on NDTV Profit. Cholamandalam Investment and Finance Company's numbers out on the screen. Total income up 30%, 7137 versus, 5499. I think it's the other things. Then profit up, actually, may not be really bad a number. We wait for the other details to come out, of course. But on the face of it, Harsh, I don't know if there were expectations for this, but it looks okay.
Yeah, it looks like a decent set, Neeraj, and has been the case for quite a few quarters now. So overall a decent set. When I'm looking at the provisioning as well, it's fairly contained. Impairments have come in at around 625 crore versus the 664 crore number same time last quarter, and therefore looks like an okay number. Even the profit after tax has expanded both sequentially as well as on a YOY basis. So steady set, it seems like overall. Seems to be some amount of margin expansion that has happened, which seems to be the other positive, which ought to get built in. But we'll await the analyst presentation, which comes out post the numbers, to try and get a better sense as to how it's looking overall in terms of margin recovery, etc. But yes, at the outset, looks like a decent set, Neeraj.
Yes, indeed. Okay, on to the bull versus bear segment. Tech Mahindra is in focus. Puneet Johnson to argue on both sides. Puneet.
Well, thank you for that. So very interesting, stock today, definitely up in the green, but it started off actually down 4% in trade, and that was largely maybe a reaction to just the numbers being largely in line. But there are quite a few other things that you need to know. Of course, that's the first bull case, Q4 earnings, which have met estimates. While the revenue growth has been very just slight at 0.7%, and compared to the size of something like a TCS and Infosys, they also reported, similar numbers. So definitely that was the bear case. But actually, if you look at the top 4 numbers, they were largely in line with estimates. So, margins at 10.33% also met the guidance as well as the estimates that was there as well. So let's move on to the second bull and bear case, and that's deal wins. This is where it gets very interesting because the company reported deal wins of roughly about $798 million in Q4. That takes the total deal wins to $2.7 billion, and that's up 42%. And that's the highest versus all tier 1 peers. Now, of course, Tech Mahindra had a favorable base in FY24, but it's a really strong number coming in terms of deal wins and sets up the pace for FY26 for ramp up of that as well. When you look at the bear case, though, ramp up is going to be one of the key aspects to watch out for. For all tier 1 IT companies, we have seen while deal wins have been strong in this particular quarter, there is an aspect to look at in terms of execution of that and how quickly can they do that in the first half of FY26. That will be a key monitorable in this particular aspect. Now, finally, in terms of last bull and bear case, both Kotak as well as Investec as brokerage house are estimating Tech Mahindra to meet its FY27 guidance on EBIT at 15%. Now, just for some context, EBIT last year in FY25 essentially was roughly between 10 to 11%. So it is a very steep target for the next 8 quarters. While brokerages are divided whether the company could do it, they are anticipating under the new CEO, Mr. Mohit Joshi, that those numbers should be able to achieve in the next 8 quarters. Valuations currently at 21 times FY26, very similar to that of TCS and Infosys. Looks like it's largely baking in the company meeting these estimate targets. So it's going to be very interesting what happens in the next 3 to 4 quarters, at least in the near term. And if they can start their margin trajectory towards the 12-13% in EBIT in FY26, but that seems to be slightly penciled in right now. So it's not the valuations are very, very cheap compared to the other mid-cap IT players it might be, but compared to the large-cap players, it's largely in line. So a lot of things to watch out for, but overall, good set of numbers for Tech Mahindra, and deal wins was another key positive in this particular quarter.
Okay, thank you so much for that very comprehensive view, Puneet, with regard to Tech Mahindra. And let's take this conversation straight to Vineet Bolinjkar, joining us, Head of Research, Ventura Securities. Vineet, Tech Mahindra in particular, I know you're not exactly positive IT, but Tech Mahindra in particular, re-rating candidate likely on your list?
I think the valuations are a tad expensive, and so it would be a hold on, in my view, in my best case scenario view.
IT overall, Vineet?
Continue to be pessimistic. We believe that, just because the war has started drumming up, we are seeing a flight to safety. IT is that bucket. But don't see it last for very long. Once this event is out and the next quarter comes in, you will see further weaknesses and markets reacting to those numbers.
And Vineet, and I'm just trying to contextualize this a bit better. I remember you telling us that you wouldn't touch IT with a barge pole, just maybe last week. But I just want to contextualize this from a perspective that maybe the tariff overhang is starting to go away. The fact that there's no real major risk to the Fed chair getting changed or shifted. Rates in the US currently volatile but unsure, but getting likely though, the visibility is getting better because the entire tariff overhang might go away or there's a larger tilt towards that. That doesn't change your view at all with regard to IT, even now.
Let's look at the macro. 50% exposure to the US economy. Right. US economy in the doldrums, unable to contain their fiscal deficit. Everything in the US, if you start local manufacturing, still more expensive. People wanting to go for Chinese goods despite availability of certain products which are there in the US purely because the cost element is almost 50% higher. And now with the base and getting your Trump deals going is very difficult. Add to this your AI. Trump has wanted the inflation to cool off. The rates have been going higher. And there has been slay of hand M2 increase globally. So when slay of hand M2 increase globally, inflation goes up, yields kind of also go up, and it's very difficult to get cheaper rollovers for their debt. So, until they don't roll over their debt, you can't really take a call on how the value of the dollar would be driven. We expect the dollar to dip further. That puts pressure on rupee, and that indirectly affects, your pricing and EBITDA margins. And add to this AI coming in. I think it's a lot of variables that you're dealing with. And in a domestic economy with India having 6 to 7% growth, why chase stocks where there is so much of froth? I think Indian manufacturing is a plain, simple story. Even if they get a fraction of the share from China, the pie doubles, and better to play manufacturing export rather than to focus on IT plays.
Within manufacturing, are you playing, Vineet?
Look at leather goods, look at textiles. Brilliant plays out there. Look at manufacturing for defense, manufacturing for your EMS products. I think there is a lot of availability of good quality value stocks with substantially lower multiples. I think these are great plays out there.
Shriram Finance's numbers flashing at the bottom of your screen. Net profit is at 2144 crore versus the 2228 crore number, which was expected. So a tad bit of a miss. The net interest income number is the absolute net interest income number is 5556 crore. So that one also coming through. Slight bit of miss. I'm going to quickly look at those numbers. What we're seeing with regard to provisioning and impairment, which is obviously the number which we'll focus on, which will add on to asset quality. 1563 crore is the impairment number versus the 1326 crore number same time last quarter. So we've seen an inch up with regard to provisions, which is likely not being taken well by the street. Stock is down 5%, just quickly slipped on the back of that. And I'm going to quickly take views. Vineet, within the NBFC pack, it's largely positive, right, given that rate cuts are coming through. But I'm not sure if you've had a full chance to look at the Shriram numbers. If not, just the NBFC pack. Give us a quick view.
Prefer banks to NBFCs. And if you want to play the NBFCs, play the direct consumer play, which is Bajaj Finance.
Okay. Kunal, do you have a view with regard to a Shriram with the way in which the stock has just moved?
Yeah, I think overall the chart structure has been positive apart from today's result. So the stock in today's trading session has again reached the 20 daily moving average. So the short-term trend could be it could test the 200-day moving average, which is placed at 616 on the downside. So short-term view is negative, but overall the large-term view still remains on the positive side. Within this larger-term uptrend, we might see some correction that could come in.
The NII number largely in line with what was being penciled in by analysts, and this is total income less interest expenditure, largely in line. So it's probably the hit is probably being taken more so because of a slight inch up with regard to impairments within the financial statements. So so credit losses is what is causing that little bit of blip with regard to profit after tax. It's just a marginal miss, frankly, Neeraj, but not taking it too kindly, at least at this point. The stock is down 5% odd. But on to the brokerage note of the day, Kotak Securities has maintained a reduced rating on Cyient. There's just so much happening, frankly. So let's quickly try and address as much as we can. They've cut target price to 1150 rupees from 1300. Puneet joins us with the details. Stock under pressure, down 6%.
Well, thank you for that. So we had 4 IT earnings actually today, and we've addressed Tech Mahindra. Cyient was the other one apart from L&T Tech. That was a disappointment, while Emphasis had a positive view. In terms of Cyient, it's a second consecutive quarter where the margins have been below estimates. In this particular quarter, EBIT margin was down 4%, overall margins at 13%, and the net profit beat was also led by other income of 39 crores, and that's something that Kotak has also mentioned in the note. They mentioned that it's a yet another significant miss in terms of operating performance, and the company is now suspended as guidance. So no guidance given for FY26. They mentioned that currently they don't see any kind of respite in terms of demand. And they seeing challenges of demand in the near term. EBIT margin aspiration have also been lowered as well as deterred going forward. So they are cutting EPS estimates by roughly 8 to 14% between FY26 and 28. And it's important to know that while today it's down 5%, after quarter 3 earnings, the stock was down 22%, which was the first clear miss. We have seen a new management come in as well for Cyient go into the next quarter. So that will be something to watch out for. But overall, weak earnings for the company, and brokerages are also maintaining the negative view on the stock.
Okay, so Cyient also under pressure on the back of that. Kunal, a quick technical view with regard to a Cyient, down 6%.
See, already the trend has been negative for the stock, and it has been making a lot of low bottom formation. The stock is trading in a deep oversold territory, but this correction could again continue towards this area on the downside, which is played at 1050. So 1050 is what I'm expecting on the downside, and probably from there we can see some recovery coming back.
Okay, so Cyient 2 down in trade. Vineet, I wonder if you have a view with regard to something like a VST Industries, 4.5% dividend yield, consumption play, domestic facing, a lot of the risks which you're not currently comfortable with, something like a VST does away with. And I ask you this because the stock has also moved substantially post the numbers today.
So, they are more into these tillers than tractors. Tractors is a very large market. A lot of incumbents already there. VST focuses on the lighter range of the HP pack, and not very inclusive model as such. So would want to reserve my opinion on that.
Fair, Vineet, more on VST Industries and not tillers, because that stock has moved 8.5% lower on the back of numbers.
You asking VST Industries? Sorry,
yes,
I don't cover
please.
this.
Yes, please, Vineet. Sorry, no, apologies. I allowed you to complete your point so that we get views on VST tillers as well, but VST Industries.
No views on that. We don't cover it.
Okay, fair point. Kunal, any view with regard to VST Industries, 8.5%?
Yeah, I think there is more downside left for the stock.
Okay.
So this is the pullback what we had, and for that pullback, we are now seeing the correction getting resumed. So the stock can go towards the mark of 270 on the downside.
Okay. And Kunal, your BTST, STBT?
The BT, yeah. So I'll recommend over here Chola Holdings as a BTST call. I think the structure is positive or bullish. Flat pattern has been formed over here, and we expect this to break out on the upside. So 1982 is where currently it is trading. Keep a stop loss of 1960 and look for targets of 2010 to 2030 on the higher end.
Okay. Now, Vineet, the ACC numbers, and I mean, unitary EBITDA being higher, most people or most brokerage notes that I read were not, actually most were constructive. Stock is down about 6%. Any thoughts here?
So I think, what the focus of the management is more towards Ambuja. And I think there is lack of interest from the management to push ACC because all the activities are happening in Ambuja. And, that would create a situation where the valuation multiple, when they're looking to merge the two entities, could compromise the interest of ACC vis-a-vis Ambuja. And hence, I think that is the reason why this stock would be beaten down. Otherwise, there's no reason. The performance has been great. And, so it is going to remain like a lackluster play within the cement pack.
Okay. Vineet, the other thing is today the fluorochemical stocks have shown a bit of a flare up. Navin Fluorine is up, Gujarat Fluoro in the green, some other select chemical names too doing well. Is it a bucket that is kind of lived its pain and could start doing well, or is it difficult to say in light of all that's happening in China?
So I think, I would go with your second thoughts that, difficult to say what's happening right now. But, let's see how long this holds on to. You would want to have a more better clarity on everything that Trump is doing. There's too much of a haze around that, back and forth on a lot of decisions. Don't want to plow money into sectors being stuck purely based on the outcome of an event, which is a 50-50 chance.
Okay. Fair call. What else from amongst the last few minutes of trade, stocks which might be moving around, and Kunal would want to take your views on some. So I think there is on very high volumes, there is a bit of a downtick on Motherson Wiring, Kunal. It's a stock priced at about 55, if I'm not wrong. Could you take a look at that for me, please?
Yeah, I think here we are seeing that the stock had faced multiple resistance around the mark of 55, 56 zone, and we are not able to surpass that mark decisively. Yes, there has been volume-based buying in the last couple of trading sessions. We need to wait for a breakout above this 56 zone. Once that is taken out, then we can expect the stock to go towards the mark of 60, which is where the 200-day moving average for Motherson Sumi Wiring is placed.
Got it. The other one, Kunal, that is sunk is IGL. Sharp downtick there. Any thoughts?
Again, here the down move is likely to continue. The trend is weak. The stock has been facing rejection at the 20 DMA, similar structure like Voltas or what we discussed. And I expect this to continue on the downside, can go towards the mark of 170, 167 on the downside.
Vineet, let me come to you with regard to a Motilal declared numbers. We've spoken about it earlier on the show, but haven't taken your view. Wanted your quick take because one, of course, stock down 8.5%, numbers were weaker and of course expected to be weaker, but they've turned into losses and therefore that's where the concern lies. Would you at all give us a view with regard to this one?
I think, you will find that to be the case with most of the brokerage stocks that, the numbers are very, very bad. Because last quarter we saw severe downtrends in, your trading volumes. And if you don't have very large FII involvement, where the retail when the retail participants are minuscule, you're bound to declare a disappointment. So that will be the trend playing out with everyone. However, the next quarter seems much better. This quarter, we've seen some good active participation, but again, we've had headwinds and most of the retailers are, long players. So again, we could have the risk of volumes drying up.
Now, Reliance is the other one which is in focus because of numbers, and let's quickly go across to Somit. He's here with what to expect.
Well, yes, Reliance Industries' fourth quarter on a consolidated basis is expected to be quite muted, though revenues of the company would be higher by around 26% as per the estimates. But EBITDA is expected to be down by nearly 1%, and this will result into very sharp drop in the EBITDA margins. It could come in at close to 14.3% as against 18.2% reported by the company in the previous quarter. Net profit is expected to be flat at close to 18,500 crore rupees. Now, segment-wise performance, if you look at, it's the O2C business which will be the main drag on the financials, and that will be largely on the back of lower gross refining margins and weak petrochemical margins. O2C segments EBITDA is expected to be 3% lower on a sequential basis. EBITDA of retail is expected to drop by nearly 9%, but that is largely on account of the fact that Q3 is a seasonally strong quarter because of the festive season, and hence we are seeing this drop. When it comes to the oil and gas exploration business, that is expected to be around 5% on a sequential basis, and this is largely on account of lower gas volumes in the fourth quarter as against the third quarter of FY25. The only segment segment that is expected to report a growth is the telecom business. Now, if you look at Reliance Jio, which is the telecom arm, revenue, EBITDA and net profit is expected to be higher by anywhere between 1.5 to 2%. The ARPU is expected to be 1% higher. Subscriber number is expected to come in at 48.76 crore, and entire growth for the telecom business will be led by ARPU and on the back of the tariff hike and because of the subscriber addition that the company has done. However, do remember that the ARPU growth is slowing down, and this is the slowest growth that will be seen in the last 3 quarters. Now, a company had taken a tariff hike 3 quarters back, and that's the reason we are seeing this kind of a growth on the ARPU and the tariff front. Now, the key things to watch out from the Reliance Industries earnings would be margin outlook in refinery and petrochemical business, their outlook for the new energy business, what is the commentary that comes in on ARPU post tariff hike, Jio Fibers growth, and any commentary on capital expenditure outlay and how they plan to reduce their debt now going forward would be important to track from Reliance Industries earnings.
Thank you so much for that, Somit. Vineet, coming to you with regard to Reliance, it's been a rank underperformer now. A little bit of uptick that we've seen over the last maybe 10-15 days, but it's been a rank underperformer. What can we expect in your views with regard to Reliance at this point from a value standpoint as well as from expectations going forward?
So, the first thing from a business risk case, considering that war clouds are, hovering around, I think I would avoid all stocks with assets near the borderline. Jamnagar, even all the Adani stocks which are, having their operations in Khavda, because they're susceptible to damage. Of course, they would be insured and you will get the money back. But, putting those assets back into play is another question, which will take a lot of time, and you don't know till when this could last. So right now, my pure take is to avoid this stock. And, if this thing continues, then questions of the IPO for Reliance Jio and Reliance Retail also hang in limbo. And that puts a little bit of pressure on when you're talking of debt curtailment. So my view is to completely avoid these stocks.
Completely avoid. Thank you so much, both of you gentlemen, for joining us this afternoon, giving us all of those views. We'll let you go on that note. Thanks for being with us. But quickly on to where we are settling in at as we close this week out. Of course, it's been a tepid couple of days, but outside of that, the week has been overall quite strong. Whether we're able to hold that 24K mark or not is really the big question at this point. We're a minute away from close. But at this point, it seems that we're about to close 250 odd points lower, which is just below the 24K mark. 1% odd lower on the Nifty Bank. Let's pull up the intraday chart as well. And within that intraday, what we're seeing is we were building on a little bit on the gains that we're making somewhere midway through the day of trade. But thereafter, we're now kind of giving away some of those gains as well. So 250 odd points lower is where we're settling in at. Let's look at the heat map as well. 2 pockets which have likely been in focus pretty much through the day. One set is clearly T, because that set has been doing decently well. Even IT, for that matter, has given up some of the gains that they've made through the day. And then, of course, there are these pockets, media, defense, etc., which has seen some bit of pressure. Let's pull up the heat map with regard to sectors. We've closed for the day, by the way, as well as for the week. But defense was the other pocket, down 3%. Realty also silently now down 3% for the day. The Nifty metal is down 2.5%, so that's another pain pocket. Auto down 2%, has also underperformed. PSU banking stocks are the other pocket which have done slightly poorly in trade today. 0.5% up on Nifty IT as we close. Let's pull up the intraday on the Nifty IT if we can, and thereafter look at it from a week gone by perspective as well. That's for the day, 0.5% higher. It's been a choppy day actually for the Nifty IT. It's not been a very clean 0.5%. We've been in the red for some part and thereafter bounced back and come off the highs as well. So it's been quite a choppy day for the Nifty IT index. Let's look at it for the week on by as well, because otherwise IT has done fairly well. There you go, 6% up for the week, the Nifty IT index. So this one's definitely in focus. Let's look at the Nifty 50 as well for the week on by. Yes, 0.5% higher on the Nifty 50. So that's how it's played out. Can we also pull up the Nifty Bank now while we are at it? And there you go, the Nifty Bank down around 0.25%. So it's not been the best week for the Nifty Bank. Let's pull up the advanced decline for the day and see how the breadth has been. It's been a steady 2,000 stocks in the decline. So it's been a weak breadth pretty much through the day. And that's where the Nifty mid-cap and small-cap indices have felt the pain. Let's pull up the weekly chart on the Nifty. Okay, the daily chart as well, 2.5% lower on the Nifty mid-cap. The Nifty small-cap as well has seen some bit of pain. We're seeing a marginal recovery and thereafter we've slipped again. The Nifty small-cap too, down roughly 2.5%. Let's look at the weekly charts on both of these and see how we fared. Well, flat for the week on the small-cap index and the mid-cap index, there you go, just about 1% higher. So that's how we flip-flop on the Nifty mid-cap and small-cap indices. Last off, I want to look at a couple of sectors for the week. We've looked at IT, major positive, but I want to look at realty, the other one within the broader market space, and try and see what they've done, because plenty of flip-flop there. So while 3% lower for the day, it's still up 1.4% for the week gone by on the Nifty Realty. That's how it's played out. Now, in terms of cues for next week, let's try and zoom in and see what all do we have for next week. You'll have loan and deposit growth, foreign exchange reserves. These are domestic largely, but I think there's also plenty that's going to come up through the weekend with regard to everything that's happening at the India-Pakistan border, and maybe that may also influence how everything plays out in the next week. Core retail sales, Canada, okay, with regard to global, and then we'll have a whole host of earnings as well, I guess. Corporate action, there's a rights issue at Lloyd's Engineering, 9:34, and HCL Tech interim dividend will be in focus as well. Let's look at all the earnings that will be in focus pretty much through this weekend, and which we will have to look for on Monday. Delta Waters, 4% shares to exit lock-in. And last off with regard to earnings, if we can pull that list up, there'll be a whole host of earnings, including a Reliance Industries, which I'm sure will be in focus on Monday. And you know what, actually we have a press conference, Maruti Suzuki's press conference. We'll go straight to that. But for now, it's a goodbye from all of us here.
What SIAM has forecast is not going to be a better year. Growth has been foreseen at 1 to 2%. I think Maruti will try and do a little better than that, but we are doing better not because of the domestic performance. We are doing better because exports have been very buoyant. Export growth in 24-25 was as high as 17%. The numbers, as you'll see, was about 322,000 vehicles. It's the highest ever achieved, and I think we are now about 43% of domestic exports. In the coming year, the situation is going to be very similar. Exports are expected, because you can never predict exact figures for exports, you can't have a fixed target. But our expectation is that we will try and increase exports by about 20%. And that is going to be the main driver of our total production, of our sales, of our profits. Along with that, the domestic market growth will, unless something changes, remain muted. Government, I think, has recognized to a large extent the fact that without the revival of the small car market growth in India will always remain muted. This is because if you look at the household income distribution data, you will find that 200 million households out of 300 million households are having income below $6,000 per year. The households which have incomes above $25,000 and between $18,000 and $25,000, they are about 8%. If we go up to 12 lakh of rupees, which is about $14,000, we get another 5-6% added. So about 12% households in India are above 12 lakhs income annually. To buy a car costing 10 lakh plus, you normally would need to be in this household bracket of 12 lakhs plus. And therefore, car buying in India is largely restricted to this 12% of households. How can you get high growth if 88% of the country are below levels of income where they cannot afford these cars costing 10 lakhs and above? The smaller cars, the cheaper cars, have become unaffordable to these people, as I've said in the past, because of the high cost of implementing regulatory measures. And we have seen that in this current year, the sale of small cars has declined by another about 9%. So if 9% is the decline in cars which are bought by 88% of the people in this country, where will you get growth? I think it's a fact which people have to look at and recognize. It's not as some people seem to think, that India has become affluent and everybody wants to buy the expensive cars. That would happen if the number of households having income above 12 lakhs increased from 12% to 50%. Then you would have this situation where there would be a big possibility of selling large cars, but that's not true today. And it's a fallacy to think that the decline in the small car market and the growth of the SUV market is a result of people aspirations changing and people wanting to buy big cars and not wanting small cars. It's not true. What is happening is that people can't afford small cars. Anyway, that's as far as the market situation is concerned. Some of the key important things which you'll ask me about, which I might still talk to you about now. I've already talked about exports for this year, which I think we are expecting that the growth will be around 20% or so. Our capital budget this year we'll be spending something around 8,000 to 9,000 crores on the capital budget. As you know, the Kharkhoda second unit is on work now. The first unit is already commissioned. The second unit work will continue. We have to see the market situation to decide exactly when we want to commission it. We will be launching the EVs this year. As you know, we already launched it actually. And domestic sales will start before the end of September, and export sales will start. This year's production will largely be exported, largely. I think the annual production in the 6-7 months that we're talking about will be somewhere near 70,000 electric vehicles, the bulk of which will be exported.